Can hear me?
You have to hit the start button, yeah.
I
It should
think
be
I
at the
did.
top of your control box.
Yeah, I think I did. I saw it.
It
Is it
says you're
going?
still on hold. We should get a message that says the broadcast is now starting. If not, I don't get the privilege. I got to call Larry in the background and have him hit the button.
I'm like 100% sure it's recording because it says stop recording. So if I wanted to stop it, I could stop it. It says on air.
I'm so sorry then. Let me go ahead and introduce you. It means my computer's lagging. Good morning, everybody. Apologize for that, but welcome to Traders Corner's Stock and Options special event. We're currently in a post-Labor Day trading environment and shifting gears for a big increase in volatility. On our panel today, we've handpicked 7 professional trading experts of the highest caliber, and they've agreed to share their most consistent and profitable trading strategies with us today in a free online educational forum. In today's Stock and Options special event, we're going to learn from a wide range of topics, from how to make money shorting to how the SPY super system works. So grab yourself a nice hot cup of coffee and settle in. I know I just got one for myself. Today's show is packed with great information. We're going to get started. You may have seen our first presenter on Fox News, Fox Business Network, RT America, Cheddar TV, and CBS News. She's an expert stock market analyst and the founder and owner of an international education company where she teaches people how to successfully trade the market. Her trading methodology is based on one wonderful strategy called Golden Gaps, which pinpoints institutional money in the stock market. Here to present Make Money Shorting is Melissa Armo of the Stock Swoosh. Welcome back to Traders Corner, Melissa.
Thanks so much for having me. Great to be here with everyone. I'm jealous that you have coffee. I have had no coffee yet today. So I am needing caffeine desperately, but we will make it through. It is a rainy day here in Manhattan, and I'm coming to you from New York. Welcome, everyone. My name is Melissa Armo, and I own my own company called the Stock Swoosh. So we're in interesting times right now. Today's topic is shorting. I'm going to talk about shorting, how to make money shorting, and actually, I'll tell you what we did today. We shorted Mu. We did Mu. We got in, we got out. It was a nice short. It fell. The market, however, is attempting to rally today. Market gap down today, is trying to rally. And Jerome Powell will be speaking today. It will be after 4 o'clock, so you can watch what happens in the after hour tonight. But he is doing a speech tonight after hours, so we'll see where we go between today and tomorrow. Oh, there, can you hear me? I think that the recording just started now. All right, great. Thanks, Rob. I just heard it give a little message. Hopefully everybody can hear me. Can you hear me?
I know I can, and I think it was just a delay on GoToWebinar, with it processing.
Okay. All right, so I don't know if it caught the first part, but I'm Melissa Armo. I'm here to talk to you about shorting today. So if you have any questions, you can email me at melissa@thestockswoosh.com. You can also call me at 929-3200-GAP. You can follow me on Twitter, Facebook, YouTube, or Skype. And as Rob said, I do appear on television talking about stocks, talking about the market, talking about the economy, which has been on tap for pretty much the majority of the year, mostly with interest rates rising. And we're in an environment where interest rates are going to go up at least one more time between now and the end of the year. And again, the Fed chair will be speaking today after 4 o'clock, so that will be an interesting time to listen to what he has to say. I do believe that the market is in a very critical area. Yes, we're rallying right now today. However, we've had a really big sell-off for the month of September. If you go back and look and see how September started, we've done almost nothing but sell off this entire month. And we did short it. So again, I prefer to short. One of the reasons that I prefer to short is that short moves happen fast, quick, and big. Again, we did Mu today. That was the day trade we did this morning. We shorted Mu. You can pull up the chart and look at it. We got in, we got out, we made money, and we were done for the rest of the day. And that's how I'm able to talk to you here now today, and then have the rest of the afternoon to myself. So a lot of people come to me and they want to learn what to do. But some people are not serious, I think, about their trading. They're kind of doing it on the side, but they're not taking it seriously. Even if you're only trading for 1 hour a week, the fact is you have to take it seriously because you're risking money. You could lose if you don't know what to do. Now, whether you want to become a professional full-time trader or a part-time trader, or again, do it on the side with your regular job, keeping your regular job, you still have to take it seriously and you still need to know what to do. So you have to think like a professional when you're making choices about your trades, okay? So I always get this question, can you make it as a professional trader? The answer is yes. And if you can, it's a great lifestyle because you're not working for 40, 50 hours a week. So how can you earn a living doing this? How can you make money? You have to be consistent. I'm sure if you're here and you've traded before, if you've traded even today, sometimes you make money, sometimes you lose. In order to be successful or to do it as a living, to rely on it, you have to have the consistency. That means you have to make money in more trades than you lose. And if you don't, you're not going to be able to get anywhere with it, okay? And you have to kind of prove to yourself that you can, in fact, do it. And you also need a strategy that you can use, that you can replicate in the market each and every single solitary day. So today, Mu gapped down. Mu had earnings last night, it gapped down today, and we shorted it. We got in and out. We also did the SPY this week. Now, let's go over what is a gap. Again, this is a daily chart of the SPY. So what happened here? This is the close of the U.S. market, 4 o'clock Eastern time. This is the ETF for the S&P. The SPY fell. This was last week. Remember when the Fed had their meeting? Closed here, gap down here, fell off a cliff. Okay, we shorted the market here. This was Wednesday, this was Thursday of last week. Okay, this was the 21st. So what is a gap? A gap is the difference between the close and the open. So this gap down, then we shorted it. And we also bought puts. Okay, we're going to talk about options today, and we're also going to talk about day trades. But in today's markets, people think they can short everything. And again, if the market turns bearish, that's exactly what people are going to try to do. But you can't short everything, okay? You can't short every gap down. You can't go long every gap up. Also, gap fills don't work. That's a misnomer. People get sucked into doing gaps thinking that that could work. If it was that easy to play something as a gap fill, no one would ever lose money. It doesn't work consistently as something to do. Yes, sometimes gaps reverse, but that does not mean it's something that works more than it doesn't, okay? Sometimes anything works, okay? It's just the luck of the draw on things. That's not a consistent way to make money in the market. You need to have something that's reliable. But for me, it is gaps, and I use a set method to rate the gaps to determine what exactly I'm doing, what exactly I want to trade today, and I go with the highest rated gap, which is why we did the Mu today, okay? So what I do is a system that I invented myself. It was 2008, 2009. I figured out this system. It took me about 3 years until I figured the whole thing out. And now I teach my class once a month. I teach people how to do it. But I trade every day, Monday through Friday. I do options and I do day trades. And one of the reasons my class is so special is that I did not create my business or my class or anything to teach anyone. I did it for myself. And then I ended up realizing that I had a voice, which is one of the reasons why I started to appear on TV. Because I'm good at talking, I like talking, it's fun to do. And then of course I'm also trading for a very short time every morning, so I have the time to do it. I have the time to do lectures like this right now because I'm not engaged in any specific trade right now at the moment. So having a strategy to focus on daily is very important. You also shouldn't have any distractions. And what do I mean by that? I mean, if you've got CNBC on 24/7 while you're trading, you may hear somebody say something that may scare you out of a trade. It's better just to trade and look at the price data, look at the charts, look at the price action. That's going to be better for you. If you listen to even the economic news, you're going to say, wait a minute, we had a good number, but we're falling. This makes no sense. The data doesn't always add up to be exactly what you think. So again, if it was that easy, okay, in order to just short something if we have bad data or buy something on good data or news, okay, like earnings, for example, then again, no one would ever lose money in the market, okay? So the basic general analysis of what I do is not just gaps, but it's really momentum trading. And that's how I'm getting really, really large moves in stocks. So this is something that a lot of traders say, yeah, momentum, but they really are scared of momentum, don't understand momentum, or really don't know how to trade it. So I think one of the reasons people don't trade momentum is they just don't understand it. But I do trade momentum. The momentum comes in the gap. And then I play it. And again, that's how I can get large moves in stocks. And whether you have a beginner account or a small account or a large account, you can make money if you're trading momentum. You got to get the direction right, but of course, that's always the case. I'm seeing some chats in the room. If anyone has any questions when we're going along, I will see it and answer them as we're going along today. Anyways, this was a chart of Netflix. We shorted this. We did a put in this. Here, we got the move down. And again, you say, oh my God, it was really, really late. No, it wasn't. It was not. And you could see it wasn't late because it continued to fall. So again, the momentum in Netflix here for the play, wherever you did it, was to the downside. Momentum was a short, and we bought puts. A put is a short, okay? Again, what is a gap? A gap is a difference between the close and the open. So Netflix closed here at 4 o'clock Eastern time, gap down here and open here at 9:30 a.m. Eastern time. So this is a gap. It was a gap down. Then it fell. Boom. Again, that was the second week of September, actually. So a couple of weeks ago. So what is a gap? A stock bounce on the opening price today is different than the closing price of yesterday's trading. A gap is a break in price action from one day to the next. Now, the market gaps almost every single solitary day. Again, I don't trade the market every day, but I look at the market every day, and I might trade the market if it's gapping and if it's a good gap, or what I call a golden gap. So what is a golden gap? It's a gap that rates per my 26-point system 20 points or more. I take it in the direction of the gap. I do the ratings in the pre-market, or you could do them in the post-market, but I do mine in the pre-market. So the market may gap tonight because Powell's talking. I don't know where it goes or what it does, but he's talking after hours, which is really unusual, but he is, okay? So the fact is that I'm always trying to find the best trade I can, the highest quality trade that has the highest odds of working, because I feel if I take something that rates high, I have higher odds of making money and getting a large move and less chance that I'm going to lose. Now, I do put stops into my trades. So I have a limit order. When I put a stop in, I put a stop in the mu. The mu didn't stop. The mu went on to work. If I had stopped in the mu, I would have lost, but I would have lost a fixed amount versus an unlimited amount. Okay, so stops are important, and people should use stops, because if you don't use stops, then again, you have an unlimited risk. But every single thing that I'm looking to do is based on institutional money. So I'm looking for institutional money in a chart. It could be buying or it could be selling. Okay, so what is institutional money? It's big money, hedge funds, banks that are invested in stocks. They're buying stocks, they're shorting stocks, they're selling to positions. And again, what happened in the market in the last week? We sold off. People dumped their long positions in the market, and that is what we shorted, okay? So if you're following institutional money, it is very easy to make money trading. If you're going against it, it is very, very difficult, because you're not gonna, you can have a trading room filled with 1,000 people, and it's not gonna move against what's happening in the institutional money. I'm looking for gaps that are created and made with institutional money, and it makes it so much easier to trade. And again, that's how you're getting the big move. So I'm not trading penny stocks. I'm not trading ultra cheap stocks. I'm not doing any of that kind of things. We're doing companies, things you know, places you can say, oh yeah, I bought a so-and-so there or whatever. It's things that you recognize, companies with volume. You will get filled in position. You will get filled out of position. You could do them as day trades. You could do them as options and calls or puts, okay? Somebody's answering a question. Most of the times will be wiped out by algos with moves. I don't know what do you mean most of the time you're going to be wiped out by what? I didn't understand that question. Most of the time you're wiped out. I don't know what you mean by wiped out at all. There are machines that are in the market in every single thing that we trade. But there's also people trading. And don't forget, people program machines. Let me look here at question. Stop losses for Fed time. Stop losses. I still don't know what you mean. Do I day trade at 2 o'clock when the Fed isn't making an announcement? No. So you're mentioning about the Fed. The Fed meeting last week, we were already in trades, and I was in the right direction. So we were in puts and the market fell. I'm not day trading during the Fed announcements, because the Fed has meetings once a month. And when that happens, the market can be volatile. It could go up and then reverse and go down. If that's what you mean by stopping, I'm day trading in the morning. I'm flat and out of my day trades usually by 9:45, 10 a.m., 10:15 in the morning. I might be in options, but you got to follow through whatever you're doing with the options trades. my stop in an option is the amount that I have risk. So if you risk $1,000 in an option and it goes against you for 5 minutes with a Fed meeting and then goes in your direction for the rest of the day into the close, you're up money. So I'm not sure what you mean. If you're day trading during Fed announcements or Fed meetings, that is a bad decision, in my opinion. I would not do that going forward, whoever said that. Just stop doing that. I don't have a problem with algorithms trading. I don't have a problem with anything when I'm trading in the morning. Okay. We were talking about institutional money. Here was Adobe. This was another earnings trade. Stock closed here, gap down, open, rallied, dropped. We shorted it, and we got in, got out. We also did a put. Didn't really go till here. Again, this was the day. This also gap down here. This was the day the market gap down. This was after the Fed. So the put went really here. The put was up a little bit here, but took a couple days to really get going in the momentum. Again, this was selling that happened in Adobe. Okay. What does selling look like? What does institutional money look like? What does buying look like if you want to go long something? I was on a Schwab's new network yesterday with Nicole Pitalides. They wanted me to talk about things I wanted to go long. Tough to think about that right now. You know, it's really, I didn't post the clip yet on my YouTube, but hard to think about what to go long because the market could be lower between now and the end of 2023. I think the best thing to do is to wait for earnings season, which starts in 2 weeks, to see really what stocks and how they perform and what they say. Target already came out that they're closing stores. One is uptown in New York. They've had too much theft. I don't know why they're not doing anything about the theft, but it's a problem nationwide. And so you're going to have a lot of retailers that are going to say things prior to the earnings in the fall and during their earnings calls that are going to affect the stocks and, again, could make for some nice plays. So I'm not predicting XYZ is going to gap. I'm waiting for the gap. Then I see it. Then I rate it. And then I make the determination what I'm going to do, and I wait to the open. Okay, I'm never trading in the pre-market, and you can't trade options in the pre-market. But the nice thing about options is the SPYs and the Qs, you can do the daily options. If you wanted to day trade the options that I'm doing is the weeklies, you could get in and out in the day and pay less money because they have weekly expirations or daily expirations now for the SPY and the Q since the beginning of this year. But power looks like money. Big money. This was one of the biggest trades that I called in the last week, the Qs. So I'm going to show you a beginner risk and advanced risk for that, because I always get this thing. People say, I don't have enough money to risk this much money. If you have a trading account, you have enough money. You can do a beginner risk. You can make money with one contract in an option. So again, I think people often say that it's an excuse. I think people make excuses for the reasons for their own failure. Stop making excuses for your own failure. Stop making excuses for why you're not successful. Do it. Do it. Do what you need to do to be successful. You want to get in shape? Go on a diet. Start exercising. You want to make money trading? Sign up for a class like mine and do it. As much money as you have in your trading account, that's what you can risk, and that's that. Stop making excuses for yourself. I can't even believe that it is almost the holidays. I'm already getting all these emails, Pottery Bar and everything, all the places I like to shop. Holiday, Christmas. I'm like, wait a minute. It's Christmas? It's Monday was September 25th. Christmas is less than 3 months away. Time keeps ticking. Time keeps going. If you have goals and things you want to do for yourself, do not wait. Stop making excuses for yourself. Everybody does it. It's one of these things where you just have to pull up your bootstraps and say, I'm going to do it. I'm going to be successful. And between now and the end of the year, the holidays, I'm going to be at a completely different place in my trading, a completely different place with my finances. I'm going to be where I need to be. Because again, interest rates are going up. I looked it up the other day, 8.05%, 30-year fixed mortgage, 700 FICO. So if you have 700 FICO, you're going to pay almost 3 times what your interest rates were 2 years ago. That's how much it's gone up if you want to buy a house. That's crazy. That's completely insane. There's nothing you can do about these things. This is the way of the world. So you can do something about your personal finances, and you can do something about your trading, and you can do something about your own life, because you're not going to change what happens with other things outside of yourself, whether it's credit card interest rates, again, whether it's high inflation, the cost of food, and oil's going up. Again, we were looking at that as a long, talk about longs the other day. So things constantly are in flux outside of your control, but your trading is within inside of your control. It is. So let's talk about the QQQs. We did the 370 call. This was a good call because we were early on it. I called this on Monday, 3 o'clock in the afternoon. I don't really usually call trades that late, but I saw where we were going for the week. I called the 370 Qs in the last week here. Was that the 8th? No, yeah, the 18th was here. So here. So this was Monday. It was a week and a half ago. Today's what, Thursday? So this was last Monday. Closed here, gapped down, rallied, fell off a cliff, boom. So this was a really big trade because we did it here, did it basically at the strike, see the 370s, and see where it went. I don't have Friday's day in here, but we kept going on Friday. So the cost of this was $2.60. 35 contracts is a higher risk. It's an advanced risk. You can risk more. Sold at $11.50. It went further on Friday, by the way. Profit was $31,150 in this trade that you would have done on Monday, exited Thursday, a 342% return on investment. Now, a beginner risk would have been what? I'm using $1,000, $1,040. You could have got 4 contracts. You could have done one. You could have made $35.60, risking $1,000 on a trade that you would have done on Monday and exited Thursday. So I don't want to hear people say, oh, I need all this money. No, you don't. This trade was just a trade you would have done, and you would have let it go to its natural conclusion. You could have been in this the last day, and we were down farther on the 22nd, which was Friday. However, I exited on Thursday. I don't always think it's a good idea to hold things into the last day. There's occasions where I will, where I'm so far through the strike that I might, or if I'm down, I could be completely down in the trade and hold it to the expiration. But I don't really think that's in general a good idea to always hold until the very last day. Let me go back and ask a question here. Your risk tolerance is $30 per options trades. Okay, I have a bunch of different questions. You could have done one contract. Monica's asking here, you could have done one contract, which would have been cost $260. So that would have been within your risk of $350. The options trades are sent in a newsletter. See the timestamp. So you get the trade live to your email. I do have targets on the letter. I don't have that in here. That's for members. But I have targets in the letter. They're chart targets. Or you can, if you can't watch the trade, like some people are working, well, then you're just going to have to put a sell order at 50% or 100% or something if you can't watch it. But I do put chart targets, again, going here to the chart, because I'm watching stuff, and there are other people that are with me that are watching. The day trade, my live room, like today where I called the Mew, I called the exact entry, the exact stop, and the exact exit that you could have done with me. Mew was a day trade though. So my live trading room is day trades. This options I'm doing differently because I don't have an options room. I have an options newsletter. The person that was saying they're risking $30 per trade, I think you should be trading on a demo. That's my professional advice. I think the person's name was Sai. I'm not sure if I'm pronouncing it correctly. If you can't risk at least $100 a trade, I think just save your money. Move on a demo and practice on a demo until you can afford to take a class, open a trading account with at least $2,000, which is the minimum for an options account. If you're only risking $30 a trade, you really can't afford to lose at all. And you're not going to be able to do, like, I don't know what you're doing with that even. You can't even buy one contract if the market costs $1. And that's cheap for an option in the Qs or the SPY. And these are really, I mean, look at the price of the market. The SPY is over $400. These are cheap comparatively. Again, I'm doing some margin trades in the Qs and the SPY, but the cost of these options per the cost of what the market's trading at is cheap. Because if you went to go long in your IRA right now and you had to go long the Qs and pay what it costs, it's a lot of money. Okay. For the person that said they're risking $30, I would hold your money, save your pennies, learn how to trade, save your money to open up a larger account till you get up to 2,000 and can risk at least $100, $150 per trade. And then I would trade in a demo and practice. You can still get the feel of it. You can still do the charts. You need to have more money. What my statement earlier was not towards you. My statement is for people that are actively trading that are risking at least $1,000 a day or $500 a day and are trading every day. And they're trading and losing and winning and losing and losing and losing and losing. And they just make excuses about doing it. And it's just like, you don't understand how many people I talk to. Again, I'm on national television. I come to the webinars like here with Rob. I have a YouTube channel. I speak to so many people. And I've had the business now for a long time too, 11 years. I can read people very easily what's going on in their heads. And if you have an individual situation, email me. I will tell you my honest opinion. You may or may not like it. You have plenty of time to work and save money to open a trading account properly. Trading is not something that everyone should be doing if they don't have enough money to open an account. That's a different story. And one of the problems is, and I'll say this right now, there are places out there that are allowing people to trade and open accounts with next to no money, and they lose it and they blow up their accounts, and that's just doing a disservice to the customer, in my opinion. It's kind of like the way they used to charge fees. Now, fees have gone away for the most part. You know, brokerage fees since Ameritrade, Schwab's, Consolidated, this is going on for the last couple of years. But anyways, I mean, they used to rate people with fees back in the day, where people would actually, like, I remember when I first started, I don't want to get too off target, I would like be down for the day, come back for the day, have a fabulous day, like be down, come back, or I would like be down, come back, make money, and then I would end up getting up the next day and my fees ate into my profits, or I was down then even being breaking with my fees, because I used to pay fees on my trades, all the ECNs, the broker fees was ridiculous. Of course, that's all gone away now, you know, so times have changed. It's cheap to trade, but you gotta have money to risk. And I think $2,000 is a minimum, in my opinion. Okay, so let's get back to this here. I know we start a little late, but I gotta watch my time. Institutional money is always in charge. So you gotta be aware of it, and you have to pay attention to it, and you can't trade against it, and you have to learn how to find it. So I'm capturing the institutional money that happens in the market. Again, we got the market lower in the last month, really. And actually, if you look back in August, with the exception of the last week of August, August was a month for the market to sell off as well. So a big flow of money going in a certain direction is what moves the market stocks, creates momentum, and sets the trend in charts. When you're looking for institutional money, you're really reading the side of the power in a stock. You want to be on the side of the power in order for you to make money trading. Institutional money is in charge of the market and stocks at all times. Even if you think it isn't, it is. This is another trade that we did. This was Oracle. This was the middle of the month. Oracle closed here, gap down. Oracle had earnings. We did a put. Again, you could have bought the put, got in, got out. Volume is down here. Again, this is buying options. Okay, a put is a short. It's a cheaper way to take the trade rather than trade this on margin. Because in order to do a day trade, you would need a margin account. Now that means you need 25,000 or more to retail broker in the US, or you can open up a prop account with probably about $5 grand someplace. They're going to give you 10-to-1 margin. A retail place, you're going to get 4-to-1 margin. Or you open up an options account, and then you can take a trade and buy a put. Okay. So again, it's a cheaper way to do it when this is kind of expensive. For people, again, if you want to do 2,000 shares of this, if it's over $110. Let me see some questions here. $260 is a lot. That's more than 25% of your trading account. How is that sustainable? I thought you said you were risking $350. I thought you said you were risking $350. Maybe I read that wrong, Monica. So I don't know if you read that, if I read that wrong or not. What's the logic for the put? That's where I'm doing the rating. I get up in the morning and I rate the gap. If this gap rates 20 points or more, I know it's going to drop. Therefore, I short it. How I short it is up to me. I can buy a put, which I did. I could short as a day trade. You could do both. Again, depends on the type of account you have, what you can do. If you have a small account, I would do the options. How do I differentiate if it reverses or not? By the rating. The rating system. The rating system tells me if it's under 20 points, I'm not going to go long it, but I'm also not going to short it. So the rating system tells me, and again, it's a system you can learn that's applicable, that you can learn and do yourself. And that's what you learn from me in the class. It's not like when you watch on TV, we're talking about me on TV, when you watch Kramer, you know, Kramer says, oh, I like this, I like that, do. Kramer is not going to tell you, like, you can't learn from Kramer why he likes XYZ stock so that you can do it yourself and come up with the same conclusion as Kramer Monday, Tuesday, Wednesday, Thursday, for Friday. So that's the difference. So you come, you learn my system, you can do it yourself. And I do it myself. And then I just call the trade. What do you mean a higher price? Sometimes I do at the money, sometimes I do below the money in a put, so I know what you mean by higher price. Let's see if there's something else. For the person who's asking about 25% of your trading account, listen, if someone has 10 grand in an account and they're gonna risk $2,500 in a trade, I think that's too much. If someone has 100 grand in an account and they're going to risk $25,000 in a trade, that's crazy to me. If you only have $1,000 in a trading account, which is what I think you're saying, whoever said that, and $250 is 25% of your account, you know, I still think you should cut it back to risk 100, 150. But if you want to do one trade and be in one trade at a time for $250, that would be the max. That would be the max. And again, if you know what you're doing, you can still make money and do well. But I was saying earlier, $2,000, which is a minimum to open up an options account, is what I think is normal. Listen, I am here to talk to you about what I do. I am here to tell you a little bit about myself and what I do. If you're trading, you need an education. If you don't want to pay for it, you're going to keep losing. Period. End of story. Whether you sign up for my class or somebody else's today of all the speakers that Rob's having, you will not make it and you will not make money if you don't learn what to do. Now, you got two choices. You either pay someone like me or you go figure out your own system, which is exactly what I did. I actually did both. I paid someone for a class. I paid them more money than I charged for mine, and that was 15 years ago. And I did not learn from that person how to make money in the market. I didn't hate that person. I learned a basic information about technical analysis, which I took to devise my own system, but it took me 3 years and it took me a lot of money, and very few people could spend the time or money to do what I did. You can try to create your own system. It will take you a long time. And the markets are different now than they were when I started 15 years ago. Very, very different. Okay, someone was talking about algorithms. That's not the reason the markets are different, although there are more machines in the market now than there were 15 years ago. It's just different. There's more participants in the market. Again, I just got done telling you trading is free. It's basically free. Before, you needed XYZ amount of money and you had to pay, you know, commissions. For the people that are saying that they have $1,000 in account, you wouldn't be able to trade 15 years ago because they would charge you $200 for your platform, you know, and 5 cents a share. I mean, it's just it would be unaffordable. It's an open market now. I just told you also they have daily option expirations. That is added volume into the market too. So it's a free for all for anybody that wants to trade, but you still need to know what to do. And you need to know what to do now more than ever. Now more than ever, because of the fact there's so many people in the market. So again, you know, it's getting real with yourself and grounded about where you are is, I don't want to do a disservice to people. You know, people need to understand the reality, which is that you need an education and you also need money to trade. And my statement earlier was that there's so many people that come to these lectures, you know, that I've been doing now for years, that really, I had a man I talked to on the phone a couple weeks ago. He's been following me for 8 years. 8 years. 8. I'm just like, he hasn't done the class yet. I don't know what he's waiting for. He probably will never do my class. I will retire before he does my class because I will not be doing this forever. So, I mean, it's just sort of like, you know, it's one of these things where everybody's in a different financial situation. I get it. But if you're holding yourself back from being successful and you have the money to trade and you're actively trading and you're just scared, you got no excuses as far as I'm concerned. Let me see the questions here. In simple terms, there's nothing in simple terms. What is my recommendation? You mean going long or going short? Or what do you mean? I told you I prefer to short. That's what we're talking about today. All right, let's get back to the lecture here. Good discussion there today. Good discussion. It's reality check for some people. And again, we're talking in generalities here about trading, but if you feel like you need more money to trade, then do something about it. I don't know, go out and get a second job, go out and get a part-time job, go out and do whatever you need to do. You know, I've done those things at different points of my life. You know, everybody has to do what they have to do. And that is exactly what probably people are going to have to do if in fact we do go into recession in 2024, which if nothing changes, if the Fed stays on course, we're probably going to go into recession. I think we're in a mild recession now. I was on Fox and Charles Payne pointed the question at me live on air on Labor Day, and I said, I thought about it afterwards. And the next time I'm on Fox, I'll say, I think we're in a mild recession. And I think we could go into a full-blown recession and a deeper recession in 2024 if nothing changes. So if the Fed reverses course, we won't. If somebody different wins, if Biden doesn't win re-election, we could switch gears. But even that is a year and a half away. You know, otherwise that's probably where we're headed. So anyways, we did square. Square closed here, gap down, rallied, dropped. Okay. So we had a big sell-off here in the square. Again, that was a gap down. So remember, institutional money is in charge all the time. What do I focus on? Gaps. This was the biggest trade that we did last week. It was the SPY. This was another option. I did this really early. I was in this Friday, the Friday before the big sell-off, which was the 15th. I call this around 11:04, 442. The SPY fell pretty good here. So this closed here, gap down, did the 442s. It was an insane trade. Actually, here was the 22nd. So you see, you could have even been in this even the last day. I got out of it. But anyways, it cost $1.25. So in this case, someone was asking the lady with the $1,000, you could have bought one contract for $125. This was a ridiculous trade. $61,250 with a risk of $87.50, a 700% return on investment. Why? Because I got the move. I got in early. I called the direction right. We got the momentum. Selling happened in the market. Okay. 10 contracts with a risk of $12.50, you would have made $87.50. If for someone who has, for example, $5,000 in their account, you know, or more, 10 grand, you could have taken this and look, you could have almost doubled your account. So these trades happen, trading with me. We also did the 440s. I did this on Monday. I called this before the market opened, and that was Monday here. First it rallied, then it dropped, then it reversed in the Fed announcement, then it fell off a cliff, then we fell down. This was 471% return investment. Again, cost $1.40 for one. That is cheap. Do one, do two. I'm trading with a lot of risk here. 39,600 with 60 contracts, but here's the risk. Again, I'm using an average of 1,000. You could have made almost $6,000, risking $12.60, and that's a phenomenal trade. These are trades that are based on institutional money moves and momentum. They spot the power of money. Again, I'm not predicting the gap. I'm playing it, and we're getting the direction right, and then we're getting a big move. But it's the rating system that tells me how to do it. It's the checklist that tells me what to look for. This is what you will learn from me if you take my class, which is a paid class, okay? But there is one thing and one thing only that can move the direction of a stock. It's money. Not a little bit of money, but a lot of money, or what I call power money. Power money is in charge. Power money is in charge of the stock's direction. Trends are set and moved by the power money people, of which there's a lot of in the market. And again, the nice thing about gaps is they happen almost every single day. They happen on a regular basis. You cannot take every gap in the opposite direction of the gap, and there are people that do that. And they lose, for every trade that they win, they lose in 10 more that they don't. If it was that easy to just look at something like that or just buy support or short resistance, no one would ever lose. And it's not. And that's why I said it's tricky. And if you've been trading the last year, you know that. Here was the Oracle trade I talked about, 919. We did this. This was earnings. We did the 112s. This was an easy one because it went bing, bam, boom the same day. It was a nice short. Lots of volume, good trade, 150% return on investment. This cost 90 cents. Here, this would have been one, could have risked 90 bucks. It's, you know, anyways, this was a good one. So we're not doing, the most expensive options we're doing are NVIDIA. and that will you be priced out of. But think intellectually about what you're doing. I mean, it makes sense. You're like, okay, yeah, momentum, I get it. Selling, I get it. Shorting, I get it. Here's a picture of the market. This is back from, I don't have the last 2 weeks. If you looked at this, you said, oh my God, we're higher, we're going to make new highs. Woo! If you look at the summer, and then all of a sudden here, now you're like, oh crap. See, it's totally different. But we were already short. So, you know, this is the genius in coming and learning how to understand and read price action. It's price action in the gap, but this is what you're going to learn from me in the class. It is a class. It's an online class. The subscription service, you can sign up for the option subscription service. You do not need to do the class. I have a 6-month subscription, a 12-month subscription. It's on the website. The options newsletter, if you want to sign up for that, you get those to your emails. You don't have to do a class. If you want to do the class, you do the class. The only way to get in the live trading room is if you do the class. But I do have an options newsletter, yes. Right-wing hack because I said we're in a mild recession. Well, I guess we can disagree. We can disagree. That comment though just goes to show you how negative people are about politics and the economy right now. Because I think you'd be hard pressed even, and again, I live in Manhattan, I live in New York, which is very progressive. You'd be hard pressed to find anybody in this city that wouldn't agree with me that we're in a very high inflation rate environment, and there's a lot of pressure on people right now in businesses, even in a city like New York, which is probably one of the most Democrat cities in the country. So, you know, we live in times right now, again, sometimes they come out, the consumer confidence data says, everything's fine, everything's great, and the market sells off. You say, well, wait a minute. But as a consumer, you know that not everything's great. You know that if you go out and shop, and I'm a person that I shop for myself, I buy food, and I buy other things too. So I see what the prices of things are. So, you know, it's one of these things where you kind of have to look at things in reality, whether you like it or whether you don't like it. You can make money on things, and if you're so much in a closed box about your opinions about things, you will miss out on an opportunity to get a bearish move in the market, to get a sell-off in the market, if you're so ingrained that you think that things are going well, everything's great, the market's going to rally, it's going to make new highs, and you can't get off of that bias. So when you're trading, you need to look at actually what's happening each and every single solitary day in the gap and read it. You may or may not agree with it, but if you want to make money, then you have to look honestly at what's happening and make decisions based on that. Anyways, my class is called The Golden Gap. Of course, it's a 26-point rating system. It pinpoints the direction of power money by reading price. And again, that's extremely, extremely important because that's how I'm going to make the decisions in the morning. I'm looking at the pre-market data. I'm looking at the post-market data. And you need conviction to make money. Having a system gives you conviction, and you need an edge. For me, the edge is not just the fast trades, but it's also shorting. Shorting gives me an edge. Most retail traders, most traders want to go long, okay? And I think the whole thing is that once you get out of this, you know, buy the dip kind of mentality, you're going to see things a whole lot different. While that worked in 2021 and the market was extremely, extremely, extremely bullish, you could have bought strong stocks, you could have bought weak stocks, you could have made money going long the market, going long virtually anything in 2021 because the market power trended. That did not work in 2022, and it actually didn't work in 2023. So I drew this. This is a really crude pie chart here, but I drew this. You look at the amount of time you spend preparing to trade versus actually trading. Okay, so this is the time I spend prepping to trade and the time I spend trading. So I spend a lot of time in the morning preparing, looking at my charts, doing the rating system, getting ready, trying to decide what to trade, and then I trade. A lot of people are not even making decisions what they're trading till 10 o'clock or later. I think I have a few minutes here. We're going to quickly go over last week's trades. These are the day trades. Again, we went over some options. These are the day trades. 918. We shorted NVIDIA. It lost. I just want to go over this here. 918. NVIDIA closed here, gap down. We shorted it, got stopped. I did 2 trades in NVIDIA, got stopped here. 918. And then we did a SPY trade on 9/18 that worked, shorted this tail. So lost on Monday. Then on, we did a little Qs into the close here in that tail. That was the 18th. Then on the 19th, we shorted the market. We shorted the SPY. Again, I've been in puts, but we also did this as a day trade here. Market close here, gap down, fell. Okay, so I shorted the SPY. Then on the 19th, we did a little trade in the square. We talked about that. 920 no trades. 921 did the SPY, which was here, closed here, gap down. This was a day after the Fed announcement. And then 922, there were no trades. So that was 1 week of totals for the day trades. And again, I do options too. But I like the day trades because we're in and out of the trades quick. So if you're looking for a high winning strategy, good money management, and a mentor to follow, I teach my class once a month. The class is about gaps. You're going to learn how to find, pick, and play professional bearish gaps. And the fact is that when you trade, you can trade from home. If you are not making money trading, then I think you need to step back and think about what you're doing, maybe take a break, maybe change what you're doing. You don't want to lose money. I think the fall is going to be tricky for a lot of people. Again, I'm not making any predictions now. I'm not saying we rally. I'm not saying we drop. I'm saying that I think it's going to be tricky and you have to be focused. And I think that's extremely, extremely important. But when you trade, you need to have 100% conviction that what you're doing is a right choice, because if you don't, you could lose money. You need to know that. And that's why some of the people were mentioning their account balances. I would wait. I would save money. You can practice on a demo. You can still read charts. You'll still learn something. So empower yourself to trade the market. If you're interested in my class, the class is this weekend. I know this is last minute, but I already had it planned. I already have people signed up. The Golden Gap course teaches a 26-point rating system to find the best stock to trade each day. The course also teaches you how to enter and exit the stock on the day. The course teaches price analysis and technical analysis on an advanced level. It's a full 2-day course on how to strategically find, pick, and play stocks that are professional bearish gaps. Class is online. You can be anywhere in the world and take it. You must take the class in order to join the live room. Someone's asking about the subscription service. The options newsletter is a subscription service for 6 months and 12 months. So 12 months is $69.99 and the 6-month subscription is $49.99. I do not have trials for the newsletter or any shorter time period than 6 months, but it is a good time to trade options with me because earnings season starts in a couple of weeks. The special I'm doing for this class ends tomorrow. The class is September 30th and October 1st. The class tuition is $69.99. Class is 9 to 5 Eastern time. I live in New York, as I said. If you sign up by tomorrow, which is the deadline, you will get the trading room and the options newsletter free through the end of this year, and the market report free through the end of this year. Again, class is $69.99 and everyone pays the same. If you're interested, you must email me forms to sign up. Let me see if I got all the questions. Let me just see. I think that's it. Rob,
I think you got them too. And if anyone would like to ask further questions, I did put Melissa's email in the chat box. Melissa, I can't tell you how impressed I am. It's not necessarily about the amount, because some people can't take a trade that big, but your percentage returns and ability to pick triple-digit winners, oh my God.
The reason, I appreciate your nice comments. I don't do anything else. If you did nothing else, anyone here, if you only focused on one thing for 15 years, of course you'd be good at it. I think with trading, people jump from thing to thing to thing. They jump from futures to options to equities to Forex. You're never going to really get good at something if you're jumping around too much. So one of the reasons for my success is I've been doing nothing but gaps since I started and shorting. So anybody can do it. It's like if you played a sport, you know, if my father's a golfer, he's a good golfer. You know, he's in his 70s. He's been golfing for a long time. The more you do something, the better you get. And traders err because they constantly jump around to the next big thing. And then they give up, quit, and do something else, and do something else, and do something else. Stick with something, do something, and find something that works.
Oh, you found your edge and exploit it. And we don't expect that your father's going to get on a football field.
No, he's not.
Your topic, make money shorting, very relevant. And I mean, we've seen the market falling before our very eyes. And we're it's what recently is going on. And your Golden Gaps course looks amazing. I want to thank you for making such a generous offer to our audience today. And it's always great to have you on Traders Corner. I know we had a little conversation before we officially started, but I'm absolutely impressed. Ladies and gentlemen, this is Melissa Armo of the Stock Swoosh. And if you're interested in learning a strategy that has the potential to garner fast and big profits, trading just 30 minutes a day, you can find our special offer in our chat box, and you can always find her at thestockswoosh.com. Thanks again so much, Melissa, for joining us today, and we hope you have a great weekend. Ladies and gentlemen, our staff at Traders Corner sifts through hundreds of pro traders and brings you the most credible and qualified traders to participate on our investor summits. And our next presenter is no exception. He began his career in 1980, conveniently the year I was born, and one of the original market makers in the pit at the Chicago Board of Options Exchange. He's traded all the major exchanges in Chicago and is currently a member of the CBOT. He's spent the last 8 years as a mentor and educator to traders of all levels, and he's developed a program for high school students that allows them to learn how to trade the financial markets. Ladies and gentlemen, it's my pleasure to introduce a seasoned pro who's always entertaining, never bashful, and rarely filtered, and I would like to call my friend. Here to present weekly options trading is Mr. Todd Bubba Horwitz of BubbaTrading.com. Welcome back to Traders Corner, Bubs.
What's up? What's up, everybody? What's up, Rob? How you doing, man?
Hey, brother, I'm good. How are you been?
I got my nuts knocked off yesterday with a set, flopped the set and got them knocked. But anyways, what's going on, everybody? It's great to be here and always a pleasure to be at Traders Corner, the corner of happy and healthy.
We love having you, sir.
So anyways, we'll rock and roll, and I know, what do I have, 12:45 or 1:40, whatever tell time is?
Technically it's 45, but previous presenter ran a few over. If you need to run a few over too, we don't.
I know he's Las Vegas, so I'll go until I run out of time, but that's all right. What's up, everybody? Great to be here, and thanks for being a part of this. And of course, today we're going to talk a little bit about options. And I know you just heard a lot about options. I use a little bit different of an approach. I think there's a lot of different ways to skin a cat, and I do trade all markets all the time, but I have done so for 45 years. So in the meantime, one of the things we talk about is set a trading goal so big that you can't achieve it until you grow into the trader who you can. And again, you have to be very careful when you're setting goals. You do not want to put yourself in a position to blow yourself out trying to achieve something that is unachievable, right? You want to make sure that you put yourself in a position so that you can celebrate the goal and move on to the next level of your trading, okay? Of course, there's always a disclaimer I have to give you, and it's past results, which I don't show a lot of results, but past results are not indicative of the future. What I'm really talking today about is education. If you really want to become good at trading, if you want to learn how to trade markets, that's what I'm going to do with you today and share with you today, and give you some ideas and some pointers. In the meantime, my name is Todd Horwitz, and I have been doing this for 44 years. This is all I've done for 44 years. And it's only the last, I guess, 12 or 13 I became an educator, because I went from a floor trader to a screen trader or a retail trader like everybody else here, okay? We are all retail traders now. And for those who are not aware, that high frequency trading that you hear them bitching about on TV all the time, it's amazing that they only think the markets go down on high frequency, when the truth of the matter is high frequency trading is nothing more than an electronic market maker making fractions of pennies on billions of transactions, unlike market makers, because of what they did with the high frequency is they replaced guys like me, okay? I was one of the original marketers in the SPX, and one thing I can tell you for sure is every trade that I recommend, I trade with you, okay? So we're not just giving recommendations, we're trading alongside or sharing what we do. And I do have a chat room where those trades go in as well, and where all my members hang out and chat together. The first thing you got to understand about trading, okay, is that I don't care how good you are, there are drawdowns, okay? You have drawdowns in your trading. You run into some bad luck. As I said earlier, I flopped a set and got beat for a big pot yesterday. It happens. You can't let that be part of it, okay? Which means that when you're trading, the size that you're trading has to be commensurate with the account size that you're dealing with, okay? You cannot be risking 30% of your account in every trade that you make. You've got to be risking under 10%, okay, and really under 5 is what your risk has to be. But drawdowns can also teach you an advantage to the market, because if you understand how you're trading and what you're trading, you can actually use these dips in your equity to add to your position, knowing that your probabilities are you're going to get the next hand much bigger. Okay, the next trade's going to be a winner, and that's something that we use, and I teach the very, very advanced traders how to use. But again, drawdowns can be an advantage as long as you're staying in consistency with the amount of money that you're trading. Now, what are options? Options are a derivative. There's a lot of derivatives in this world, and there's options on options, there's cash derivatives. Again, they're derived from something, and of course, options are a popular product because there's a lot less capital involved, there's a lot less margin involved if you're using them. I do trade futures as well, and again, they're a little bit higher cost or a little bit more margin money, but at the end of the day, it depends on what you're trying to accomplish. Okay, but understanding the derivatives market and understanding that there is no such thing as a cheap option. Okay, options are always fairly priced except when they are expensive. Okay, because I got news for you. On the other side of your trade, there is a market maker who's making that market. If you think they're going to sell you something cheap, you're wrong. Okay, that does not happen. That is not part of this business. Nobody gives away anything for free. Okay, they will overcharge you though, and that'll happen when the VIX index, if you've heard of the VIX, which is the volatility index, and it's not really the fear index, it's really the difference in when there's more activity in the market. Okay, when the markets are moving, okay, and there's a lot of volatility, that means that there's no more people selling their options to open. There are more buying options to open, either calls or puts. And that is what the volatility index is based off of orders to buy to open versus sell to open. That is what creates volatility. And since one of the most popular trades is to sell puts naked, when you stop selling the puts, all of a sudden the VIX starts to rise. Okay. So again, don't listen to the story that there are cheap options. There's no such thing as cheap options. Derivative products are a way to leverage your money. Now, again, leverage can be a very dangerous tool. Okay. If you're using too much, you end up going to the poorhouse. A number of years ago, guys came to me, some of my own members, begging me to get involved in this program. They were making nothing but money. And I said, I can see the strategy. It is a losing strategy, and you're all going to be broke. And I said, if you go there, I will have to relieve you of my membership because I cannot be involved in what you're doing. And sure enough, it was optionsellers.com, and the guys are still paying off the debt that was created from those products because they were so far over leveraged and selling naked options, which is not a way to make money in this business over the long haul, especially as a retail trader. Okay. The whole business starts out with a trading plan. Okay, and we talked about goals. Goals have to be reasonable, that are achievable, because you have to celebrate the victories, you have to celebrate the education, you have to determine your risk management. And that should be fairly simple. Okay, if you're a gambler, you'll understand you only risk some percentage of your bankroll on any one bet or any one trade. You can't keep firing all in all the time. Okay. You got to have a strategy. Now, there's a million strategies that you can use, okay? And in fact, in any given day, I might use 20 or 30 different strategies depending on what I'm doing, because I'm building my trading plan, and each thing that I do has a different plan. It is your entry, okay? What is your entry going to be, all right? How are you going to determine your entry? Well, I'll give you a quick note of what I do when I'm day trading, okay? And I day trade live with my members every morning. But at the end of the day, when we're trading, we're looking for a specific pattern, okay, using 4-minute charts, okay? And I have a trigger chart, which is 1-minute charts. So this is what I'm using every morning for an hour. We traded this morning and we happen to be 5 for 5. Okay, but again, that doesn't happen. Yesterday we had no trades. So again, but there has to be a trigger that I'm looking for that tells me where my entry is going to be. Okay, what is my analysis? How am I figuring it out? Well, in my day trading, I'm using a pattern that we call the blow-off pattern, and that is a pattern where price and time become irregardless, and people go bonkers. Okay, and they just chase the market one way or the other, and we're going to take the opposite side because there's an old floor trader saying, when you can see their tonsils, give them whatever they want. They're wrong. Okay, and of course, managing the trade. How am I going to get out? Okay, you got to have an exit plan. Okay, in the futures market, we use a numerical number to exit, but when you're trading in my options program, everything is built in. Those decisions are made for you ahead of time. We don't have to worry about that because we build a trade not only that can go unlimited profit potential, but can also has its own built-in stops that you never really get out of the market, just the amounts that you can change and how you can trade them, change it. Everything is predetermined each and every week. Okay. I think the sound, oh, did I lose something here? Hold on a second. I think the sound has been lost. Is that possible? Are you there, Rob?
You're all right, Bubs.
Okay, I'm reading on some of the things. Anyways, trading is hard. All right, listen, I don't care what anybody says. I've been doing this this is my 45th year coming in. Okay, I don't care what anybody tells you. Trading is hard. Okay, there's not a single profitable trader that will claim that trading is easy. Instead, he or she will probably say that trading is tough and competitive industry that requires constant work and you want to stay in the game. All right, listen to me. Again, 45 years of trading, I'm still learning. Okay, I'm still learning new trades, better ways to build the mousetrap. Okay, because A, you have to stay ahead of the curve, and B, it's a constant education. Now, it's not full time, but again, because derivatives can be created in so many different ways, I can get long or buy the market in 100 different ways, and I can sell the market in 100 different ways. And I don't care which side of the market it's going to. I'm going to go with the market, with the path of least resistance that gives me the greatest opportunity to make money. Okay. So again, when the aspects of trading, you need to know some of those are the quantity of misleading information out there. Okay. And again, there is so much misleading information out there about how easy it is, how much the news affects it. The last time I looked at the news was about 15 years ago, and I still do a lot of media. Okay, I've never read the Wall Street Journal, nor have I read a copy of Barron's, because again, at the end of the day, news is noise. Everything that you need to know is in this chart right here. Okay, whatever product you're looking at, this will give you all the answers you need to know. Okay, and in fact, I wrote yesterday and I wrote this morning, look for a big rally. Now I'm looking for a spot to sell, but in the meantime, I knew that the rally was about to come. I didn't know it would be today. I knew it was about to come. Okay, and that's recognizing what the markets are doing, which will then help you put your positions on that fit the market the best. Remember, forget the Holy Grail. There is no such thing. I don't care who promises you all that crap out there that they're going to make $1 billion tomorrow. If you think that you're going to come into a trade and start with 2, 3, 4, 5,000 and make 100,000 next year, you're out of your mind. You have no chance to make that kind of money. Okay, there's no way unless you just expose yourself, double up, and don't go broke and have a bad trade in between. Okay, there's a lot of basic strategies, and most of these are all garbage. Okay, covered call. I'm sure many of you know of the covered call. Okay. Can you tell me the website address and YouTube channel? My website address is bubbatrading.com. And I think it's the same for my YouTube channel as well. In fact, I do live events for Trader twice a week, every Tuesday and Thursday on YouTube. Anyways, covered calls, worst strategy ever. Okay, now 35 years ago, it wasn't the worst because again, as Melissa mentioned, the costs were so high, but now costs are free. I mean, my brokerage fees are $10 a month flat with my broker. Okay, $10 a month flat saves me $100,000 a year in commission. Okay, but covered calls are not a good strategy. You're better off doing a selling a call spread if you want to cover up and collect some premium. A married put, well, again, you're buying a put and buying the stock. Why would you want to do that? Okay. If you think the stock is going up, and if you're buying a put to cover up the stock, because you're probably too late. You're going to pay way too much premium. Bull call spreads, which are debit spreads. I don't trade debit spreads as a rule. Okay. If I'm going to get long, there's a lot better ways to get long in the market. Bear put spreads, I don't do those. Those are also debit spreads. Again, if I'm going to put a trade on, I want that trade to have unlimited profit potential. Okay. I don't want to restrict what I can make. Long straddles and strangles, you'll go broke buying premium like that. Long straddles and strangles. Because remember, if you buy a straddle, you need double the move to get even because you're paying for both sides, and both sides are equally priced. Iron condors, I don't trade them, except I use them in my hedging model as a form of premium collection. But there are many services out there that use these as a total trade, and you keep pressing up and you try to play the highest probability, and those all end up going broke. And in fact, I call it the condor shuffle when people come to me with these strategies, because they don't work. That's why they're out there, because they don't work. It's all about making decisions. Okay, it's all about analyzing a market. Okay, figuring out what you're seeing, what is the footprint, what is the map of the market. Okay, and then deciding how you want to attack that trade. Okay, and that should always be based on what is happening in the market. Is the volatility high? What trade am I going to make? Is volatility low? What trade am I going to make? Because each trade is different depending on what you're trying to accomplish and what your risk tolerance happens to be. Okay. Options trading may sound riskier, complex for beginners, and so they often stay away. Look, option trading is about as easy as it gets if you're willing to take the time to learn. Okay. Again, I teach part of this class, the part of what I'm doing today, and if you become a member, every Saturday for an hour and a half, I teach. Okay. Every day in the chat room, I teach a little bit. Okay. And the strategies are not complex. Okay. People like to make them complex because it makes it easier to make you have to spend more money to get with them. But at the end of the day, option trading for what we're going to do is very simple. We're buying and selling, and we're combining options together, and we can determine on any trade we ever make, we can determine the exact amount of risk. Profit we can never determine, because profit will always be unlimited. Okay. The psychology outside of this market, this is where most people will fail. Okay. If you've ever panicked in the market, if you've ever puked and thrown out stuff that you sold some positions that you had because the market was going dramatically against you, you're already wrong. Okay. When you understand that you are trading in a business that is competitive, okay, you cannot be fearful. Okay, you have to let the markets trade. If you get the urge to panic, your urge should not be to dump and get out. Your urge should be to take a deep breath, logically look at the market and say, there should be some sort of little bounce. So if I really want to sell, I can probably get out at some place better than here. Okay, greed, same thing. Hope is not a strategy. Complacency, overconfidence, overtrading, regret, despair. Look, at these things that go through everybody's mind. Okay, you have to get them away from your mind. You have to say, this is what I'm doing. This is how I trade. This is my risk. This is what I'm prepared to do. And keep yourself out of all these emotional cycles, because many people will actually cover, okay, a position at the max loss anyway. So what's the point? You realize in 1987, when I was trading on the floor during the crash, people were buying puts as if the market was going to go below zero. Think about that. Okay. This is why risk management is the most important thing. Again, in life comes down to two things. One that is common with everybody is money. Okay. If you ain't got it, you can't live. I don't care that they don't say money can't buy happiness, but it makes life a hell of a lot better when you got money to go along with it. Okay. You got to manage the risk. If you put yourself out of control, you are doomed to fail. okay? Because again, the more risk you put yourself at, the more that you put yourself in danger, okay? The more you're gonna make a bad decision. Different strategies, okay, that we use, and we talk about always be learning, okay? Again, ABCs or ABLs, always be learning is what I wanna say. It's very simple. Just always try to take something from a trade, especially a losing trade. You know, you're gonna have losing trades. Learn from it. What did you do wrong? Or did it just happen to be a bad break? You know, you're gonna get bad breaks. You know, life happens, right? That is part of it, right? But the strategy that I like to use, we use a lot of calendar spreads. We use a lot of weighted calendar spreads. Okay, and what is a calendar spread? It's selling a near-term option and buying an option out in the future. Okay, that trade by itself has a limited amount of risk, and it still has a potential unlimited amount of profit. Okay. But we like to use a lot of weighted double diagonals, a lot of weighted calendars. Why? Because again, the premium that we can sell in the short term is financing our trade by rolling each and every week. Okay, each and every week we roll trades forward. So if I start out a trade with, let's say, a $10 debit, okay, I've already calculated out what that debit, how many rolls I have to get that debit out, and I will not put on a trade that if everything stayed exactly the same, that I can't roll enough out of that trade to make a profit, okay? So we also have the opportunity to roll the extra option, okay? So if we have a 1x2 on, the 1x1 stays still, but the extra, the 2, we can roll one of those up or down, okay, to capture more profit, to reduce our debit, and to lock in more profit. Okay, so that's where we take our business and we continue to move in to lock in more profit. But our first objective is to what? Continue to reduce the debit on a daily basis or a weekly basis. Okay, now we trade, like the SPYs are dailies now, so we actually are using those dailies, but we're trying to reduce the debit, get back to a point of break even, so then it's all profit, okay? And this week with this big move and with our expectations, we pitched off and not only rolled down, but sold off a lot of our extra put options, assuming that there would be a rally, also assuming and knowing that we were going to continue to be able to roll forward. And here's a trade that is live right now, okay, in Google, okay? We put this on a couple weeks ago, but it goes through October 20th, okay? But here, the Google puts, we've sold one down, and our total debit in this trade left is $1.98, okay? And I know that I can collect more than $1.98 in the next 3 weeks, okay? I already know that, okay? Here's another trade that we have on right now, which is Twilio, okay? Which the debit is now down to 96 cents. I know that I'm collecting over $1 a week. So I know based on whatever it is right now, I'm going to make a couple $100 for every one contract I put on. This trade has a limited risk the minute I put it on, okay? And if I did nothing, okay, the risk is maximum is 696, okay? And I know that that's virtually impossible. That's just a mathematical number, because if the stock sits, the premium is going to collapse, okay? If the stock runs big one way or the other, I'm going to be able to pitch off part of one side or part of the other. So I cannot, that risk, although I'm giving it to you, is actually nowhere near there. It has to be less, okay? And it's something that we look at, because as we continue to roll these positions down, okay, and we trade these positions, this is what they look like. And I send these out every day on an update. Every morning, I send you an update, and right now we have currently about 15 positions open, okay? And here's kind of what they look like, all right? Here's what I do every Saturday when I go through the call. I give you and show you where we stand on all these trades, okay? This is a spreadsheet that I do. I don't give overall results. I give you results weekly, okay? And I don't lose members. I've got people that have been members of mine since the day I started, because we teach it, we work it, we give you the best education you can get, and of course, here's more of the same, right? These are all, some are big profits, some are little profits, and of course, what you'll learn is the bad things in these markets are, and some of our positions where we have losers, as you can see here, is a market ran too fast, somewhere in the middle, and it killed part of our premium collection, and it didn't give us enough collection on the extra option. Hey, it's going to happen. Okay, I can't worry about that. I gotta be prepared to move on to the next trade. Okay, it's always the next trade. That's what we're looking at, because you can trade in any market. You know, there's options in stocks, there's options in futures. Okay, so there's many different choices that you can use. Okay, I prefer, if you're new, to stick to the equity markets, but again, if you're more experienced, you can trade anywhere you want. Now, we talk about the distribution curve. Why? Well, in this case, I'm using it to tell you that whether you become a member or not, if you're an options trader, the best options to trade are the at-the-money options. Okay, the deep in the monies as a surrogate for the stock are no good, because you give up the biggest edge of what options are. Does anybody know what the biggest edge in options are? Anybody? Okay. It is volatility. Okay. It is, if you're trading a 50 delta option, which is the at-the-money option, okay, you get the biggest edge at the money. Okay. You get the biggest percentage of gain at the money. Those of you who are buying way out of the money options, you're a loser. You can't make money buying out of the money options. I assure you that over time you will find out that you'll be busted. And I know we used to all get stock tips, and we ought to go out and buy those farther out in the money options, and they'd all just expire worthless. And I can show you thousands and thousands of trades of garbage like that just don't work. You have to trade at the money where the liquidity is. That is what it comes down to. It's about liquidity. This business is about liquidity. And if you take yourself out of that liquidity, you're making a big mistake. Okay. Many like to talk about these risk graphs, right? Well, look. They're horseshit, okay? Because if you're using cross time periods, then a risk graph can't calculate that, okay? It doesn't understand, and this is one of the things you have to understand, is that if you cannot figure out, okay, what your risk is on any given trade, okay, and if you can't figure out the factors and you haven't learned enough, then you shouldn't be trading, okay? Now, I had to do this stuff, and granted, I mean, I have a little bit more experience than most, but I had to do this live on the floor within seconds, okay, to make a decision. I didn't have all these tools, nor did we have the time to use them, but these are not worth it. I'm telling you, you'll learn much better and make way more if you learn to do it yourself and figure it out, because a lot of things that you think you can do cannot be done on a computer anyways. What trading strategies I use? Buy calls or puts? I never just buy calls or puts, with one exception. And sometimes I'll make trades at 10 minutes to the bell, okay, and trade some 6 or 7 or 8 or 10 cent options, okay. Sell calls or puts, never naked. I will use them in an overall position. Buy debit spreads, never, okay, with the exception of a combination of selling credit and buying debit. And sell credit spreads often, okay? But every trade that we look at here, every trade that we have here is a trade that has unlimited potential profit, okay, with an exact amount of risk. A naked option, if you sell naked options, you're foolish. And I don't care if you tell me you're selling puts because you don't mind owning the stock. That's fine, okay? But why would you sell a naked put on, let's say, Apple, $170 stock, and put up $17,000 margin, okay, when you can sell the 170, 150 put spread for about the same credit as selling the naked put, but instead of putting up 17,000, you're putting up 2,000. Okay, you tell me, especially with margin rates at 9.5%. Okay, again, it's a way that you must be prepared to trade, and you must take the ownership and understand that when you're selling naked, you're either giving away too much money in interest or you're taking too much risk. When you can create the same trade for a hell of a lot less risk, okay, and a lot less cost, okay. Formal education will make you a living. Self-education education will make you a fortune, okay. Now again, I am a self-educated guy. And again, I'm telling you that all the stuff you're going to hear from me, from anybody after me, before me, tomorrow, next time, know that if you don't take the time to understand and learn it yourself, you're making a huge mistake. Okay. Again, whether it's with me or not, I don't care. I want happy members. We have a good time. We're going to Vegas in December. Every year I do a big webinar, big seminar in Vegas. Look, I want people that are happy. I want you to learn. I want you to make money. Okay. I'm not interested in anything else. Okay. And education will help you. Again, whether it was with me or anybody, to me, it doesn't matter. I want you to be comfortable wherever you end up going. Okay. That's what it's about for me. Okay. I do this because I enjoy it and because I can teach it and I'm a good coach. But I don't need to do this. I can just trade by myself all day too. Okay. In the meantime, what now? Well, what now is, do you want to become a member? That's the what now. Okay. If you want to come and become a member with me, okay, you get a weekly training webinar, you get daily updates, you get a Monday night live call, you get to learn how to use the options properly. For the first 50 people, either a monthly or annual, BubbaTrading.com/options or BubbaTrading.com/opt-year. Okay. And because you're such a great audience, anybody who signs up today, I will give you 30 days to trade with me. Okay. At no cost. Okay. You can trade live with me every morning. I trade every morning at 9 to 10 Eastern time every morning. Okay. You can come and trade with me as my guest for 30 days. Okay. And any of you joins today, I will give you the 2 books I've written. This one's sold out on Amazon. I will give you 2 books I've written on PDF files if you become a member today. And again, that's BubbaTrading.com/options or opt-year. And if you have any questions, I know I went a little fast, but I wanted to make sure that Rob was on time because that's the kind of guy I am. But in the meantime, remember, it's all about the market footprint. Okay. The bounce in the NASDAQ was not shocking. Okay. It should probably fail from right about here, would be my guess. I don't think there's a lot more room to go here today. I think the S&P, which had broken down, and it's got a chance to get to about 4380. Okay. And this applies to everything, because if you remember one thing, remember this: all charts are the same, all patterns repeat themselves, and the shortest time frame is the decision time frame that tells you direction. The market cannot trend lower and still starts trending lower in a 1 minute, 5 minute, 10 minute, 20 minute chart. So the daily cannot start to go down until the shorter time frame start to go down first. Okay. So I hope I answered all your questions. I hope that you did good. I got you way back on schedule here, kid.
Oh, Bubs, you're always ahead of time. No BS, no nothing. You tell it like it is. And I got to tell you, you gave me the copy of your 2 PDF books, and anybody that signs up, ladies and gentlemen, these books are absolutely worthwhile. I mean, I'm a veteran trader myself, and going through them, I picked up some, call it golden eggs or tidbits and stuff too, that have helped improve me. But well,
you just gotta be prepared, and you gotta keep your mind and your emotion out. It has to be more, trading is more robotic anyways. I mean, it's a decision process. Like I said, whatever you guys decide to do, whether it's with me or anywhere else, just make sure that you know what you're doing, you know what you're trying to get done, and for God's sakes, know what your risk is. Okay, that is the biggest thing, and I've seen more people bust out not knowing what the risk is. I didn't know that. Well, I'm telling you to make sure you understand it and know before.
Oh, and absolutely, and I'm in a lot of Facebook groups and stuff too, where they ask what the biggest advice you'll give is, and I say limit your risk. If you take that big loss, it takes twice as big of a gain to get it back, and it's detrimental to keeping someone's account balance high enough for them to be profitable.
So, my friend, I appreciate you having me back as always. I know I was a little quick, but listen, that's just me. No nonsense, right? Tell it like it is.
Rarely filtered, always entertaining. I gotta say, I enjoy your presentations as much as anybody's, if not the most. But great information. I really love trading options myself. My option today was the SPY 429 0 day, and I had a great day. But your service is perfect for all investors, including those with limited experience, time, or funds. Thank you for making our members such a generous offer today. And I have to mention your program for high school students, man. That was something worthwhile and very altruistic. Be proud of it.
I love it, and I love teaching kids because that's where we started at. And if we can change the financial views in this country, we'll be in a hell of a lot better shape.
No, absolutely. I'd tell you something else too, but I don't think I could do so on air. But you might get an email from me following this. Ladies and gentlemen, Mr. Todd Bubba Horwitz, and you can learn more by clicking on the link in the chat box or going to bubbatrading.com. I did type out both links correctly in the chat box. Bubba's truly a great guy, has over 40 years experience. Bub, I hope you come back and see us soon. I love having you on the show. Have
Thanks,
a great
man.
weekend, sir.
I look for you in Vegas, baby.
I'm going to end up there probably next year. I got Florida next.
You keep threatening me. I'm waiting for you.
Hey, it's not a threat. It's a good time.
All right, brother. Thanks,
well.
guys.
That will bring us to our next presenter, who's been an active trader for over 15 years and focuses on equities, commodity futures, currencies, and options, focusing on analysis and trading using price action, institutional levels, historic data to put the odds in his favor. He began working on a global trading desk at the Chicago Board of Trade as well, right out of college, executing trades and large block order flow for hedge funds, banks, institutional investors, commodity trading advisors, and high net worth individuals. He holds or has held a Series 7, 3, 7, 30, 34, 65, and 66 securities and futures licenses. Here to present Price Action is King. How I cracked the code to more profits with a simple 3-step strategy is Mr. Silas Peters of TradesTrending.com. Welcome back to Traders Corner, Silas. Are you not in front of your PC yet because we're 2 minutes early?
Hey, I just tuned in. I'm sorry about that.
Hey, don't be sorry. You're actually right on time. Bubba usually finishes a minute early and has yielded his extra time to you.
Okay, awesome. I'm just getting my slides together here in 1 moment.
No big deal. Take your time. Did you take any trades this morning? I know I'm up big on SPY calls.
Yes, we took NASDAQ long, and we took a small short in the bonds.
Nice.
So,
well, congratulations on 2 profitable trades from what I can tell by the price action.
Absolutely. We just finished up our member session and where we went over all that in detail. Can you guys see my screen now?
Just came up. I got your splash screen, brother.
All right, awesome. Let me pull up the questions and we'll get started. So, are we ready to go?
Take it away.
All right. Well, thank you so much for having me back on the show. And we're going to get kicked off here about a minute or so early. And I do want to say thanks to the Traders Corner team for having me back on. Always a great crowd. Lots of eager, hungry traders looking to step up their trading to the next level. So do me a favor in the chat. Can you let me know just if you can hear me and see my screen? I want to make sure I'm not talking to a black wall. And if that's the case, we're going to go ahead and get rolling. All right, perfect. Okay, so give me 1 second here. Let me get my deck in line. All right, so my name is Silas Peters, and I'm the founder head trader of Trades Trending, and I'm very excited to be sharing this unique strategy with you today. It is what I call my 15-minute trading blueprint, and I've been using it for almost the last 20 years or so. Absolutely crushes it, and the best thing is its simplicity. It's truly a mechanical, stress-free, emotion-free trading method that can be applied literally on any market or time frame. So let's get right to it. Let's quickly take a quick moment to read all of this from our friends from the regulatory governing bodies. We know past performance is not necessarily indicative of future results. There is substantial risk of loss associated with trading securities and options. Only risk capital should be used to trade. So now that you understand that, let's get right to the good stuff. Now, let me ask you, what do you trade? I want to get a feel for who's in the room here. Do you trade stocks, options, futures, Forex, maybe even crypto? What do you trade? What markets do you trade? So I trade these actively stocks, options, futures, and Forex. I'm more involved in the futures and options market, but it does not matter what asset class you trade or what you're looking to trade. What I'm going to share with you works in simply anything that can be plotted onto your chart. So I see a lot of options, stocks, futures, and FX, futures, not trading yet. And you'll be very surprised about how simple this strategy is and how it can literally be used on anything. And so what I'm going to share with you today is highly accurate, works in all markets, all time frames, 99% mechanical, and most importantly, it is simple and it can be used for small accounts. I've used this strategy with $2,000 accounts, $20,000, even $100,000 plus. I've used it in every market situation, from the 08 financial crisis to roaring bull markets, traded it through debt crises, government shutdowns, presidential elections, flash crashes, you name it, from scalping and intraday trading to swing trading and position trading for weeks or months. You can do this with small or large accounts, and it can take it as little as 15 minutes a week if you wish. Now, before we dive into all this, let me introduce myself, who I am, and maybe why you should listen to me. This is myself with my two beautiful daughters in front of my alma mater. And 3 days after I graduated, I moved to the great Windy City. I sold my car, drove straight up to Chicago, and started working at the Board of Trade. It's here where I cut my teeth in the commodity markets. While there, I helped run a global trading desk at the Chicago Board of Trade, working with large block order flow for hedge funds, banks, commodity trading advisors. What does that mean? It means our desk was placing, executing, managing trades in a size of several hundred or thousand contracts, multi, six-figure, seven-figure position sizes where a single tick in the movement of a market meant $300,000 or $500,000, not for the faint of heart. I've also been a part of building and managing several futures and equity brokerage firms. I've also worked for a private family office where we manage about $2.5 billion. And then I hold or have held these various futures and securities licenses. And then in 2016 is where I launched my publishing brand. And it's here where we developed a community with thousands of traders and investors that use the education and tools that I've developed over the years to help them become consistent and profitable. Now, it wasn't always easy. There was a learning curve, several obstacles and hurdles on the path to where I am today. First step was obviously learning. School does not teach real life experience in the markets. In the beginning, I made money. In fact, a substantial amount of money. Was I lucky? No, but ignorance and greed cost me my profits. I blew up an account, blew up several others in what I like to call revenge trading. And these were extremely humbling experiences. I almost gave up, I almost quit, nothing seemed to work. I was always on the wrong side. But do you know what got me back in the game? I was in a dark place, but I went back to the very first trading setup I learned almost 20 years ago. I got back on track. I started banking wins again. I had gone off the reservation looking for the elusive Holy Grail, but my journey ultimately led me back to where I had first started. So I went back to my roots, worked my repeatable process to find overall consistency. But enough about me. Let's talk about you. Does your trading desk look like this? Anybody's trading desk look like this? This is a bad joke. I found this on the internet because I thought, or I think it's what the perception of what those on the outside looking in think this is what trading is about. We're surrounded by all these monitors and CNBC and Bloomberg, and really this is not necessary. This is absolutely unnecessary. Now, my desk did look like this in Chicago for obvious reasons, but all this does is lead to unhealthy eyeballs and paralysis analysis. So who here is or has been a victim of paralysis analysis? The state of overanalyzing or overthinking a situation so that a decision or action is never taken, in effect paralyzing the outcome. So I'm raising my hand. I've been there, done that, got the t-shirt. And my goal today, I promise, is pretty simple, that we're gonna rid ourselves of paralysis analysis. We're gonna learn a simple and mechanical setup. that is repeatable regardless of the market or time frame. And at some point during this presentation, I'm going to ask you, have I fulfilled my promise? And I want an honest answer. Now, I think that the most powerful thing that can be done is show you proof about what we're going to learn, because we all know that no markets go straight up, go straight down. Trillions have been lost by those who think they knew what they were looking at, got it wrong. But I'm going to show you how to get on the right side of these moves. They just say proof is in the pudding. So we're going to talk about how you can easily and mechanically find and locate setups like this in Halliburton. Shorting here in Halliburton, shorting here in Halliburton, buying here in Halliburton, shorting Halliburton. These are 10, 8, 12% moves. They may not sound sexy when you turn into CNBC or get your penny stock letter about gains of 1,000%. But these moves right here can mean up to $1,100 on 100 shares, $600, $2,000 on 5 option contracts. Let's look at another one. BMY. Who can spot these? Short here, long here, long here. 3.5%, 6%, 9% moves, equating to $400, $800, $900 on 100 shares. They all start to add up. Here we are in Lockheed move, 5% move, 6% move, 6%. What can you do? You can buy the stock, buy call options, sell bull put credit spreads, and gold futures. This is 30-minute time frame. Works on all time frames. Here we have an $800 per contract move, followed by a $450 per contract move. Day traders out here. 5-minute chart at even the S&P. 3 points, 8 points, 6 points, 10 points. Over $1,300 a contract in a single session. Do you start to see the potential here? 600 and tick chart on the 30-year bonds. 4 ticks, $125 a contract. 7 ticks, $218 a contract. Single session. Who would be happy with $218 a day, $500 a day, $1,000 a day, even $50 a day? This pattern is responsible for identifying these moves before they happen and let you know when to get out. So with all these examples I just showed you, can it really be too simple? Well, we know trading is not easy. It's not easy at all, but it can be simple. You see, when I got started, I was probably a lot like you, sifting through hundreds of different strategies, system setups, you name it. I tried all kinds of stuff. Indicators, red light, green light systems, Greeks, alert services, robots. Most of it was garbage. The single most important part of this journey was when I learned to keep it simple. Once I got rid of the clutter, the fancy blinking gizmos, and started focusing on pure price action, that led me to seeing one simple pattern over and over again. And guess what? This is when it clicked. It all started clicking. So if you're sitting here as a new trader or a struggling trader or even experienced trader, I'm about to teach you my foundational go-to strategy that got me from a struggling to a winning trader. I'm telling you right here, right now, this is a simple mechanical setup that anyone can learn. And you will keep this in your trading arsenal for years to come. And the end of today's workshop, I'm going to make you an offer you can't refuse. How you can join my team with a specific set of tools and plan that will help you shortcut not only your learning curve, but also the time you need to spend looking for quality setups. So let's get right to it. Now, the price action pattern we're going to be discussing today is the 1, 2, 3 pattern, also referred to as the 1, 2, 3 top or 1, 2, 3 bottom. Who here in the chat, type a Y, type a yes, type a hell yes, type a 777. Who here has heard of the 1, 2, 3? And let me know if you're trading this pattern right now. This is one of the most fundamental technical patterns in the textbooks. Highly, and I mean highly, overlooked by most traders. You know why? Because it's almost too simple. People are looking for complexity because they think that's the winning golden ticket. Well, let's talk about this setup. Setup is price action based, and guess what? Price action is king. And speaking of king, did you know that McDonald's and Burger King have different ways of choosing where to open new restaurants. McDonald's does tons of research. They look at maps, population counts, traffic patterns, competitive analysis, on until they find the perfect location for a new store. Burger King approaches it differently. They wait to see where McDonald's opens up a store. They open one up across the street or down the block. They get the same result with a lot less time and effort. So when we relate this to trading, we can let all of the large traders, institutions do the research on which markets to buy or sell. All we need to do is look at price action, which takes into account all of the fancy processes. Basically, we're the Burger King to Wall Street's McDonald's. So the setup is comprised of a low and then a higher high, a higher low, and a break of that higher high. In the case that we're going long, inverse if short, anticipates a change in trend from up to down on a break below the 2 or B point, anticipates a change in trend from down to up on a break above the 2 or B point. Usually occurs at the end of trends and swings, can be an indication of a change in trend, can also be found within a trading range. And I will stress it works extremely well when the pattern sets up at significant areas of support resistance, supply demand levels, head and shoulders, tops and bottoms, and more. But let's take a look at the basic mechanics. Let's start with identifying 1, 2, 3 bottoms. When we're looking for 1, 2, 3 bottoms, it means we are looking for a bullish setup. We are looking to go long. We're either looking to buy that stock, buy call options, expecting that stock or that market to go higher. So as price moves down and finds that lowest low and finds the ultimate support and traces up, we get our number 1. As the market trades higher and then pulls back, we get our number 2. And as the market retraces and stops printing these higher lows and retraces back, we get our 3. 1, 2, 3. We're looking to go long on breaks or closes above the number 2. We use 1, 2, 3 tops when we are bearish or looking to go short a market. We're looking or expecting that market to go lower, so we're looking to sell, buy put options, sell bear call spreads, expecting that market to go lower. So here we have price push up. Once we find that highest high and pull down, we have a 1. Once the market stops retracing and pulls up, we have a number 2. And when we stop printing these lower highs, we have our 3. 1, 2, 3. We're looking to get short on breaks or closes below the number 2. Now, one of the great things about 1, 2, 3 patterns is you don't really have to worry about the first 2 legs. It's not like you have to be glued to your computer all day long, unless maybe you are scalping. But all you have to do to cash in on the 1, 2, 3 setups is spot when it's about to go past the number 2 point. It's that simple. So let's go into some charts. Let's deep dive into some charts because seeing is believing. Now, this is a 1, 2, 3 top pattern on the Aussie dollar. 6A futures. If you don't trade futures, you could look at FXA, the ETF, or Forex traders can look at AUD, USD, the Forex pair. You're going to see the exact same pattern, exact same setup. So what we're looking at here is a daily chart. And what we're also looking for is a 52-week high. Now, it doesn't have to be a 52-week high. This is not a hard rule. We'll talk about ways later where you can dial it in to find more opportunities. But for this example purpose, we're going to look at a 52-week high. So we see a red 1 circle. That's a 52-week high. We have a 1, 2, 3. The market retraces down, pulls up. We get our number 2. As we stop making lower highs and pull down, we have a 3. Now, the market could have come all the way up here, 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 or here, as long as we didn't take out the number 1 high. We have a 1, 2, 3 top, and we're looking to get short on closes or breaks below the number 2. Now, you say, Silas, this is great. I already know the setup. Well, what about the other important ingredients of the recipe? Like, where's my risk? Where are my targets? Very important parts of the trade. Your initial risk goes above the number 1 high. Your target is the distance between the high of the 1 measured to the low of the 2 measured down. So you'll see that our initial risk right off the bat is, yes, a 1-to-1. We can do better, but it's very important to let the market materialize in its anticipated direction. So as we start breaking down below, taking out support, where is the next logical area to put our risk? Above the number 3. So we can quickly cut our risk down by 50, 60, 70%, and the trade moves on and reaches our $2,200 per contract price objective. Here we are on Walmart, daily chart of Walmart. We have a red one circle. Why? It's a 52-week high. Here we pull up, market retraces, pulls up, 1, 2, 3. We already know pretty much everything that we're going to do, where 98% of other traders are struggling and scratching their heads. We know where we're looking to get short on breaks or closes below the number 2. We know initial risk is above the swing high of number 1. We know our initial target is the distance between the high of the 1 measured to the low of the 2 measured down, which is about $5 in this example. Let's look at some 1, 2, 3 bottoms. Same process, same rules apply, only in inverse. So here is a 15-minute chart of the E-mini S&P. On a 15-minute chart, or on any intraday chart, whether it's a 2-minute, a 1-minute, a 10, does it make sense to look for 52-week highs or 52-week lows? No, absolutely not. So on an intraday chart, we're looking for what's called new session highs or new session lows. And so if you're not familiar, futures and Forex markets are trading virtually around the clock. So whenever you log into your computer for the day, you are looking for new session highs or new session lows. So we get a new session low. That's why we have a red 1 circle. So we have a 1, 2, 3. Talk about a couple of different entry techniques. So aggressive traders could consider getting long a tick or 2 above the number 2 high. You're triggered into the trade. Now, an alternative method, at least one that I prefer, is either to A, wait for the market to come back, retest that breakout here, or let the market come back and do what is called a second pass or a hook back above. So if you utilize this method here, sometimes you'll miss out on trades. Sometimes the market will break up above the number 2, zip on up to the profit target, and leave you at the train station. That's okay. There's no need to get your feelings hurt because there's plenty of other opportunities. So what this will also do is sometimes by waiting for this second confirmation, it keeps you out of false trades, false breakouts. Sometimes the market will break up and then it'll come down and then it'll drift lower, lower, lower and stop you out. So this, by having the second confirmation, that can help put the odds on your side. Here's a weekly chart, a hell of a way to catch some longer term position type moves. Here we have a multi-week low. We have a 1, 2, 3, also a double bottom. Market breaks above the number 2 on this large bullish candle. 4 or 5 weeks come by, pulls back, hooks back up. That's our confirmation to get long Apple. How? We buy Apple stock, we buy call options, we sell bull put credit spreads, whatever your flavor or style of trading may be. Now, hate to burst your bubble, but they don't all work. They don't all work. There is nothing guaranteed in life or in trading, and this is a trade setup I probably took here in my real account. Here we have the market trading higher, new session high, 1, 2, 3. Aggressive traders could get short on the initial break below the number 2, or if you wait for that second pass hook, you get in right here. Now, if you sat on your hands and didn't do anything, you're stopped out at the initial risk point, or if you exercise money management, once we took out these lows here, you moved your stop above number 3 and you cut your risk in half. Guess what we also get here, guys? Guess what we also get? A new entry. This high is greater than this high, so we start to count over. 1, 2, 3, market breaks down, and we end up having a profitable trade. Now, this is an example of what I call a no trigger or voided trade. It's neither good, bad, nor ugly. It's just a voided trade. I'll tell you why I like these. So here we have a 1, 2, 3 looking to get long. The market trades lower, takes out that number 1 low. we start to count over. 1, 2, 3, looking to get long above the number 2. Market breaks lower, we start to count over. 1, 2, 3, finally are able to get long in this third situation. Now, why do I like these? What is likely happening? Can anybody tell me? Price is making new lows, new lows, new lows, but I bet if you added an oscillator there of your choice, MACD, RSI, stochastics, will probably have higher lows, higher lows, higher lows. That's called divergence. That is another piece of confluence there to add to an already high probability setup. So pattern trade management, again, the confirmation of entry is on a break above the 2 or B point for a long, or a break below the 2 or B point for a short. Exit strategies. If you're only able to trade one contract, whether it's one futures, whether it's one option, one share of stock, I would say, hey, go for the distance between the number 1 and number 2. It's uncanny how often the market will often tag that to a tick and often reverse. If you have the ability to trade multiple contracts or multiple shares that say, hey, take a third, take half, 2/3 off at that number 1 point or that distance, and then you trail your stop with whatever methodology fits your style. Basic trend lines, parsar, moving averages. You have to figure out what works best for you. Now, I've showed you that this setup works in any market, whether it's pips and Forex, Pepsi stock, potash or pot stocks, pork bellies, or the Polish zloty, and on any time frame, whether it's a tick, 5, hourly, daily, weekly, monthly, and more, and on any trading style. Let me know in the chat, are you a position trader, swing trader, scalp, tick trader? What is everybody's trading style? Let me see where you are here. So swing, weekly options, day and swing, scalper, day trader, not sure yet. That's perfect. My point is that you have to figure out what your bread and butter is. I'm not going to tell you that this strategy only works on a 5-minute Bitcoin chart or a weekly chart of Apple, because it's not true. It does not matter. It does not matter what you trade, what time frame you trade. Figure out what works best for you. And these are some of my favorite time frames for both intraday trading as well as swing and position trading. So you've seen the proof. Let's look at some real trade examples. And let's not to say what I showed you were fake examples. Those were real examples by all means. But let's look at some of examples we utilize in some of our services. So I'm going to let you guys and gals read all this over here to the right. I'm going to look at the chart and work myself from left to right. Okay. So here we are on a daily chart of crude oil. Daily chart of crude, we have a red one high. Why? Because it's a 52-week high. We have a 1, 2, 3. So we know in advance before we even enter where we're looking to get short on breaks or close below the number 2. We know our initial risk is above the number 1 high, and we know our initial target is the distance between the high of the 1 measured to the low of the 2 measured down. So we break down, we get a couple retests, we meet our $3 or $3,000 per contract price objective, and then we go sideways. I get asked all the time, Silas, does this work in range bound or consolidated markets? Well, yeah, you could trade this 1, 2, 3, 1, 2, 3 pattern. Market trades higher. Good for you. Pat yourself on the back. I'm looking for new highs or I'm looking for new lows. So we get a new high. This high is greater than this high. So we get a new 1, 2, 3 count. 1, 2, 3. Really licking my chops at this setup. Why? Because of not only the high probability 1, 2, 3 top setup, but we're now at a time of the year where crude and energy markets in general typically trade to the downside. So we have 1, 2, 3 top, bearish seasonality. We're all over this. We break down, we get 3 or 4 days of retest. We come down, meet our $4 or $4,000 per contract price objective, and then we start melting. We start melting, and all we're doing is trailing the market through a stop or until we get a reversal. and the market sells off another $20 or $20,000 a contract. We get a potential 1, 2, 3 here, potential 1, 2, 3 here. We never take out the number 2. We never take out the number 2. The market goes higher, lower, another $10 or $10,000 a barrel. Finally get our bottom. 1, 2, 3 bottom, breaks above the number 2, hits our $5 per contract price objective. Now, I want you to remember this chart in the subsequent charts because I'm going to show you something really special in just a moment. Well, if you're looking at this chart, you say, Silas, this is 2018. Come on, you're killing me. Show me some recent examples. Here are some recent examples. Crude oil, $5,900 move, $9,700 move, $4,500 move. Here we are in gold. This is actually GLD, the ETF that tracks gold futures. So that's why it looks a little spottier. Nonetheless, same pattern. 1, 2, 3 top, breaks down, reaches our $4 per contract price objective. Here we find a new bottom, new low, 1, 2, 3, double bottom, breaks above the number 2, reaches our $2 profit objective. Then we go sideways. Well, Silas, what about this in the middle? Maybe a 1, 2, 3, maybe a 1, 2, 3. Yeah, hey, if you caught those, you trade sideways markets, go for it. I'm looking for new highs, I'm looking for new lows, and we get just that. Potential new number 1 here, potential new number 1 here, 1, 2. But look, this guy comes and breaks that low. No worries, we start to count over. 1, 2, 3. Gaps higher 2 days in a row, comes back down, retests, hooks back up. That's our cue to get long gold. Buy gold futures, minis, micros, buy call options, buy GLD ETF, sell puts, whatever your style or flavor is. Silas, you're killing me. This is 2019. Does it work in today's environment? Well, of course it does. It's price action. How about a $19,000 move? How about an $8,000 move? How about a $24,000 move trading this simple pattern? Delta Airlines. This is becoming very redundant by now. I'm trying to hit home the fact how these repeat over and over again. Here's a long, here's a short, here's a short, here's a long. What about current market environment? Here's a long, here's a short, short, long. Forex friends, CAD Swissy, Canadian dollar versus Swiss franc, multi-session low, 1, 2, 3 bottom. Aggressive traders get long on the initial breakout, or if you wait back and wait for the hook retest, you're long, you beat your 70 pip profit objective. What do we do now? We don't do anything until we get a new signal. Maybe a new 1, 2, nope, 1, 2, nope, 1, 2, nope. Finally, a 1, 2, 3 top here. We break down, reach our 40 pip profit objective. Canadian dollar versus Swiss franc, 80 pips, 70 pips, 35 pips, 70 pips, 55 pips. Day traders, 5-minute chart NASDAQ. Session low, 1, 2, 3, we break above, we come down, hook back up, we reach our 13-point profit objective. New session high, 1, 2, 3, we break down, go sideways, pop some tums, market breaks down, reach our 20-point profit objective. New session low, 1, 2, 3 bottom, break above the number 2. If you're lucky enough to get long in that retest, you reach your 30-point profit objective in about 2 or 3 bars. 137 ticks, 60 ticks, 91 ticks. So now I'm going to ask you, why are you here? Why are you here? You're here to learn a mechanical, simple, done-for-you strategy for all markets and all time frames. This is the part where I ask you, have I shown you enough proof? Have I shown you? It does not get any more mechanical, simpler, easier. There's no guessing where to get in, where to get out, where the market's likely headed. If we have 100 traders in here, we should have at least 99 people seeing the same thing. There's always somebody out there that wants to make this rocket surgery, make it complicated. Well, we don't need to. I want to take it a step further. One weakness or drawback of these setups is that there are so many of them. How do you catch them all without spending hours in front of your computer? Well, what if this strategy was automated? What if the strategy was plotted onto your chart for you? What if the trigger entry targets were drawn for you? And what if your platform could scan the markets for you and tell you when there's a penny setup? I don't know about you, but I'd say that's pretty damn amazing. Remember the examples I showed earlier? Crude oil, same chart of crude oil. Now we see some colorful arrows and some pretty lines. Well, you're smart boys and girls. Let's see what this is. The green arrow is your 1, the red arrow is your 2, the blue arrow is your 3. 1, 2, 3. If and when we break below the number 2 or break above the number 2, we're going to get a white chevron. That's telling us it's not a buy or sell. It's waving to us saying, hey, we have a potential short here. We have a potential long here. If and only if we get a break below the number 2 and get our chevron, we're then going to get our colorful lines plotted onto the chart. The blue line is that breakout or entry level. Your red line is your stop or risk level. Your lime green line is TP1 or profit objective 1, and your dark green line is TP or profit objective 2. Remember the distance, TP1 is the distance between the high of the 1 measured to the low of the 2 measured down, and TP2 is 2 times the distance of TP1. Here we are on gold. 1, 2, 3 bottom. We break above the number 2, we get our plots. TP1, TP2. We don't get anything right here because we're looking for new highs or new lows. These green arrows are pointing new lows, new lows, new lows, new lows. Okay, we finally stop making these new lows and we have a setup. 1, 2, 3. There we go. TP1, TP2. We start to get a 1, 2, 3 top over here in the top right-hand corner. There's Delta Airlines. There's your long. There's your short. There's your short. There's your long. Could you have bought call options? Could you have bought put options? Could you have sold bear call spreads? Could you have sold bull put spreads? Yes, 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 and yes. 5-minute NASDAQ. 1, 2, 3 top. We break down, hit TP1, hit TP2 to the tick. Happens to be a new session low, so we start a new 1, 2, 3 bottom count. 1, 2, 3 bottom. 1, 2, 3. We break above, we come down, hook back up, hit TP1. Don't quite hit TP2, but it's close enough for government work. You shouldn't have lost any money. We go sideways, new low. This low is lower than this low. 1, 2, 3. Market peaks its little head there above the number 2, comes down, hooks back up, comes back down again, hits TP1. As we're looking for TP2, we start to get new session highs. This clues us in that we may need to get ready to look for a short. We end up hitting it TP2, new session highs, 1, 2, 3 top. We break down, we come up, back down for that second pass, TP1, TP2, and we get a new second. So this is training for you. Only you and you only can answer this. Does not matter what you trade. If you're new to the markets and want to jumpstart your success, if you're an experienced trader and want to add an arrow to your trading quiver, if you're tired of all the noise we talked about, the indicator overload, paralysis analysis, if you just want to simplify your process and add a new strategy to your toolbox, if you need something that you can use part-time and even avoid doing this on your own, this could be for you. Have setups like this in Holly Frontier. Long, short, long. Trades like this in Google. Short, short, long, short. Trades like this in the Canadian dollar. 4-hour chart. Long, short. 233 tick chart of even S&P for those that love to scalp. You love to scalp, you're going to love the 233 and 610 charts. Why do all the work for you when you can let technology do the work for you? This is my scanner in Thinkorswim. I'm scanning for 1, 2, 3 tops across the Russell 1000. Stocks that are only optionable. $20 a share or greater. I hit the green scan button. What would take me days or weeks to sift through 1,000 stocks is now done in seconds. I am running multiple watch lists across different markets, asset classes, and timeframes every single day. We built this for Thinkorswim, TradeStation, NinjaTrader 8, TradingView, MetaTrader 4, Wealth Charts, and MetaStock. Is this not a thing of beauty? Now, we know there's no real crystal ball in the markets, but I view this as one that provides me a process, a plan. Every single day, I'm letting technology, my platform, scan markets for me. I locate the setup. I go to my platform for entry, and I manage that trade to the exit. And you can start doing so today with the 3S code. So here's your offer you simply cannot refuse. Now, All of this programming, coding, software development costs well into the 5 figures. 7 platforms of coding, 7 different requirements, hundreds of hours of testing. I realized that the $3,000 price tag was way out of reach for most folks. Hell, even $2,000, hell, even $1,000. So I truly mean this when I say I want you to be able to start on the right foot right now with a proven mechanical, no BS, no guessing, straightforward setup that you could literally take and use for the rest of your trading career. So we made this absolutely and completely affordable today for those that are willing to take action and get in right now with today's special offer. We've opened up 25 slots. You're going to get the 3S indicator for 7 platforms, the 3S code scanner for 6 platforms, the 3S code optimizer, access to biweekly strategy and scan sessions, private Telegram room access, 3S code quick start guides, and more, all for the one-time fee, lifetime fee of $397. And you go to tradestreaming.com/code if you want access today. We open this to 25 slots. Why? Because you will get a personal onboarding follow-up with our team. We want to ensure you get started on the right foot. We can help install the indicator for you. We don't want any questions. We want you to be able to start using this in the market. Now, these are the platforms: Thinkorswim, TradeStation, Ninja, MT4, Well Charts, and Metastock. You're going to get the indicator and scanner. TradingView is the only platform we don't have a scanner at this time. It's simply a limitation of the platform, but if and when we do, that will also be included. tradestreaming.com/code. Now, we've also offered a PayPal option for those that want to use it. You'll find that on the order form, tradestreaming.com/code. You can do a direct purchase, or you can finance if you wish. Now, you're also going to get access to weekly strategy and scan sessions. This is where we are locating top setups, doing a multi-analysis, high time frame analysis across stocks, commodities, currencies, how to day and swing trade using the 3S code, using options, and much, much more. Remember, I want to make sure you understand with this package what you're getting. You're getting the indicator and scanner that includes a visual plot of the 1, 2, 3 top and bottom reversal areas. That includes the entry, exit, stop, targets, customizable settings. You can scan for setups only, triggers only, 1, 2, 3 tops, 1, 2, 3 bottoms, or both, intraday setups, swing setups, or both. You're also getting the 3S code optimizer. You can now take this mechanical 1, 2, 3 top and bottom strategy and create and run multiple back tests across various inputs to find your best parameters that fit your trading style. Here is the optimizer in Thinkorswim. You can see I'm running this here on crude oil. Here it is in TradingView. Here is the 3S optimizer in TradeStation. Here is the 3S optimizer in NinjaTrader. With the 3S code package, I'm also throwing in these additional bonuses. This trading manual, chart pattern principle trading manual guide, will help jumpstart you by teaching you how the market works, why markets move the way they do, who the players are, and how to look and understand the market the proper way, plus bonus setups and how we use the power of seasonality to trade the 1, 2, 3 pattern. You're also going to get my 25 top option strategy guide. This is great regardless of your knowledge of options. I include this guide because I believe options are a powerful trading instrument if you know how to use them properly and if doing it the right way using the 3S code strategy. You're also getting access to our private Telegram room channel. Every day, I'm posting analysis and chart setups across stocks, ETFs, indices, commodities, currencies, day setups, swing setups, and more. You get complete access. Here are some recent posts from our Telegram room. Short here in Nucor, short here in Cardinal, setups here in the E-mini S&P, setups here in Moderna. Here are some testimonials. These come in all the time. I don't ask for them. They come in the time all the time. And it makes me extremely happy. And I'm humbled because these are people that are taking action. You're not going to see results unless you take action. And these people are seeing results because they have taken action with the 3S code. So who here is ready? Who's ready to get started? Right now, there have been some incredible setups today using this indicator, and I'm going to show you. I think I've got a couple minutes, and here is the complete offer. Guys, this is a one-time lifetime access fee. You get immediate access to all available indicators. If you want to load it on NinjaTrader and Thinkorswim, if you want to load this on TradeStation and TradingView, if you want to load it on all 6 platforms, 7 platforms, you have the ability to do so. So I'm going to stop here and answer a few questions before I turn it back over to the Traders Quarter team. Does this work on NinjaTrader, M? Yes. Does it work on range bars, Carlos? Yes. Does it work on Heikin-Ashi? Yes. Is this a subscription? No. You keep saying 1, 2, 3, but they don't seem to make sense or be obvious. Well, if you're having problems and they don't make sense or are obvious to you, then you most certainly need the indicator. Can everybody see the chart right now where we are in the E-mini S&P? Can everybody see this chart? Does this work on TradingView? Kumar, we're looking at TradingView as we speak. Does it work on TradeStation, Vikram? Yes, I've showed you right here, 7 platforms. Everybody see this right here? Do you see these setups? Do you see the 3S code right here? Everybody see this. Everybody see this. Everybody see this, 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 and this. This is real time. This is not repainting. 1, 2, 3, target 1. 1, 2, 3, target 1, target 2. 1, 2, 3, top, target 1. 1, 2, 3, target 1. 1, 2, 3. We give 50% to target 1 and then reverses, but then we get a new 1, 2, 3 top, hits target 1, 80% to target 2. Everybody see that? Yes, if you need assistance loading this on any platform, your platform of choice, all you've got to do is email support@tradestrading.com or call 502-383-1182. Our team can help you place the order over the phone or answer any additional questions that you may have. Sorry, but sorry, Silas, you were able to see 1, 2, 3. I only see X. This is the 1, 2, 3. The X is showing you the break of the number 2. See this? 1. Here's the 1, 2, 3 pattern. Green arrow, red is your 2, blue arrow is your 3. Once we break the number 2 right here, we get the white X. We break the number 2. You already know that you're looking to get short on below the number 2. Target 1, target 2, risk. Can I look at Tesla? Tesla. There you go. 1, 2, 3. There's your entry. Target 1. Target 2. This is not automated right now. This is not a robot. We are working on automated features, but the setup, locating these patterns, the setup, and using scanners is what's automated. I think my time is up. I want to give a big shout out to Rob and Traders Corner for having me on. I really appreciate it, appreciate the opportunity, and thanks and welcome to all the new students. I see a lot of you guys are in. If you have any questions, reach out to support@tradestrading.com. Have a great week, and we'll see you next time.
Silas, man, I want to thank you. I know we handpick our traders and get the best and most credible, but the 1, 2, 3 was not in my repertoire, but after watching your presentation, that is one more thing I am putting in my tool belt. Ladies and gentlemen, if you're interested in a simple 3-step system for day and swing trades that provides you with precise entry and exit price points, and I gotta say, what you did with the SPY chart live today, that's what I mainly trade. Oh my God, did it call it amazingly. But remove emotions from trading, work in all market conditions. Mr. Peters of TradesTrending.com has a solution for you. To learn more, he beat me to put in his link and his number in the chat box for him. But Silas, thank you again for making such a generous offer, for being here today. We hope you come back and see us again.
Thank you so much. Take care, everybody.
Not a problem. Have a great weekend. Ladies and gentlemen, we're going to keep the ball rolling, and our next presenter is a 9.5-year United States Army veteran. He's a married father of 9, and he's a leader in his local church and a successful business owner and trader. That, however, wasn't always the case. His compelling broke dad to 7-figure trading success story will captivate and inspire you. He's dedicated to helping people from all walks of life fulfill their financial dreams while also achieving financial freedom. Helping others is at the heart of all that drives him on a daily basis. Ladies and gentlemen, here to present Unlocking the Secrets of Making Money from the Stock Market, Expert Strategies for Financial Success. It is my pleasure to introduce Mr. Casey Stubbs of Trading Strategy Guides. Welcome back to Trader's Corner, Case. Let me unmute you, brother. Try again.
Okay. All right. Rob, how are you doing?
I'm doing good, man. I said before every presentation, I took the SPY long off of the bottom today, and I got out right around the top.
All right. Good stuff, man. You're awesome.
I'm not as awesome as everybody else on here. Maybe one day I'll have my own system and present, but you guys are where I learned from, and hosting this has been a great contribution to the success I found trading with the tidbits I get from everybody.
Okay, cool. Well, I also went long on the S&P 500 today, but I didn't pick the bottom. I just kind of waited for it to go up, and we'll see if it continues to go. I'm still in the trade. Tell me what you can see right now. You see my screen and all that? I'm trying to figure out.
I do, and we've also got your webcam on. I'm not sure if you want to leave it on while you have your PowerPoint up.
I like to have it on because I want people to see me and all that. Okay, so I like to look at myself while I'm talking too. Anyways, how much time do I have, Rob?
It's a 45-minute slot. You've technically got until quarter after. The fact that the previous presenter ran a few over, if you do too, not a big deal.
Okay, well, no, I don't mind. Okay, all right. Well, thank you, Rob. Let's get going. So we're going to talk about stock market patterns to trade. And so if you notice my little slide here, it's got a chart and then like a blue line, and it says stock market underneath. That was an AI image generator. So I put a bunch of AI images when I was prepping this slideshow, just because I think they're pretty cool. They're really weird, but cool at the same time. So if you see these weird images, you're gonna know. And if you haven't played around with the AI image generator, you should, just because it's fun. I've been putting them in videos and other things as well. Okay, so first thing we want to talk about with market investing is we want to talk about timing, right? When you're looking at the market, and the AI image generator does some weird stuff. Like these pictures are just so weird when you zoom in on them. But you want to be able to time the market, right? And that's the hard part. Rob was talking today, and he was able to time the S&P 500 and make an absolute perfect entry. And that's all about timing, because in the past couple of weeks, the S&P has been going down, 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 down. But today, it bottomed out. We got a nice little pin bar, and it went up. And so that's a big part of timing. So try to work on improving your timing. and learn how to get timing and understand the timing of the markets. Okay, and I'm going to share a little bit on how I do it, and primarily we're going to go over two patterns that I use to time the markets. Patterns are part of it. Okay. However, the first thing that I like to look for is I like to look for growing companies, right? If we know that the S&P 500, and I'm not sure what markets these guys are trading when they say they were hitting it, but I like the S&P 500. But you've got the Dow 30, which is a market index. You've got quite a few of them. There's the NASDAQ, right? S&P 500. My personal favorite is the S&P 500. Now, the thing about the S&P 500 is that they're all growing companies and they're all solid and great companies. So if you just use the S&P 500, that's great, you know, because you know that they've taken 500 rock solid, amazing companies. You don't want to invest in something that's not growing, that doesn't have predicted future growth. So you're looking for companies that have earnings growth and that are looking for predicted future growth. And one of the things that I like to do a lot with that is I like to look at tech, right? Tech is a big thing for me as far as, and this is like if I'm doing long-term investing as well, but it also applies to short-term. So what I do is I trade, and then I take some of the revenue that I make from trading and I throw it into a long-term investment portfolio. So having a long-term investment portfolio, I think everybody should have, because then you're not really working to make money, it's just compounding over time, right? And so you want to find companies that are growing. And if you find something that has a new breakthrough technology, that makes a big difference. A big difference, because if we look at things like recently, just the creation of the internet. You know, I feel that I'm really not that old, and I'm not, but I know that when I was growing up, there was no internet, right? And so when the internet came out, it changed everything. And, you know, phones, when I was growing up, there was no cell phones. We didn't have cell phones when I was growing up, right? And so those technologies have been amazing to invest in. Internet companies, if we look back in the late 1999s when we had the dot-com boom, but anything internet was exploding, and then it crashed. But then after that crash, the internet was very stable and had a continued move to the upside and a great opportunity to make tremendous amount of wealth. So I started investing in late 99, and those were some of the stocks that I got in, and they have paid off tremendously. Think about like Amazon, right? Amazon was an internet stock, and that thing just took off, and the earnings grew and the stock went up, right? And it's based off of new technology. So some of the new ones that I'm excited about right now, well, we have EV, which is electric vehicles. You know, that's a new tech. Looks like there's still a lot of growth in that. Another relatively recent a recent field is crypto, right? And you know, some people hate crypto, some people love it, but I believe that it's here to stay, and I think that it's got a pretty bright future ahead. And then the probably the newest field right now that's getting the most craze is AI, right? AI's been, I would say 2023 has been the year of AI. I mean, everybody's been talking about it, trying to find ways to invest in it, and it's so new right now. And that type of company could pay off for 20 years. You know, you get in now and it could just go up and up and up for 20 years. I love the fact that technology is what drives the market, and new innovation and new inventions. You know, we can look at all the negative things about the bad economy, about the bad things in political stuff, all of the negatives out there, and there's a lot of things that are negative. But when we look at new technology, that is an exciting thing, because those fuel revenue growth and it fuels the future. And over the last couple hundred years, as if we've been investing in new technology all the way back from when electricity was started, or the light bulb, or automobile, telephone, all of those inventions have driven the markets for so long now and have created incredible wealth for millions and millions of people. And when I say millions of people, if we look at the United States and other nations, those inventions have created an amazing prosperity and an amazing lifestyle for these countries that is pretty phenomenal if we look back at it, and something for all of us to be very thankful for. So that's the first step of this strategy, is I'm looking for those kind of companies, okay? And you know, one of the tools that I like to use, I'm going to share a couple tools, but one of them is Yahoo Finance, and I didn't put it on here. I probably should have put a little notation. But Yahoo Finance, I get these revenue charts, right? And so I like to see, this one is not the greatest example because in 21 it was growing, and then 22 took a little bit of a drop, but then 23 we're growing again. And so I like to see revenues that are looking like this, right? Those are the revenues, and I like to see earnings that are stepping up too, because that's really my first filter. Now, here's the thing that you got to remember, that's called fundamentals, right? That's called market fundamentals, and a lot of people don't like trading on fundamentals. Well, it's either way. Some people love fundamentals and that's what they invest in. They don't time the market at all, okay? Then you have the other hand that times the market and they don't worry about fundamentals. But then I like a combo of both, because I know that if you're investing in just fundamentals, if those fundamentals continue, even if the market has a big dip or the company is in a little bit of a slump and the stock price drops, well, eventually it's going to come back. And that's where my dollar cost averaging strategy comes into play, because if you keep investing in a company like this that's growing its earnings, growing its revenue year after year, you are going to make a great deal of profit. And I absolutely love the fundamental concept behind dollar cost averaging, because dollar cost averaging, the price will go down and the price continues to go down, and you keep investing in it, you keep investing in it, I just did it on Coinbase, and I should have included a chart, but I got in on the IPO, and my first price, I thought, waited for it to drop a little, was like in the 300s, and I'm like, oh man. But I still had, you know, I like crypto, and so I kept investing in Coinbase. I just kept investing, and it went all the way down, I think, to like $31. So it's like, oh my goodness. Not good, right? Your first investment goes from 300 to 31, but I just kept at it. I just kept putting in, and just every single month dropping it in. And then when it got down to 31, I went in pretty big, and then the price came back to like recently just hit 100, I believe, and I was in massive profit, right? So my first entry was at 330. But because I was consistent, by the time it got to 100, I was at like a 25% gain on that investment. So 25% ROI is great. It took a couple years to get, but still 25% ROI is phenomenal. And if it goes back to IPO price, it's my profit on that's going to be insane. Okay, and so that's why timing the market, sometimes it doesn't even matter, because you're just consistently putting in on the dollar cost average strategy, you're going to make out big. Okay, so that's where fundamentals come in, just sticking with it, finding the right things. And so another little tip that I like to look for with these fundamentals is I like to look for the leadership. Okay, if I find an industry, find the best of that industry. You know, the leader is always going to outperform the rest. It's just like in sports, right? You've got you know, if you guys are soccer fans, you've got some of the best players in the world. And I know one of them is Messier, right? He just won the World Cup, right? I'm not a soccer fan, but I've heard that name and I know that he's really good. And there was the other guy, I think his name was Ronaldo. Like those guys are like, those are the kind of stocks you want to invest in, right? The leaders of the pack, because you know they're always going to perform, they're always going to do good. You look at the leadership of the company, you're trying to find all stars. In stocks, you want same thing. You're going to find all stars, ones that will perform all of the time. So getting a good solid company is a great part of the foundation of making money in the markets. Now, the next part is what we're going to do is go over some patterns, and I have two patterns that I like to look at. Okay, and so one of them is called the box breakout pattern, and this is a very simple pattern to trade. Okay, very simple. However, I'm looking for one that's upward trend, so let's go ahead and take a look at it. So here's the rules. I look for a stock above the moving average that are in a box on the daily time frame, and I wait for them to break out of the box, and then I add a stop loss below the box. Okay, so this is super easy. I mean, this is simple, and this is the timing side. So remember, I'm also looking for companies that are fundamentally solid. And another tool that I use is I use FinViz. If you guys have ever used FinViz, I use FinViz to find the stocks that I'm looking at. Okay, but let's go ahead and take a look at a couple of charts here. So this is the chart that I had the earnings for, right? And that was FedEx. So you can see, listen, the market has been so bad, and this is another thing I like about individual stocks. The market's been really bad recently. I mean, it's just been tanking, and yet we still have stocks that go up, which is why screeners are really important. So I run my fundamental screen, and then I run my technical screen, and I don't get a lot of options either, which is nice. I don't have to scour through. The screener does all the work. And look, I've got a trade in a box. So you'll notice that we have 1, 2, 3, 4, 5, 6 days inside this box. Okay. Now, if we go back, it was in this box for a long time beforehand, and it never broke out. Okay, so now we're coming back and we're getting a second chance at it. So I really like this as a nice entry, but I'm going to wait for it to break out of this box, and when it does, I'm going to buy. Okay, and I'm going to buy the stock, and then I'm going to put my stop loss right below this box. Okay, and I'm going to put my target. My target is going to be the length of this box, right? And so I don't actually have the numbers here, so I don't know what that price is, but it's going to be, I'm going to measure this out. So if this is like a $15 box, the price on the target is going to be 15, and the stop loss will be 15. Now you'll notice I didn't actually draw it, but you'll notice here that we have right in this area another box. Okay, so you see that, and this particular box right here had a very nice breakout, and we would have put our price target here, you see, and our stop loss would have been about the size of the box. So our stop loss would have been right here, or our target would have been right there, and our stop would have been down here. So this would have been a perfect trade right here. Okay, and then you can see there was other examples of this too. So when inside of an uptrend, these little boxes will happen all the time. Okay, so you're going to be able to see these all the time, and once you start seeing them, you'll be able to identify them. And one of the things that you got to understand is just knowing how markets move in general. The markets will consolidate, right? And what consolidation means is it's the market collecting buy and sell orders, right? It's just building up traffic, it's building up orders for this instrument. And the market is going to need a certain amount of buyers and a certain amount of people selling to push this price up, right? And so the reason it doesn't move up is because it doesn't have enough buyers. And so as people start getting in here, they're like, okay, it's getting good, it's getting good, it's getting good, and they're just collecting more and more buyers. So consolidation is a good thing. When you see it, just be ready, but you don't want to trade inside of the consolidation patterns. You want to wait until it breaks out. So that is, that's what I call my box breakout pattern. All right, and so I'm gonna show a couple more examples here. Okay, all right, this is a stock called ALV. ALV, and you can see right now we're in a box, and what I like about it is that we're trending up. The 200 period moving average I put on the chart, make sure it's up. We've got the 50, it's just breaking above the 50 right now, but look, we're in a box, and this box, we do have the price on it. This box is from 94 to 97. Okay, so I'm just gonna say that this is a $3 box. So I'm gonna put my target right here on the breakout at $3, and I'm going to put my stop loss below the box, so it's about a $3 stop with a $3 target. It's a 1-to-1 risk to reward ratio, and this is a perfect setup. So right now, the last two stocks I showed you, which was FedEx, FDX, and ALV, neither of them have triggered yet. Neither of those are entries, but put them on your watch list, and you'll be able to see the price moving on those, okay? Also, let's keep going here. Let's keep going. Next one. All right, this is BKNG. And so this has a small little box right here, but it's also got kind of a bigger one. So I'd probably trade the bigger one, which is right here. So the big box, and this is a big price on the stock, Booking Holdings, BKNG. This box is actually really big. It's from 3,180 to, we'll say 3,000. So this is like a $200 box, right? But this stock moves a lot. So $200 for this stock isn't massive, but we'll put our target right up here at 200, and our stop loss will be right under here. Okay, so we're gonna wait for this. But you can see this is a very nice uptrend. Really solid company, is consistently growing earnings, a great investment, okay? And you can see before we had some of these other boxes in the past, like right here was a box, right? And you can see where this one would have gone, right here, put your stop, right there's hitting the target. So you can see that this pattern is very consistent, and over time, if you are, when you're trading, if you, let's say your target is $3 and your stop loss is $3, all you have to do is hit just over 50% of the time to be profitable, right? So this is a strategy that has a pretty high win rate. So if you just do this over and over again, and you can win 55, 60%, you're going to make money, right? And yes, you're going to have some periods where you're going to lose money, but what I like about this is that even in a down market, you can do this, right? Because we've had, as you guys all know, as everybody knows, we've had a very down market the last little bit, okay? All right, so one more for us here, and this is called SLB, Schlumberger. You'll notice here that we've got inside the box here at 62.22, and right below is 58.58. So this is about a $4 box right here. Now, you're going to also notice that we have a pretty solid uptrend. The 200 period moving average is up. We got a bouncing off this trend line. It's got the 50 period moving average. It has some support down here as well, but we're in a box right now. And so I don't know what's going to happen. It might come down. It might stay in this box for a while, but when it breaks out and closes, so this is a trade that has not been in, but when it closes above that high, which is 62.12, at that point, I'm going to be looking at taking an entry, right? And what am I going to do? I'm going to put my stop loss right here, and I'm going to put my target at about, it's not on the chart because this is a $4 box, right? This is a $4 box. So I'm going to put my target around $66 on this one, okay? So it's very simple strategy, doesn't take a lot of your time. If you happen to be one of those poor people that have to work for a living, you can do this and work, and that's okay, right? You can just do this and check the chart at the end of the night and put the order in for the next day. And you can do this in a matter of a few minutes a day. I personally don't like to spend a ton of time on trading. You know, I only want to do a few trades at a time, okay? I only want to spend a few minutes. I want to look at the scan and I want to do, you know, I want to look at the scan, go through a couple charts, look at my orders and just make it happen. I don't want to sit in front of the charts all day. That's just not something I want to do. And so with trading, you don't have to do that, and you can still be very successful. You don't have to stare at the charts all day, and you can still make a great amount of revenue just by trading a little bit in the evenings, right? You don't have to, you know, it's a misconception if you think that you have to be in front of your charts all day to make more money, because that's not true, or even that you have to trade more. If you just take 1 or 2 trades a week and you are consistent, you're going to be able to increase your profits through scaling those profits. Okay, now the next pattern I wanted to look at is the megaphone pattern. And if you look at this image, this is an AI generated image. I don't know if anyone was paying attention, you noticed how strange some of those images were, but this is a guy on a megaphone and he's like really weird. That's because it's an AI generated image. So, okay, so megaphone pattern. Let me give you a little bit of a rundown on the megaphone pattern. So it's very similar, okay? So that's the first thing I want to say. It's very similar to the box. Because you remember the box that we just showed you? The box was going sideways, okay? Right? Sideways. And this is the exact same thing. The only difference between this pattern and the megaphone is that this pattern is at an angle. You got a slight angle on the top and a slight angle on the bottom, okay? And you're going to trade it the same way. Now you can trade off the tops here, okay? The tops and the bottoms, you can do that, but the ideal way is what we call a breakout, a megaphone breakout. But again, megaphones are just consolidation patterns. So when I talked about the box being inside and that it's consolidating, we're looking at price building up those orders so that it can push to a big level. So a lot of times, this could also be called a flag pattern too, but a lot of times you'll see a big move like this, right? You'll see a big move here, okay? You will, it's because it runs out of momentum, because the price runs out of momentum. So it comes up and then it just can't keep going. And so then what happens? It consolidates until the next breakout. And if there's enough buyers, it'll go to the next level. If there isn't, then it will disappear and just drop and just, you know, go down. Okay, so that's how that works. Okay, so let's keep going here. So this one right here, this is an ascending, and just another example. This is just another chart. You can see what it looks like here, an ascending one and the descending. And so yeah, obviously a trade off the bottom of this. Any of these trades off the bottom are pretty good trades as well, but you want to be able to try to catch it to break out, because once it breaks out of the top, then it's going to go to a new level. Hopefully, that's the idea. Okay. All right, so here is one on gold. This is a gold chart, and this is pretty, no, it's not too recent, but you can see it's back in June, so it's not too bad. But this is a 4-hour time frame. You can see it hits up and then it comes down, and it just really honors those levels. So just again, giving you some more examples of how to draw those patterns. All right, okay, so now we have another example here. This one is on a 15-minute chart, but you can see I like to put a lot of examples so you guys can really get an idea. But again, you can see the trend line here. And this is a lower time frame. And so when you're looking at it on a lower time frame, this is you can see here, this is a 15-minute time frame. So when you're looking at it on a lower time frame, it's really good to look at it in the context of the higher time frame. And I don't know if a lot of people are familiar with that, but you can look at charts on a daily time frame, you can look at them on a 15-minute time frame. And really, a candlestick just contains a price data, right? It shows all of the different price changes, and that's data. And the data is stored inside of these candles. So it's just always printing new data, new prices are printing, and it just keeps track of all of that data within a given time. So the bigger the candle, the more data you get. So a daily candle has a lot more data than a 15-minute candle. And so when you have more data, you can make better decisions. So with a larger candle of a daily time frame, you can make better decisions because you have more data and you can see longer out. You can make those decisions for a longer period of time because you have a bigger picture. And when you're looking at a daily chart, you've got an entire chart of daily candles, and those daily candles are giving you more data, so you're going to be able to see out even further. And the same thing if you want to look at an even higher time frame, you want to look at weekly charts or monthly charts. The bigger the time frame, the more you can see into the future, the more you can see into the past, the bigger the trade you can do. Okay, so that's one of the really big advantages of looking at these things, looking at patterns like this on a daily time frame or higher, because you can see data and find a lot of long-term trades, which I'm a big proponent of. Now, on the other side of that, if we look at the short-term charts, the problem when you have a lot of data, you can see out further, but it's hard to see close up. It's kind of like if we look at a magnifying glass, right? A magnifying glass or a microscope, you're zooming in. Microscopes are really cool because you look at something on your table, on your desk, and you can't really see, you can see what it is, but then you zoom up and you see all of these little things that you never would have seen before, right? There's a whole nother world. And that's in trading, right? You zoom up to a lower time frame and you see a whole nother world that you never saw before when you were looking at the big charts. So if you're looking at the big charts, you can make big long-term decisions, but short-term, it's very bad for short-term trading, really bad. So that's when you go into a lower time frame, you look at the lower time frame charts and you make your decisions for short-term trades. And what's great is when you use them together, when you get a short-term, so if we, just for as an example here, if this gold chart on a daily is pointing down, right, we know, hey, we want to try to catch this breakout to the downside. Why? Because we believe that the daily chart is saying that it's going down. So you're using the long-term time frame and the short-term time frame at the same time, finding patterns. And I've always enjoyed doing that because it gives you a greater confidence in the trade, and it's an additional confirmation point. The more confirmation points you can get on a trade, the better. All right. So here's another example right here of an actual breakout on a 15-minute time frame and how you can actually trade that. So we've got the pattern happening here. This is a short term, and you get the very nice break. You bought that, and maybe you bought it, maybe you didn't, but you get that, and boom, you got yourself a nice trade. And the way to trade this is exactly the same as trading the box method. Now, I like to put my stop below the megaphone, right? So if I put my stop in here, I'll use this to gauge it. So this entry is about 1935. So my stop loss would be around 27, right? So it's about an $8 stop. $8 on the stop loss, and the target on this again would be the same. It would be $8. So my entry here 35 right here, target would be somewhere around 40, 43, something like that. So that's how I do that. Very simple. Now, just another method here, you could obviously put your stop really tight as well. And the thing about doing that is it's a great way to increase your gains. And every time you're going to do something in trading that is going to help you and give you an edge, there's always a counter effect, right? Nothing is perfect. There's always a pro and a con, and that's just how it is. So in trading, in this example here, I was giving you the example, and I try to keep it simple when I'm teaching because I know that this works and it's easier to follow. So I gave the big example, but I give bonus things too. I gave the big example of using this for a stop loss. You got the big box, and you're going to win a lot more trades doing that, okay? But if you want to make more money on each trade, you can tighten it, put it right inside the box or below that candle. Now, the pro on this, the huge advantage is you're going to dramatically increase your winnings. The amount that you make on a trade is going to dramatically increase. Okay, so that's a really good thing for increasing your stop or tightening up your stop. Because for one, you've got like, okay, this is like instead of an $8 stop, now we're looking at a $3 stop. Okay, and if we keep our target the same, that's a big win, okay? But the drawback, because there's always some key drawbacks, and the drawback is that you're going to lose more trades because a lot of times the price will come up, come out, and then want to go right out up to the top. So the good side of it is you're going to make more money on your trade, and the bad side is that you're going to lose more trades. And so me personally, I would rather have a bigger win rate than winning more money. And the reason being is because if you win a lot of trades, it helps with confidence. And, you know, I was just trading on Monday with my friend John Melly. We're trading together. I like to trade with other people. I don't like to do it alone. I recommend that you get a trading buddy, somebody that you can run your ideas through, someone that you can help you keep your accountability. You know, if you're trading, even if it's a daily strategy where you're trading at the end of the day, it's still good to get somebody to talk to about it. But if you're doing a day trading, same thing. So I was doing some day trading and I was there with my friend John, and I just said, hey John, what do you think of this trade? And he gave me some ideas and we talk about it. It's good. I like it when people challenge my ideas, not because I want them to take me out of a trade, but because I need my ideas challenged. It's okay to have people challenge your ideas. If you think you're right, well, maybe you are, but it's good to get your ideas challenged. It's how you can sharpen yourself. So John was telling me that you cannot be a successful trader if you're not a confident trader. You have to be confident. And so for me, to keep my confidence strong, I like strategies that gives my high win rate, because mentally when I go through a big drawdown, it messes me up too much and I don't want to have to go through that. I just don't like it, so I'm not going to do it. So I like to find a really good strategy that has a high win rate, and megaphone breakouts is a great strategy with a really high win rate. So, and don't ask me what the winning percentage is, because that's impossible to know, because there's just too many patterns in the universe to figure them all out. Okay, so that's there. Okay, so also let's take a look at the sell side of this. Okay, here's another version of it. This one right here is a 15-minute chart on the sell side, and you can see the same thing. We got a nice breakdown. We could put our stop loss right up here, but this one you would be selling, and the entry is about 19.18. So very similar here. We had an $8 target or $8 stop loss on the last one, and this one is about $8. 19.18 is the entry, 19.26 is the stop you got right here. Okay, so that is an $8 stop loss. Okay, and so if we're going for a target, we want to put our target at $8, right? Entry is about 17, so our target's somewhere down there. Okay, and you'll notice on this one that we got these the time stamps at the bottom. You're going to notice that this is the open of the market. Nothing really happened on the open. It took a little bit of time, and then finally mid-morning is when it broke, and then when it broke, it went right back down to the target. But again, this is about a 1-to-1 risk to reward ratio. And when I say 1-to-1, or when you hear someone else say 1-to-1 risk to reward ratio, what we mean by that is you're risking $10 to make $10, or you're risking $100 to make $100. But this is a 1-to-1 risk to reward ratio, risking $1 to make $1. Okay, and I like to keep it simple, because if you do a 1-to-1, you know that if anything above 50%, you're going to make money. Now, just talking about these ratios, if you are looking at this on a 15-minute time frame, but you're looking at a daily chart as well, and you're noticing that on a daily chart, the target is all the way, gold this week crossed below 1900, went to like 1880, right? Maybe even lower. And so if we know on a daily time frame and you have the patience, you could keep an $8 stop loss, but then you could drive this thing all the way down to 1880, and you could make, $24. Okay, you could make $24 on the trade. Risk 8 and make 24. And if you do that, that would be a 3-to-1. And what that means is you're risking $10 and you're making 30, right? A 3-to-1 is you're making 30 and you're risking 10. Okay, so if we talk a little bit about winning percentages, you know that with the winning percentage of 50%, you're going to make money on 1-to-1. But if you're at a 3-to-1, you can win 30% of your trades, a much higher loss rate, and still make money at 30%. Now, again, that's a great thing. You don't have to be right as much, but the problem is you're not winning a lot, and so that's hard to maintain the confidence with that 3-to-1. You've got to really understand and have a big picture and keep looking at your charts long term, and just being confident in it, right? And so we've got this little, let me get my I've got this chart that I like to look at that helps me with my risk to reward here. And so if I'm risking $100 per trade and I know that I'm at a 3-to-1, you can see here 3-to-1, it's 30%. And if I take 10,000 trades, which is a lot of trades, I would make $200,000 at a 30% win rate. A 27% win rate is 80,000 at a 3-to-1 risk to reward ratio. So you can play around, or I like to play around with this a little bit to help me know what risk to reward ratio to go for. But I personally love to go for a 1-to-1, because I know that right here at 55%, I can really do a lot of good things and not have to worry about, I just don't have to worry about going through a big losing streak, right? So even if you do a 0.5 and if you do a 0.5 and you win 70%, 68%, you still can make really good money. And so a 0.5 means that I lose $10 to make 5, but because it's like a really quick win, you have a high win rate and your winning percentage can go way up. There's always a trade-off between winning percentage and risk to reward ratio. The higher your risk to reward ratio is, the higher the lower your win rate's going to be. And so I if you're interested at all in the pattern, I'm gonna let you guys read about it because we just wrote a really in-depth training on this on my website that kind of gives even more details than what I gave. So I can go ahead and throw that out there in the chat. And that's gonna be it. That's my website, tradingstrategyguides.com. And thanks a lot for letting me be here, Rob. I think I'm out of time, but appreciate it.
Okay, so you are right on time. And I have to say that I don't know what it is. I'm giving everyone extra credit today. Everything you said today really resonated with me. And I like the way that you shortened your stop there kind of to the inner trend to improve the risk reward. That was beautiful. But thank you for being here. Not only great stuff, not only is your story incredibly inspirational, father of 9. I'm trying to find somebody to have a second one with myself, but military veteran, thank you for your service. Blue collar worker, perseveres and succeeds. That really is the illustration of the American dream. But your secrets on how to make money from the stock market was a great presentation. Thank you for making such a generous offer to our audience. Just incredible. Ladies and gentlemen,
Rob.
Thank you. Ladies and gentlemen, if you want to consistently find accurate entries, even in this crazy market environment, and have the ability to consistently make around even $10,000 a month trading, you can contact Mr. Stubbs of Trading Strategy Guides. We've also placed his link, I think I spelled it correctly, in the chat box. Case, I want to thank you for being here again. Say I hope you return and wish you a great weekend, sir.
Thank you. Same to you as well.
Very welcome. Well, ladies and gentlemen, I mentioned at the top of the show that we had a great lineup today, and our next presenter is also no exception. He's been involved in the market since 1997 and is the founder of Technical Traders. He is an internationally recognized technical analyst and trader who is the author of the book, Technical Trading Mastery, 7 Steps to Win with Logic. His mission is to help clients boost their trading performance while reducing market exposure and portfolio volatility. Ladies and gentlemen, here to present the active trader and passive investor's reality check is Mr. Chris Vermeulen, the founder of TechnicalTraders.com. Welcome to Traders Corner, Chris.
Hey, Rob, thanks for having me. Can you hear me all right?
Loud and clear, and I can see your splash screen.
Perfect. All right. Sounds great. All right. Well, welcome, everybody. Thanks for sticking around. And today I'm going to share a real reality check for both active traders and even passive investors who have who really don't do much with their money other than let the financial advisor take care of it. And I'm going to show you some angles here that are going to show you kind of reasons why active traders almost always lose money and never really become successful. There's a reason why there's a million trading newsletters. It's a rotating door. Traders, we're gonna get into the details there. I'm also going to talk about why passive investors are really never able to retire really early, and why most of them run out of money once they do get retired. And I'm going to show you some of the markets, the reality, these silent killers that are holding both active traders and passive investors back. So this is completely changing gears from what Casey said. Casey, as you know, he's talking about the having confidence, which is crucial, and he keeps touching on being confident and having controlling your emotions, because it really is the #1 problem. Everything he's saying is very important and true, and I'm going to carry things forward, and you're going to see how it kind of builds on that and why you want to believe in a system, have that confidence, and protect your capital like what he does with his more active trading style. So my way here is a little different. I believe it's actually an industry-breaking investment method that the financial industry really doesn't want you to know, because it actually makes them look pretty bad when it comes to how the financial advisor kind of industry works and what they have, really brainwashed everybody to think and do with their hard-earned capital. So I'm going to touch on these. Again, it doesn't matter if you're an active trader or a passive investor. I think you're going to get a lot out of this. Most of us, actively trade, and a lot of us also have some passive investments, or if you do, you might not want to be that passive, as you're going to see going forward here. So Let me just get through this disclaimer, get it out of the way. So access to this presentation is for educational and informational purposes only. We provide educational services that are meant to teach you the risks and reward of trading and are not implying or guaranteeing any profit. Past results are not necessarily indicative of future performance. Trading securities and options involves risks, so do not trade with money that you cannot afford to lose, and consult a licensed broker or financial advisor before placing any trade to ensure it's suitable for your personal circumstances. Now, we have to say all this, but I think the reality is if you've had a financial advisor and you rode down the 2022 bear market, if your advisor has you holding bonds in a rapidly rising interest rate environment, if you held through the 2008 financial crisis or the tech bubble in 2000s, you do not have a financial advisor actually protecting your capital. They don't know what's best for you unless, going through a roller coaster ride, the stress that comes with it is good for you. And that's the whole reason why I got into trading, because I don't believe in what the financial industry does. I don't believe they should be risking our hard-earned money, doing pretty much nothing with it and letting us suffer while they consistently really take some of our money. That's kind of from the passive investor standpoint. So what I want to touch on today are two high-risk strategies. And maybe you guys can figure this out. The reality is there are two high-risk strategies that you might do one, you might even do both. And they are active trading and the buy and hold strategy. Now, these are both extreme strategies. And as you know, if you do any activity to the extreme, if you're very active or you do absolutely nothing, they can work out very well in your favor, but they can also backfire really badly. And there are extensive studies in North America, Brazil, Taiwan, you name it. They've proven 97% of all active individual traders who trade for 300 days or more lose money. And in most cases, this was during a bull market phase. So there's a huge problem with active trading, the mindset that people have. Emotions play the #1 role, which we'll touch on because it drives most people's decisions, and most people have no idea how to properly manage positions or risk. And that's from the active trader standpoint. From the diversified portfolio, the buy and hold investor, you are guaranteed to have a high risk strategy. The older you get, the more risky the buy and hold actually becomes. And you have no protection from bear markets. You're going to suffer multiple years with no gains. You're going to have huge drawdowns, losses in your account, and you're guaranteed to have poor industry average returns, 4 to 8% annual returns over the long run, which really isn't very good in the grand scheme of things. So I'm going to show you something, a third way, a different way, and it's not one of these two extremes. And that's what I want to cover today. So we're going to go through these things. And at the end of this presentation, if you want, I'm going to go through this infographic here. You'll be able to download it at the end of the presentation. Plus, you can also opt into my Asset Revesting quarterly newsletter if you want to stay on top of these things that I'm going to show you here today. So a little bit about myself real quickly here. I am located in Canada, Collingwood, which is about an hour and a half north of Toronto. I'm married, I have 2 kids. I'm an entrepreneur, I'm a technical analyst, and I've been involved in the market since 1997. And I've authored 2 books, Asset Revesting and Technical Trading Mastery. Now, I grew up with entrepreneur family. So my sister and I would help my parents run their businesses, stuff envelopes, go to events, put flyers indoors, you name it. So I've always had the entrepreneur bug, and I've always wanted to do my own thing and do what I want versus being forced or told what to do. And I naturally gravitated into the stock market at a very young age. And fortunately enough, at the age of 27, I was able to retire from the financial markets, or semi-retire. I love what I do, so I continue to do it, but semi-retired, built my dream home on the water. We've got a dock, boats, pool, cabana. We travel. The ski club's 4 minutes behind our house. My daughter has a horse and competes. And I got Mirabelle, my wife, Kristen, and Ben. And life is pretty good. And it's all because of the financial markets. And it comes down to managing your emotions, your risk, your money. And it's completely opposite than what, it's not about looking for big chart patterns with huge moves. It's quite the contrary. It's the exact opposite, as you're going to see. But the reality is, once you become successful, which we all want to be, and it's why most of us are here, to learn how to make more money and generate more cash flow, so we can help more people. I mean, if you do well, your family's going to do well, your friends and family. You've got the time and money to help those individuals. And we do a lot of charity with technical traders. Even our subscribers do a lot of fundraising with us. My family does. I organize several fundraising events every year. And it's all about giving back and trying to help people. It's the reason why I'm here today, is because I think we're heading into some very difficult times. And I do not want to see what could unfold and the devastation that it could lead to most investors in the markets if they're not prepared. So I want to try and help people not only avoid chaos going forward here, but to really thrive and completely change their financial standings in a very short period of time. So let's dive into problem number one. Now, managing risk in positions. This is where most people don't have any interest in this. They ignore it. They put on whatever random position size they think. They don't really manage their risk or look or figure out how much risk they're taking for their overall portfolio. And I've sold lots of different courses over the years, 25 plus years, and no one has any interest in managing risk or positions or trading as a business. It's all boring. It's not like you're just playing breakouts and trading, which is what everybody wants to do. But here's the reality. If you focus on problem number one, if you do this, all of the other stuff just falls together and all the money will start to roll in on its own. If you don't take losses or big losses, you don't have to go out and hunt for huge high risk trades and actively trade trying to make more money. You just have to have consistent growth, consistent trades, and have a high win rate and be able to just continue to hit new high watermarks. So I want to share with you 3 quick stories of why this is important, how I came about it, and how it carries forward through what I'm going to show you here today. So long story short, when I was 16 years old, before I could drive a car, my mom dropped me off at the Collingwood Airport here, and I was getting my pilot's license. And I remember my instructor, Nelson, came out and he said, "Hey, Chris, grab your stuff, hop into the plane. You're going to go do your solo today." And I remember as soon as he said that, I was like, oh my gosh, I got to go flying on my own. I remember looking at my mom and the look on her face scared me. And I was like, okay. So before I know it, I'm on the end of the runway. I'm giving it full throttle. We're barreling down the center line and I take off, and my emotions were all over the place. I was singing, I was talking to myself, I was like laughing and kind of crying. It was like a dream come true. The emotions were flying so high. I almost had no control for a brief moment there. And that was when something hit. I'm like, okay, I'm past the airport. I need to like snap out of it and do everything that is needed to be done and get back down on the ground without crashing and bursting into flames. And so that was when I put my hand on my leg. I have a checklist. If you're a pilot, there's a checklist for everything when it comes to piloting. And I worked through that checklist, turned on the final, flaps are in, or down, and before I know it, I'm taxiing off on the runway. Nelson comes over the radio. He's like, "Hey, congratulations, Chris, you're a pilot." And the feeling was unbelievable. And at that age of only 16, after talking to him and debriefing, I really realized the power of having systems, checklists, processes that work, that you believe in, that you can follow, which gives you all the confidence in the world. And what happens is most traders get into trades, or they see things moving and they have FOMO and they just have to get in them, or they can't get out of a loser because it's too big. That's the feeling I had when I was up in the plane. I had no control over my emotions until I decided to shut it off and just go to what I know works. And that is what you need to do as a trader, is have a strategy, a system in place that no matter how you think or feel and whatever news is going on, you can just be like, okay, I know I feel nervous. I know the market feels like it should do this, but my strategy says I have to do this, and you have to follow it. So that was what I learned at a very young age, was to systemize things, and you can almost do anything you want in this world. Now, the second story was my dad retired in his early 40s, but he's an entrepreneur. He got back into the game, and unfortunately, he got back into the game with the wrong group of people who literally took all their investors' money and vanished. And we went from top of the food chain with lifestyle and things like that to the very bottom where we had nothing left but our clothes and our furniture. And going from one extreme to the other was frustrating. It was embarrassing. My parents lost a lot of friends because of it, because investors were family and friends. We're in a small town. It was pretty devastating. And I remember one morning I heard my mom screaming, and then suddenly I hear footsteps running. I hear my sister start screaming. And so of course I run over, I run into my parents' room, and my dad is laying on the floor having a seizure, and we thought he was dying. I remember my sister looking back at me with the fear, and we were two deer in the headlights. My mom's trying to call 911, and it was because my dad had so much stress, lack of sleep from losing his lifestyle, his life savings and friends, all because of one bad investment. And that was when I learned, okay, no matter how good life is, if you do not protect your capital, if you don't protect your lifestyle, you can lose it all in a blink of an eye. And so that was my second lesson, is always protect your capital, number one. And then when you know it's protected, you can go looking safely for investments in trades that aren't going to break your bank if something goes wrong. So that was lesson number two. And the last one here was I was trading through college. I ended up making enough trading in my college account to pay for my college, tuition and residence and all that stuff. And then the 2001 bear market hit. And what happened there was I was trading small cap stocks with strong fundamentals. They were growing quarter after quarter, yet the share price was plummeting. And nothing more frustrating than buying companies that are growing and your account gets cut in half and then gets cut in half again. And that was when I lost almost all my trading account money, trading some of the strongest companies. And that's when it hit me. After I had lost all that money, I went back to the drawing board. Back then I searched up what is the alternative to fundamental analysis, because that's what everybody was talking about back then. And I came across technical analysis, found John Murphy, the godfather of technical analysis. And it's all about understanding price action. Just follow the charts, follow trends, identify the trend, trade with it. You don't have to pick tops, you don't have to pick bottoms. You just have to find nice, strong trends and get on board. And so that is what I do now. I could care less about other people's opinions. I don't care about the Fed, the news, economic data. It means absolutely nothing when it comes to trading, because you never know when news is coming out and you have no idea how people are going to react to it. So it is just a total crapshoot to go down that path when you can just wait for price to confirm a direction, hop on board if it has a lot of momentum behind it, and play that trade. So that is how we go about doing that. And we can do that by managing our risk through understanding the market structure, technical analysis, and position management. So this is one of the first graphics on that infographic, which is there's 4 stages to the market. Now, Stan Weinstein coined this 4-stage theory many years ago. And more or less, stage 1 is a basing formation. It is a difficult, trendless market. It's a difficult time to make money. Stage 2 is a bull market. We all love those. They can last many years. Stage 3 is a topping phase. Very difficult to trade. Stocks and sectors are all over the place. That is what the stock market is in right now. And then we have a stage 4 decline, which is highlighted green as well, because that is a financial reset. That is a bear market, and it is a strong trend. Give us a trend and we can make a lot of money. And so that is kind of how the market structure works. And if you understand this, you know what strategies to deploy, what needs to be altered, because every stage requires a different type of trading strategy. Now, this is the emotional cycle, the roller coaster ride that the average trader investor goes through. And what I want to just really point out here is if you become a technical trader, if you can cut off your emotions and focus and follow a strategy versus hunting for big trades and trading off the hip, off emotions, you can live this optimism, belief, thrill, euphoric phase twice in this cycle. As it goes up, you get to live it. As the market plummets, you also get to live it. And here we are right now in the markets in this complacency rally. We're going back up towards the previous highs we saw last year. Everybody, advisors are saying this is the start of something new. Everything's reevaluated already, which I believe we've got a long ways to go before that happens. But what's going to happen is everybody is expecting a big bull market. They're mentally prepared. They're reinvesting for another 5 or 10-year bull market. Problem is, if the market starts to break down, they're going to start to get anxiety, and they're going to be like, there's no way we're starting another bear market. I just survived, the 2022 one. And when they have anxiety, we're going to be optimistic going, oh, wow, I think we're actually starting a stage 4. This could get really, really good. And then, of course, as markets plummet, they get into denial. They cannot believe how bad their timing was, that they're in another bear market, how much they're losing. Eventually, they start to panic, and eventually they bail out of the market. And when they have all these emotions surging through them, we are in this like, okay, we're full on stage 4 decline. It is like taking candy from a baby. It is like icing on a cake. I mean, the profits we can make going down are huge, and we know the bottom will come around, but we can identify these things and play that. And most people will bail out. They get angry, they get depressed. And the reality is, just in 2008 to 2009, after the financial crisis, there was over 6,500 people committed suicide that were directly linked to falling equity prices. And that cuts really deep with me because I saw how it almost took my dad's life when he lost a huge chunk of the capital of our life savings gone, had to go bankrupt. So this is very serious what could be happening over the next 6, 8, 12 months. And if you're not prepared, really bad things can happen, not just financially, but health-wise as well. So the other thing to look at here are the cycles. There's 2 cycles in the markets. There's the stock market cycle, and there is an economic cycle. Now, the stock market cycle will always top out before the economy, and that's because investors are smart. They see earnings slowing, earnings don't reach the estimates. Investors start to move away from the stock market. Usually interest rates are going up, so they can move away from the market and still earn a good rate of return sitting safely on the sidelines. And so the stock market will start to go down. And then usually 6, 9 months later, we have 2 bad quarterly economic data, GDP numbers, and finally the world says, hey, we're in a recession. Yet the stock market has already been plummeting. It's already going to be down very sharply. And at that point, most investors are like, well, I'm down too much. I can't get out now. And eventually they hold it out, which could be a 3, 7, 12, 15-year time where you don't make any money for a long time. It is a very slippery slope. Biting the bullet, exiting out of positions gives you losses that you can write future gains against anyway. So to me, there's no point of holding losers, riding them down, and suffering something that could last a very long time. Now, what's really interesting here is the energy and the precious metals space. Energy has been rocketing higher all year. Energy stocks are leading the way as the strongest sectors. Gold is still trading up near all-time highs. These commodities are typically the last ones to hold their value just before the stock market tops out. That is a huge red flag, and everything is leaning towards the market starting a much bigger correction here in a very short period of time. So that is something to keep in your mind going forward. Now, let's touch on technical analysis and position management really quick. Now, this is from a high level. Obviously, this is a short presentation. There's not enough time to go into the nitty gritty, but I color code my charts. This is the SPY. Green means we want to own equities in a bull market. Red means we do not want to own equities. And more or less, when we get into a trade, we put in a protective stop in case we're dead wrong and the markets want to go the other way. We just want it to get us out of the trade. If we go up, we can hit targets. We can move our stops up. We can hit more targets. When the market pulls back or goes sideways, we want to step aside and move to a different asset. We don't ever short a market when it's in a bull market phase. We go to a different asset class for reasons that really sometimes you'll get a sell signal and the market wants to just keep going up. And these little false signals are actually good opportunities to close out our positions and then re-enter our full portfolio and ride it up for future for more gains on the entire account, because we'll be scaling out of trades as we move up and have more cash on the sidelines. So think of the market here as the ocean. I'm a surfer, I'm a kiteboarder, I absolutely love the water. When the tide goes up, it lifts pretty much all boats with it. When the stock market is in a bull market, it lifts pretty much all stocks with it. Now, on the flip side, 2022, the tide was going down. Stock market was in a bear market, a small bear market, and more or less it pulled almost all stocks down. Most of the time, the chart is red. Every rally was either false or a very short-lived rally and didn't produce a whole lot of return. Now, when the market's going down, we want to own a different asset. 2022 was the year of the US dollar. It screamed and rocketed higher while the stock market fell 24%. The US dollar rallied like 17% or something like that. And it's a nice low volatility play. It moves very slow, very consistent, and allows you to sidestep chaos in the markets. Now, think of the markets here. So we've got the ocean tide. Think of if you're walking down the beach, like in Florida or somewhere, you look out over the break and there's a bunch of surfers floating out there. What are they doing? They're out there waiting for a clean set of waves. And the stock market has reoccurring wave-like patterns that we can identify. As a surfer, you can see the set of waves coming. You pick the one or the asset you want to get on when you see a nice strong wave, and you can hop on, you can ride that trend. And because it's a big, strong move, you can also tell when it's starting to break, when you need to carve out, get off the wave, and wait for something new. Now, this happens in rising and falling markets. In a falling market, it's usually much more wave-like. In a rising market, it's more like swells, which is even easier to trade. But that's what we want to do. We want to sit or float out there waiting for a good opportunity that's clear and take advantage of these waves. We can play the upside for small little gains, and then we can move to another asset that as the market falls, another asset is rallying up quite substantially. So that is what we want to do. And that's what, most people get caught into all this noise. They're trying to play all these little breakouts and chop. This is where most people lose money. There can be a lot made in there, but 97% of people over the long haul will lose money. They end up giving up on newsletters and they call it quits. They go back to an advisor. I mean, I see thousands and thousands of people do this all the time simply because they don't understand the reality of the markets, how they work, and how it's not about trading more, it's about protecting capital. All right, so number two here, the problem here is letting our emotions drive to the decisions. We did a survey this summer with over 5,000 comments from both active traders and passive investors. Number one problem is FOMO, emotions driving their decisions. And what I want to talk about here is if you know your personality type, if you know who you are, how your brain ticks, then you're going to be able to control your emotions a lot better than them dragging you around the markets and being frustrated and losing money. So if you've heard of Myers-Briggs, there's a personality test out there. Myers-Briggs, there's 16 different personality types, and each one has a 4-letter digits. For example, my symbol is an INTJ. I'm known as the architect or the scientist. My personality type, I'm introverted, I'm intuitive, I'm thinking, and I'm judging. And believe it or not, the stock market is exactly what my brain functions around very well. Testing, logic, all that stuff. I love everything to do with strategies and systemizing things. I don't know if I got involved in the markets when I was 16 because I just found myself good at it, or because it was my first experience was I could make a ton of money without having to really do anything. But I am now doing, and I've been doing this for 26 years, I play the stock market, I invest my capital, and it doesn't stress me out. It is what I do. It just comes naturally to me, and I just try and help as many other people as possible try to take advantage of these markets and grow our accounts every year safely with huge outperformance. And so that's what I try to do. Now, I forgot to mention this earlier, that there was a report out by a company called the Employee Benefit Research Institute, and they talked about how they're expecting 81% of individuals to run out of money in retirement in North America. So that means downgrading your lifestyle, cutting back in your spending, which to me would be an absolute nightmare to have to go backwards when you finally retire. And when I read this, it made me go back to one of my blog posts where I wrote about this Myers-Briggs personality test, because my research shows that 13 of the 16 personality types do not bode well for financial success. Meaning, if you have one of these 13 personality types, you have an S or an F in your 4 letters there, then you are going to most likely struggle from emotions, FOMO, self-discipline, and these markets are probably absolutely frustrating and costing you a ton of money just because your brain isn't really designed to process this information and deal with it. And there's nothing wrong with that. Actually, most of those personality types are very, very good. But if you are one of those, then you need to make sure you get the proper help and trading newsletter or signals that fit with your personality type. If you're an INTJ like me, then you have what it takes to create your own strategies if you want to focus on the markets full time. If you're one of these strategies that don't bode well, then you need to follow someone's signals. But if you're second guessing signals, skipping signals, you're too lazy to put in stops and take partial profits, then you probably need a strategy that auto trades for you so you can go live your life and do other things that you're naturally good at and have fun versus struggling with the markets. So that is really important to know who you are. So you can go to 16personalities.com and you can take this quick little quiz, read all about how your brain functions and works. It's pretty amazing. All right, so let's quickly jump onto the active trader's problem. Obviously, the more you trade, the more emotions and the more FOMO you're going to have. Active traders seem to think that if they trade more, they're going to make more. I mean, some people are doing like 40 trades a day, 10,000 trades a year. To me, it sounds like an absolute nightmare. I used to day trade. I've scalped trading. I've traded all kinds of different assets and futures in different ways. And trading is a job. Active day trading, I mean, it's not to me any fun. It's a ton of work and effort. It's super emotional. You can make way more doing a lot less and taking a lot less risk. So that's a false reality that people think is trading more will make you more money. And also people always think you need to be in trades. And, you know, in a bear market, when everything is going down, do you really want to always have your money pushed into some stock or commodity or something that's going to get sucked down with the markets? No, but everybody pretty much does because they think cash, if they're in cash, they're just wasting time, they're wasting money, but really they're just setting themselves backwards. And then of course, most traders don't know how to manage positions in risk properly, and they under position size, over position size, they can't get out of a losing trade. It just compounds. It's a brutal scenario. So that's the main problem with active traders are all these things, they compound on each other, and they actually make it a nightmare. Really, over time, trading just was a bad decision for most people. We all want to be that really aggressive trader making huge gains. I get it. I was there and I do that now, but not swinging for the fences. I don't do all this aggressive stuff. You don't have to do that going forward. So problem number 3 are the passive investor silent killers. And these here are, I believe that the passive investor with an advisor or who's doing the buy and hold strategy, I believe most people have like Stockholm syndrome. They think it's the only real way to do it. You know, the advisors always say, oh, technical analysis is voodoo. You can't time the markets, all this stuff. The whole financial industry has been designed around the buy and hold, like the 60-40 or the 40-60 or the 30-70 or the all-in-one ETFs or hedged ETFs. They're all garbage. They're all a terrible way, especially if you're 45 plus, to just park your money. You're really just taking on massive risk. Your really good trades are killed by your really bad trades because you're diversified across all assets. Some will do really well, others are going to be doing bad. And that's why you get that average poor return. So, you know, the other thing a lot of investors do is they'll start adding in individual stocks that they like. Oh, I like Apple. I like all these different plays. And what you're doing is you're throwing in more diversified plays that are really volatile. And when the markets do go for a crapper and we have a huge financial reset, those little individual trades plummet in value and kill your portfolio even more than it already was holding a bunch of other investments. So that's the major problem. That's one of the major problems is Stockholm syndrome. The other major problem here is there's 2 types of drawdowns that people don't realize. Most people know about the value drawdown. This is 2022, the 60-40 portfolio. Most people took a 24+% loss, which is okay because we can always make money back. It's just money. The problem here is the time drawdown. After the 2000 tech bubble, it took 12 years for the stock market to come back, 16 years for the NASDAQ. That is a long time to be losing money, to not be making any returns. And we're going to be going on here 2 years soon for the average investor who has made no money. Their accounts aren't up making new highs, and inflation is up huge. You're just going backwards and backwards, like faster and faster, versus a strategy that only holds assets that's going up, and it can continuously just hold its value or move higher with the markets. And this is a CGS strategy, which I'm going to show you here shortly, but it's based around holding only assets going up, sitting on the sidelines when there isn't a safe play to go. So the last hidden killer or secret silent killer here is called the sequence of returns risk. And this is the quickest way people run out of money early in retirement. And what this is it's the order in which your investment returns are experienced during your withdrawal phase in the market. So when you're retired and you're withdrawing money, then this is when it kicks in. And the reality is you don't realize it until it's too late. And when it's too late, it kind of almost is too late to start making a lot of money back. In general, there's usually two people. There's a risky trader or investor, somebody with higher risk, and there's a conservative or consistent player. Here's two people here. We got Mike, who's aggressive, $1 million in his trading account or investment account, and John, same million. They both withdraw $50,000 a year. Mike is more aggressive. He averages about 8% return a year and has about 800K left. Where John only makes about 6% a year, but he has 1.189 million, which may not look like a big difference, but that is a huge difference. That's $370,000 more for being conservative. It's actually 45% more money than Mike has after 10 years. Now, most of us are retired for a lot more than 10 years. So as this time goes on, this eats into you very, very quickly. And the more years where you don't have any gains, especially after a bear market with multiple years with no gains, it just, your money just disappears very, very quickly. So that is what I want to touch on. And that brings us kind of to our solution of how we go about doing this, which is how do we become richer versus poorer in retirement? Or how do we retire 10 or 30 years sooner than somebody who just does a buy and hold or swings for the fences and really never gets ahead in trading? And that's with the strategy that I've kind of coined this term because it needs its own name, because it is not active trading and it is not passive investing. I call it asset revesting. It's what my newest book is titled. And this is about holding only assets going up in value. And we use an asset hierarchy to know which assets to move into at any given time. And for example, anyone can build their own hierarchy. I trade what I'm comfortable with, what's very liquid, which is very stable, and more or less at the top of your hierarchy, you want the most volatile. And as you move down, things should become less and less volatile. They should have no correlation to each other. Here I've got the stock indexes, long-term bonds, the US dollar, the inverse dollar, and bill, which is like a cash position just to collect monthly, actually daily interest on your money while you sit on the sidelines. So the way this worked during COVID is our stock market cycle strategy here told us, give us red bars, said get out of the market. We look at our hierarchy. TLT was still in a strong uptrend. It met all of our criteria. TLT, we hopped in, it rallied 19% in 9 days. It actually gapped above our 15% target, filling us at the high of the day, or bonds put in a peak. And then we moved to cash, collected a little bit of interest until the stock market gave us a new buy signal, and we rode it up for another huge, huge gain. And we were able to buy back into the market at a 16% discount. And the coolest part here is by the time we got out of the market, we had about a month and change that we could just focus on ourselves. And you remember COVID, it was panic stations. It was like, who knew what was going to happen? But we knew our investments were sitting in cash. We had just made more money than we ever thought we could in a short period of time. And we can focus on our family, our health, and not worry about our investments. In fact, we made a fortune this year, that year, by simply walking through the markets, following our checklist. No matter how chaotic things got, we just follow the price charts and manage those positions. So, for example, if we consider what I call the high risk strategy, this is the buy and hold 60-40. This is over the past 10 years. So this is the past 10-year results. You only average about 5.78% return. You'd still only have $1 million. You started with $1 million. You withdraw 50,000 to help subsidize retirement. You're behind the ball with inflation versus an asset revesting strategy that not only avoids holding during falling markets, but we profit from falling markets. And so you can see it can jack up the returns in a very controlled manner. And you have 3 times more wealth in retirement, more money than you probably ever thought you could have by simply being more conservative and protecting the downside and just letting the gains stack up on top of each other. And that's why I call this the consistent growth strategy, CGS, is because it's consistently just inching its way higher. If you don't have losses, we don't need to swing for huge trades. We hit a bunch of first, second base hits over and over again. We collect interest when we're sitting on the sidelines, and we just kind of keep going up and to the right. We're outperforming the NASDAQ, we outperform the SP 500, we annihilate the buy and hold portfolios, and we also do it with very little losses, very small drawdowns compared to the NASDAQ, the SP 500, and the 60-40. And we do all this trading only a couple ETFs, one ETF at a time, and we have 5 to 12 trades a year. We do just enough trades to catch the waves that come through the markets. We sit in cash for 3 to 4 months. If you accumulate it through the year, we sit in cash quite a bit and just collect interest when the markets aren't favorable and don't have a clear trend. And that is what I focus on here. And we're out of time, but concluding thoughts, I've just showed you a different way, asset revesting. I don't think there's a better time now than to protect your capital. Maybe take a hard look at how you're actively trading, if it's the right thing, or if there's you might want to embrace something. You can copy my signals. You can have my signals auto traded in your brokerage account if you just want to have that kind of done for you solution. And you can pick up my book if you want to learn more at Amazon or bookstores. And of course, here's the free bonus. I'm kind of flipping through this just because we're running out of time and I want to make sure I get through all this for you. But if you go to assetrevesting.com, it's just an opt-in page. You'll get in there. You'll get an email to download this infographic. You can read through it in greater detail. That'll put you on the quarterly newsletter report. You're going to get that next month, so you can do that. And of course, if you want to get my trades, I take all these trades with my own money. They're end of day. Again, it's a very simple, slow strategy. There's nothing like watching your account hit new all-time highs every few months, no matter what the market does. We got a killer package here for Traders Corner, which is we're giving auto trading for free. I believe it's the best way for individuals. Just get out of the way and just let a strategy run versus trying to tweak things and blow things up. We're giving you technical analysis trading course. We're giving live monthly mentoring sessions twice a month, and you get our access to our band trader, which is to trade the hottest sectors when we're in a stage 2 bull market. All this is a $7,700 value per year. If you want, you can subscribe it for the semi-annual plan for $15.99. I'll get you access to all of this stuff and makes it feasible to get in and really, have a life-changing event when it comes to how you trade, how you invest. And you can do that through the technicaltraders.com/exclusive. And you can learn about all this stuff on that page as well. It's a long page that kind of covers it in detail. So I think that's about it, Rob. I know I rushed everyone, and I apologize for flying through stuff, but I try to cover everything as quick as I can. I can't go into too much detail, but this is all about trying to protect your capital. I think there's difficult times ahead, and it doesn't matter if the market rockets higher to a new bull market, because we follow price. We'll be hot on its tail, riding it up. If it goes down, we'll be taking advantage of falling prices. There's no more stress, no more crazy stress of wondering what things are going to do, because it really doesn't matter. Whichever way the markets go, we take advantage of it, or we avoid, very chaotic, difficult times in the markets. So let's see if there's a chat here, if I can pull it up, if there's any questions, but
Questions box, not chat box, and you're right on time. Feel free to answer one or two.
sure.
I got to say, Chris, from a personal perspective, I think I'd like to refer you to one of my family members that's in fixed rate annuities right now. And your system seems to deliver better returns of them, granted with a little more risk, but you obviously don't take any kind of big losses.
Yeah, I mean, yeah, that's the nice thing about this strategy, right? It's the most liquid ETFs. We're playing the biggest assets out there, and we've got investors, trading hundreds of thousands, millions of dollars. We can be in a blink of an eye, buying, the SPY. It's such a solid strategy. I mean, it has volatility. You're still playing the markets, but I mean, it is such a low risk strategy compared to the buy and hold or active trading. Which you're really just riding, the volatility out, and it is a very big game changer. I mean, I don't believe in dumping everything into one particular strategy, but if you have like an advisor, for example, you could move like $250,000 out or $150,000 over and have this strategy run automated, and it would be like diversification in how your money's invested. And then if you're comfortable with it, you can move money over, and what you'd be paying an advisor, that 1.25%, covers the cost of our newsletter. So you can actually have another strategy that hopefully and should be much better than your advisor, and it really doesn't cost you anything extra, because what you're saving from paying the advisor is covering the cost of the newsletter. And yeah, there's the auto trading to me is huge benefit. People still can't believe when they watch a trade close or account slowly keep inching their way up. They're like, this is crazy, I'm not doing anything, and it's going up.
Can I ask you one live question before we move on?
Yeah, sure, go ahead.
Not necessarily a minimum, but what would a fair amount to fund an account with you and the auto trading be?
Yeah, I mean, in general, like the subscription, if you buy the annual subscription, it's only $2,500. You could get away with a $50,000 account, so that the subscription and you're going to gain. But as we know, it takes money to make money. So you got to cover your subscription. You still want to make some money. So, 50,000, I would say, is probably the minimum. Yeah.
No, to make it worthwhile, to be able to gain more than the cost of paying for the subscription. All right.
Exactly. Yeah.
All right. Well, with that, Chris, I'd like to say thank you. Great information. That was certainly a big reality check. And ladies and gentlemen, if you don't have time for the wild movements in the stock market that could delay or destroy your retirement, especially in the example where you have to take distribution out of it after having a losing year, that really does kill. No one wants to run out of money, and we all want to live a nice lifestyle that we envision. So Mr. Chris Vermeulen has the solution for you. You can learn by clicking more on the link in the chat box and going to www.thetechnicaltraders.com. Thanks again for joining us today, Chris. We hope you come back and see us. I'd like to wish you a great weekend, sir.
Appreciate it. Thank you, Rob, and thanks everyone for sticking around. Take care. Bye-bye.
Be well. Ladies and gentlemen, as I mentioned earlier, our staff at Traders Corner sifts through hundreds of pro traders to bring you the most credible and qualified to participate on our investor summits. And our next presenter is no exception. She has a BA in mathematics from the University of Southern California and an MS in information resource management from the Air Force Institute of Technology, and has over 23 years of experience studying the markets. She's the vice president and senior technical analyst at DecisionPoint.com, along with her father, Carl Swenlin. She launched the DecisionPoint daily blog in 2009 along her dad. She also serves as a consulting technical analyst and blog contributor at StockCharts.com. She's an active member of the CMT Association. Ladies and gentlemen, here to present It's All on the Chart is Erin Swenlin of DecisionPoint.com. Welcome back to Traders Corner, Erin.
Thank you so much. Hopefully everybody can hear me.
Loud and clear, and we can see your splash screen.
All right, we're ready to go. All right, so today I'm going to talk to everyone about how it's all on the chart. There are certain indicators that I think are very important to have on your chart, and I'm going to go through those indicators, and it honestly is not that complicated. It doesn't have to be complicated. That's really what I want to get across to the traders here in the room, is that it really doesn't take too much on a chart to give you the information that you need. You already talked about, let me see if I can get my thing there. You already talked about me, so I'm gonna just flip on through this stuff. There we go. Yes. All right. Okay. So it's all on the chart. What are we going to talk about? So we're going to talk about the components that are necessary for analysis on your chart. We're going to talk about different time frame charts, particularly when we talk about entries and exits. We are going to look at selection and emphasis. And then I'm going to talk to you specifically about how I enter and exit trades. So let's get on with it. Before I get started, I do want to talk about the difference between market index indicators and single indicators, because a lot of times people get these confused. So your stock and ETF single indicators are going to be what I'm going to talk about today, what goes on the chart. It's related to just that stock or ETF. So you're going to use them. And your examples are going to be the PMO, my price momentum oscillator, which I'll get to shortly, on balance volume. People are familiar with the MACD, RSI, et cetera. Those are all considered just single indicators. Index indicators are going to be your bigger picture, you know, the results of one indicator across all the index components. For example, percent of stocks above their 20-day EMA, the percent of them out of all those in the index. I'm not going to be talking about these so much today. I'm going to be really focusing in on stock and ETF indicators. So here are the components that I think you need to have on every chart. Obviously, we have price. The next thing is trend, and trend can be measured using moving averages. I like to use exponential moving averages because they put more weight on the data that's near term versus the data that's at the end of your data set. So I prefer an EMA, but you can use whichever one you want to determine trend, but that's one of the important tools. And of course we use, you know, rising bottoms lines and declining tops lines and those types of things. But if you want to get something that gives you signals, moving averages are the best way to do that. Then we need to have something that measures condition. Is it overbought? Is it oversold? What does the trend look like, and how does that affect the conditions? So that's another thing we want on the chart. Momentum, key, got to have momentum on the chart. Volume, I think volume is very important to know what the volume patterns are, because that does give you a sense of how, you know, what people are interested in. Are they interested in this stock? Is it getting a lot of play? That's how we can do that. And then relative strength is very important. And this is a piece that I don't think a lot of people put on their charts, but I think is really important. So basically internal strength, yes, internal strength as well. And I'll talk about each of the different things that I use to measure these specific components. So let's start off with momentum, price momentum oscillator, and trend models, okay? So this is gonna give you your trend. This is gonna give you momentum of that particular stock. So the trend model signals are derived from a daily chart, and trend model signals are simply 20, 50-day EMA crossovers, 50-day crossover of a 200-day, those golden crosses. I call a 20, 50-day EMA positive crossover a silver cross. We talk about golden crosses. At DecisionPoint, we also talk about silver crosses. So you want to know those signals in all the different time frames. And by having a 5, a 20, a 50, and a 200-day EMA on each chart, you're going to be in good shape. Now, the PMO reacts differently in each time frame, and that's one of the reasons I like it. I can put it on a weekly chart, and it's going to look different than it looks on a daily chart, monthly chart, and then a 5-minute candlestick chart, which we're going to talk about. So you want to know the momentum, direction, and the signals in all of the time frames. So relative strength index, this is where I measure condition. Is a stock overbought or oversold? It measures the speed and change of price movement. So it's really a great indicator to have, right, as most people do, at the top of your chart. It gives you a very clear picture of whether price is overbought or oversold. And what I tell people to do is think of it this way, because sometimes it's easier just to picture it in your mind. But imagine over the past 14 days, the past 2 weeks, where is price within that trading range? Where is price in that range? And that is what your RSI does. If it's at the top of the range, then that means price is trading at the top of that 14-day period. If it's at the bottom of the range, it's going to be trading at below. At the bottom, it means that it is, I'm sorry, I'm getting my train of thought. So over the past 14 days, so the bottom of the range is that price is now sitting at the bottom of that 14-day range. That's what I'm trying to get across. All right, stochastics is what I use to measure internal strength. So the speed and momentum of your price movement is what this stochastics are going to tell you. It's going to tell you what the internal strength is. It talks about momentum, but it also talks about the speed. And then what I like to look at is for bullish and bearish divergences, because then you can really see when reversals are possible. And then also, like I said, with internal strength, you want to see those stochastics numbers up near the top. And when it's internally weak, you're going to see those stochastic numbers at the bottom. Relative strength. This is, like I said, the piece that I think most people forget and don't use. And what I like to do is, a lot of people will do this, is you take the symbol, the stock, relative to the benchmark, which is the SPY. So you can look at how relatively, how well is it doing? I mean, we're looking at the benchmark. We want to be doing better than the benchmark. So we need a rising relative strength line. But one of the things that a lot of people don't do is look at what the industry group is doing relative to the SPY. You don't want to get into an industry group that's underperforming, because more than likely your stock is going to underperform. We often say that the symbol, that the stock, its price movement, 50% of why a price, where price goes on a stock is related to what sector it is and in what industry group it is. So it's really important to know that you have relative strength rising with the industry group against the S&P. And then finally, the other thing I like to do is take that stock and look at it relative to the industry group itself. That's going to tell me whether I have a stock that is a leader in the group or is a weak performer in the group, underperforming. And so this piece gives you that relative strength on the chart. On balance volume, like I said, I'm talking about volume. I like on balance volume. There's nothing wrong with other accumulation distribution lines, Chaikin, money flow. They're all different ways to measure volume. I like on balance volume mainly because it's simple and it describes those volume patterns, but it's super easy to understand. We want to look for divergences, positive and negative divergences, but there's also something we call a reverse divergence. And that is when price is not following volume the way it should. And I should have an example in here, we'll see. The calculation is pretty easy. You add today's volume at the close, you add the day's volume to the OBV line on an up day. On a down day, you subtract the day's volume from the OBV line and so that gives you a really good sense of what that volume pattern is looking like. And like I said, it's very easy to understand on balance volume. I grew up learning this from my father back when I was in high school. I was looking and learning about all of this stuff, so I have been doing this for quite a long time. So which charts to follow? Well, it really depends on what time frame you're looking at. Long-term investing, you want to look at those monthly to weekly charts. That's really important to know what the momentum is doing and what the volume patterns are on your monthly and weekly charts. Intermediate term investors, you're going to be wanting to look at weekly charts to daily charts. And notice that I did long-term to shorter term on these, because the longer term really sets the backdrop for what's going on. So it's important to look at a weekly chart if you're getting ready to invest even in the intermediate term, in the short term, which we're going to talk about right here. So short-term trading, you want to look at daily charts to minute charts. So the daily chart sets the background to your minute charts. So that's kind of what you're looking at when you're doing short-term trading. And honestly, with the market in the position that it is right now, which is very weak, you need to start considering all of your investments as short-term. Whenever we're in a bear market or when we're looking at a market with a bearish bias, you want to make sure that you are trading in the time frame that matches. Day traders, you're going to be pretty much looking at minute charts. I don't do day trading, but the way I do entries and exits on my 5-minute candlestick chart, you can use that for day trading. And then we time and entries and exits, as I said, with my minute charts. So entries and exits, let's talk a little bit about those. I'm showing you all of my slides first, and then we're going to go look at charts. So you're getting your background, and then we'll show examples that'll make it easier to understand. And I am going kind of fast because I like to look at charts versus slides. All right, so entries and exits, we're going to use those same indicators that we used on our daily chart, with the exception of a few. But your same indicators, meaning your price momentum oscillator, your on-balance volume, and momentum, the price momentum oscillator. All right, so, and the RSI. The same thresholds apply on these 5-minute candlestick charts. So you're looking at the same stuff on a minute chart. It doesn't matter if it's a daily, weekly, monthly, it's the same thresholds that you want to see. Entries, I use the 5-minute candlesticks, and exits, I'll use 5, 15, and 30-minute candlesticks. But really, you can use any of these minute charts to determine your entries and exits. I just prefer the 5-minute chart because it's short-term enough to really give me a sense of what's happening to that stock that particular day. All right. So selection and emphasis. I'm not going to go into too much about how to select stocks. That's really not what I was going to talk about today, but just in a general sense, once you know that these indicators are the important indicators to use, you can scan at stockcharts.com. You can use their scan engine and use those chart components to scan the universe of stocks to find the ones that are meeting those criteria that I'm going to be discussing. So you want a momentum trade, you want middle of the road stocks, you can find momentum sleepers. A lot of these I have scheduled scans for that run at the end of every day. I do a letter called DecisionPoint Diamonds, and in Diamonds I do the selections for you. I run my scans and I pick 3 stocks, well 10 per week. We get 7 stocks and 3 ETFs per week. And I select them using the scans that use all of these components that are on all the charts that I have. You can also use scans with momentum and RSI and stochastics for bottom fishing. You can do the same thing for shorts. I have a scan that does just shorts. So when the market starts to turn like it is now in DecisionPoint Diamonds, I'll start to look at shorting positions, not just longs. So now that I've gone through all those, let's go ahead and look at some charts. If I can figure out how to change my screen. Here we go. Let's see. I don't want that. It's saying main screen, but it's not giving me an opportunity to go to, let's see if I take this out this way. No. I'm having trouble changing to my other thing.
In the control box, the first arrow, the right arrow that says show screen, there's a little pull down under it. And in a worst case scenario, move the window to the screen that's being shown.
Okay, I'll try that because it's not showing, it's giving me the PowerPoint, but let's go to main screen. Let's go ahead and tell me, can you see my chart?
Yes, ma'am.
Oh, good. Okay. Unfortunately, you can see everything else on the side, but that's just what's going to happen here. Let me see if I can just make this bigger here and get that out of the way.
We got the XLE in the background, and I can't tell the chart of what, but you got 4 or 5 oscillating indicators on the bottom.
Yes. Okay. So this is a chart of Ford Motor Company. And yeah, it is kind of hard to see. I apologize. This is about the best I can do for my screen here. But here are the various components that I have on the chart. So here's your RSI, that is on the top. This again is going to give you your information on whether the stock is overbought, where it's up here, or oversold, where it's down here. You can see how it gets shaded when it's overbought and oversold. The next one is price, obviously. And then here are the exponential moving averages that I like to use. I like to use a 5-day, a 20-day, which is green, the 50-day EMA, which is in purple, and in blue is the 200-day EMA. And what we do is we look for these crossovers, and that gives me a sense of what the bias is on the chart, what the condition is, what the trend is. So you get a golden cross, that gives you a bullish bias in the long term. If you get a 20 and 50-day positive crossover, which I call a silver cross, then you get a bullish bias in the intermediate term. The 5-day EMA, when it crosses above the 20, this is going to give you a short-term bullish bias. Now, when we go down through it, like we have here, now we've switched into a bearish bias in the short term. So we know at this point, we probably don't want to be in this stock anymore. And of course, that does give you a pretty good sense. Now, I will say EMAs, most people will use them when it goes above or below an EMA. There's nothing wrong with doing that. But one thing you do need to keep in mind when you're doing trend models like I do that are based on EMA crossovers is that that will often lag. You're not going to necessarily get the information right away. That's why we need all these other indicators on the chart. The next indicator window is the price momentum oscillator. This is very, very similar. It looks almost identical to the PPO, the price percent oscillator, which is a part, it's a way to normalize the MACD. So if you're going to use a momentum indicator, I would say PMO #1, of course, because it's mine. PPO would be the next best thing. I'm not a fan of the MACD itself, just because it isn't normalized, and so you can't use it over a longer term period. It just starts to get to where you can't see the differences in momentum, but you can always see that with the PMO and the PPO. So positive crossovers are kind of obvious. That's when you want to get into a stock. But really what I'm looking for usually is just the turn on that PMO. I just want to see that momentum just start to get positive. Now we can see that even with positive momentum here on Ford, it did make a move, but it's kind of started to consolidate below these key moving averages. So that tells you it's probably not a good time to get in. You did have a 5-20-day EMA crossover, which was a good thing, but it occurred beneath both the 50 and the 200-day EMA. So it's kind of a soft bullish signal, if you will. So there's your price momentum oscillator. Momentum is still rising slightly here. Currently, we have a nice big bullish engulfing candlestick for Ford. Considering all of the problems with the strikes, I think it's doing pretty well, to be honest. On balance volume, this is your next window right here. And like I said, pretty easy. You take the volume of the day, add it to the line, and then if it's an up day, and if it's a down day, you subtract that volume from the OBV line. So right now you can see the OBV has been very flat and in some ways trending a little bit lower here, but price has been trending higher. That's a negative divergence. So that tells you, okay, maybe the momentum's going well, maybe the RSI is positive here, but there's a problem with volume patterns. Stochastics is the next thing, and this is where you measure internal strength or weakness. It is internally strong if it's above 80. It is internally weak when it is below 20. Now, a lot of people think of it as an overbought, oversold indicator. I don't think of it that way at all. Certainly you could say, oh, this is overbought and this is oversold because it's top, bottom of the signals here. But really what you're looking for is stochastics to stay above 80. You want it to be quote unquote overbought, if you will. This is why I don't look at it as an overbought, oversold indicator. You want to see it above 80. That means there's internal price strength, internal strength. And sure enough, that's exactly what we were seeing through this period of time. When it gets internally weak, that's when price is going down. So you want internal strength on here. And the lovely thing about stochastics is they really do tend to be a little bit more forward. Unlike a lagging indicator, I really like stochastics. They tend to be very sensitive, but they are also really good at catching reversals. Now here is where the relative strength comes in. This is the industry group relative to the S&P. And you can see right now, internal relative strength for the group against the S&P is moving lower. So that kind of would take me out of the autos, just to that group. I really wouldn't be that interested in this group in the shorter term because it is starting to lose relative strength to the S&P. But there's also looking at the symbol against the SPY. Well, the symbol, Ford is actually doing pretty good in comparison to the S&P. So, well, that's good news. I could still consider this stock, but this is the other piece that you really want to consider, and that is the symbol to its industry group. And like I said, nobody really does this. I know a few people who do, but not a lot. And I think this is incredible insight when you're getting ready to pick a stock. You want to see that internal strength rising against the group. It's rising, it's not really particularly great, but it's enough that it's helping it outperform the S&P, even though the group is struggling right now. So that's why it's really important to find one that's showing leadership within the group it's in. So Ford, not looking that great right now in a consolidation phase. RSI is positive and PMO is rising, but based on these EMAs, probably not something I'd want to get involved in. Now, if you get the breakout above those EMAs, that would change things. Stochastics is also moving down. Let's look at Tesla just for an example, because it's also in the auto space. Now, Tesla is a little different here when we go down to relative strength. Tesla is underperforming its group, and consequently, it's underperforming the S&P. So between Ford and Tesla, if we're going to go this or that, I'd have to say that I would be going more toward Ford, simply because Ford is at least somewhat outperforming its group, whereas Tesla is not doing that. But we do see stochastics have turned up, so that gives us a hint that maybe internal strength might be coming back in, but we still don't have positive momentum, and we still have an RSI that is in negative territory, below that net neutral 50 level. So that tells you that there's price weakness still in Tesla stock. So that would be a problem. So now let's talk about entries and exits. Let's find another stock. Let's see. This is one that was a recent diamond pick in my newsletter. And here's why I picked it. So first of all, at the time, right now we're on the overbought side, but at the time we weren't quite overbought. We were seeing a nice rally out of this declining trend. The PMO had turned up, and now we have a positive crossover. We have on balance volume. Look at the volume that's coming in. Now you could look at the volume bars and have a sense of this, but it wouldn't give you a sense of a breakout on volume. You're getting a breakout on volume. You're also getting a breakout on price, so that's a good confirmation. Stochastics are above 80, so we have internal strength going on for OII. And then you can see relative strength really looking good. The group itself is doing very well. The oil equipment and services, not a surprise. Energy seems to be one of the bright spots in a market that's really struggling right now. You can see that the stock is doing well against the S&P, and in particular, it's doing well against the group. So I know I have a leader when I picked this stock. And so this sets me up to have hopefully a stock that's going to do well for me and continue higher. We didn't have the breakout at the time, I don't believe, on this one. We did not, but we've since gotten the breakout since I picked it. Now, if we want a stock, now it's time to talk entries and exits. So I'm going to go to my 5-minute chart. All right, so this is a 5-minute candlestick for OII. I'll keep saying the symbol just because I know it's so small, it's hard to read here. I got this new brilliant, lovely wide screen, as you can tell by based on all of the screen you can see, but it really makes sharing screens on these webinars difficult for sure. All right, so right now, OII is not having a good day, so it's below its open. But let's say this is an opportunity, right? We're getting this pullback. This might be a good opportunity to get in. So how do we determine when to get in? Well, we have the RSI, we have the price momentum oscillator, the 5-minute PMO, and we have the 5-minute on balance volume list. So we can use all 3 of these components to help us find the best entry. So on an entry, what we're looking for is a PMO crossover and a positive RSI. That would be a conservative entry. So the conservative entry would have come in right about here, and that would have meant purchasing right around 26.75. So that would be a pretty good entry considering that right now it's at 26.84. So here you go as a day trader. You can use this system to enter and exit, as I said, expertly in and out of these stocks using just these indicators right here. Now, the other thing that clued us in that this was a good buy point was that volume was starting to pick up as well. So that's a good sign, and you've got that positive RSI. So now the question is, well, when do I sell? I'm a day trader, I'm a regular trader, I'm ready to get rid of a stock. Go to your 5-minute candlestick. You can just hit the sell button, but go to the 5-minute candle if you have time, because you can get yourself a much better exit. You can get yourself a much better entry by looking at these 5-minute candlestick charts. And if anybody, by the way, is interested, if you're a stock chart subscriber and you want to get my chart styles, I am more than happy to send you my chart styles so that you can immediately hit the ground running and start using my charts to look for your stocks and symbols, and also help yourself with entries and exits. But I digress. The exit points, when I come to a chart and I'm ready to sell a stock, I just need any excuse. So for me, I only need to see the momentum turning downward. If momentum shifts lower, I don't want the stock anymore, and that's usually a good exit. And you can see over here, when we got this turn, that would have gotten us out over here versus waiting for the crossover, which would have gotten us out down here. So just waiting for that PMO to just turn over, that's going to get you a much better exit than if you just, like I said, you might happen to get lucky and hit the sell button at just the right time. But you know, if you came in on this trading day and you were like, I'm ready to sell, but it was the morning and you just hit sell, you would have missed out on all of this rise. And you could have waited until you got a PMO that was starting to turn down. So that's why if you have time, most of you do, you're here, you want to know how to trade. This is really an easy way to do that. And it's all on the chart. The RSI gives you that overbought, oversold. You've got momentum. I even have some EMAs in here, but admittedly, I don't really use the EMAs. All right, so that is how you do your entries and exits. Now, I have saved a ton of time here because I wanted to give you guys an opportunity to give me some symbol requests. And if I don't get symbol requests, I'll just start throwing up some symbols here for you to look at. But if you're interested in symbols to look at, go ahead and just put it in the question box, and I will be keeping my eyes peeled over there to see what symbols we can call up. But in the meantime, let's go ahead and call up Let's look at GSG. This was a runner-up yesterday for my diamond subscribers. I think this was a pick. Yes, this was a pick yesterday. So on Wednesdays, I do ETF day. And so I had 3 picks that were ETFs. So this was one of them. And commodities are obviously doing pretty well. Part of the reason is crude oil is in that category. And we know that inflation, we've got higher prices on a lot of everything. So this is not a bad place to be anyway. But when we looked at the chart, when I looked at it yesterday, there were a lot of things going right on it. They're not going right now. I can tell you that by looking at this PMO. I'm looking down at it now. I'm like, things went south in a day, but that's kind of the way this market's been treating us. Flag formation, chart patterns are really helpful. I have a PowerPoint that I've done on chart patterns, which I'll probably bring back here to Traders Corner because I know a lot of people are interested in how to read a chart pattern. But chart patterns, you add those to these indicators and things get really good. So we had the flag pattern, we had the breakout, a gap up. Currently, we're not having a good day, but we had just seen the momentum turning upward yesterday. We had a positive RSI. We still do. We see that on balance volume, we have rising bottoms on price. So that's confirming the uptrend. Stochastics had turned up above net neutral 50. So that's also a positive. And look at relative strength, really doing well. Now, we don't have an industry group to compare on this one, but that's okay. I'm still not seeing any symbol requests in the question box. So come on, guys, let's get it going. All right, so relative strength looking pretty good as well for GSG. So now we want to go and let's say, okay, well, we're getting a dip today. Maybe this is a good time to.
Hey, Erin.
Yes.
Scroll down. You've got quite a few of them.
Oh my goodness, look at that. Oh,
Run your mouse wheel.
I was at the top. Ooh, all right. Look at that. Okay, excellent. Oh, I can't wait now. Let's go right to it. I'm going to look at one of those now. We'll do that. Let's see, United Airlines. That sounds interesting. I haven't looked at this chart in a very long time. All right, pretty ugly, I would have to say. And I know probably if you're looking at this as a long, I'm guessing it's because it's hitting this area of pretty strong support. But there's not a lot going for it on this chart. You've got oversold, which is okay. RSI is oversold, but that also means that price is really, really weak. We have momentum is still moving lower. It is oversold, so this could be a watch list material because maybe if we can get that RSI moving and get the momentum shifting upward off this level of support, I think that would be great. But right now we don't. Look at the OBV. It is completely confirming this downtrend. We're not seeing any action on the OBV to help us think that this is a good trade. Stochastics are below 20. That means, now remember, it's not an overbought, oversold indicator. Stochastics being below 20 means it is extremely internally weak right now. And look at the relative strength. This group is really struggling. And you can see that this stock is really struggling against the S&P. Right now, with the market weak, we need something that is definitely outperforming the market. We really can't afford to go with somebody that is even performing in line. Like right here, it's almost performing in line with the market, but that's not good when we have a bearish bias in the market. Not a good thing. We really want to see that rising. You can see that the relative strength of United Airlines is pretty steady against the group. So it's not really a leader in the group, but it's also not an underperformer within the group. But the group is really suffering. So that would keep me out of this. So let's just say it's time to sell because this one, or you're looking to short it maybe. So let's go to that 5-minute candle. Here is your sell point. That was your last sell point, would have gotten you in out right here at the top. Your last buy point was back here, and that would have gotten you in here near the bottom. So again, this is a really excellent way to consider, ways to day trade. Now, if we were looking at this for a short, I'd have to say this is probably not a bad time to get in because we had that PMO for a second time top beneath its signal line. So the price is extremely weak right now. And I would expect that we're going to see much lower prices for United Airlines. All right, let's see what else. CLS, I'm not really sure about that one. And I do want to look at XHB. All right, now this is more like it. This is what I like to see on the chart. Now, obviously, it's having a huge day, and that's helpful, certainly helping the indicators. It's pushing the RSI almost to overbought territory, but it's not there yet. And you can see if it were overbought, I wouldn't be overly worried because look at how long it managed to hold overbought conditions with very few exceptions. This stock can stay overbought, so you're okay. If it gets overbought, we're not in a world of hurt. The PMO is now turning up. That's good. Stochastics moving upward. This is a little bit of an issue for me. The unbalanced volume line is decreasing, but that's more so in line with what was going on before. I'd be more interested in seeing what the OBV line looks like at the end of the day. And it looks like it will be moving upward. So that's going to be, so it shouldn't be too bad, but that declining trend is a little bit concerning. But look at the relative strength here. So the group itself is starting to outperform. This stock in particular has been an excellent, excuse me, I don't have my water here. This stock has been an excellent performer against the S&P. And then you can see that the symbol itself, it has been an excellent performer against the S&P. So everything on this chart is lined up the way I like to see it, with the exception of the OBV. And I'll be honest, the OBV is kind of my last indicator of choice. So I want to know what's going on with volume, but I won't let the OBV keep me out of a position.
Erin?
Yes.
As the host, I reserve the right to make one. Would you do the SPY for us?
Oh, I will definitely do the SPY for you. Okay, one last look here at the 5-minute candlestick. Since this looks good, where will we want to enter? Well, the last buy point occurred back here. RSI was positive, had the PMO crossover. So that was an entry right about 24.12. So that would be our optimum buy point if we could get it back down there. But the PMO is in the process of rising. It looks like it's, oh my gosh, this is terrible. I'm so sorry. Okay. It looks like the PMO has bottomed above the signal line. So this is a pretty good sign that we're not going to see that PMO turn lower. This is probably going to be the best buy point that we have right now. All right, the SPY. Now I have a better chart I'm going to show you of the SPY, but we'll start here. Because if we're here, we might as well go ahead and just do it all. All right, so our relative strength obviously is not going to be any help because the SPY relative to the SPY, well, it's exactly 1. All right, so let's see what's going on. Okay, RSI negative, which is a problem. PMO is in decline, but it is oversold. RSI is kind of oversold. Stochastics are turning up. This is one thing that has been giving me a little bit of hope here that we're going to see this rally not catch hold necessarily, but have it last more than a day or two. I'm thinking that we might be able to see this rally get us into next week. And stochastics are one of the main reasons I'm looking at that. But overall, intermediate term, there are a lot of problems, and the PMO falling and the RSI being negative really point that out. Notice also our moving averages. We had a dark cross of the 20 and 50-day EMAs. So remember, a positive crossover of the 20 and 50, a silver cross, not a golden cross, silver cross. But if you get the negative crossover, it's not a death cross like it is for the 50 and 200 day. It is a dark cross, is the nomenclature we have come up with. So big double top here on the SPY. I'm not really liking what's going on, but I'm going to show you. It's going to be an eye test. I'm going to warn you that right now. Is my bias assessment chart. So this, and I apologize again, it's really small. It's about the best I can do. Let's see, I can make it a little bit bigger. All right, so what I'm doing here is I'm looking at the percent of stocks above their 20-day EMA, their 50-day, and their 200-day EMAs. And you can see participation is extremely weak. This is going to be really hard for a rally to catch hold when you have participation this low. What we do is we take these numbers and we take those crossovers, and we came up with a golden cross index and a silver cross index. These indicators are fabulous, and I have another presentation that I've done on these indicators alone, so I won't talk about it too much. And be sure you sign up for my free email list. If you go to DecisionPoint.com, that way you'll get to know when I do some of these presentations. And I also have a little bit of an announcement at the end that I'm going to talk about. And we're almost getting there, aren't we? Okay, so the SPY right now, the Golden Cross Index measures how many stocks within the S&P have a Golden Cross or a 50-day EMA above the 200-day EMA. So we're looking across the S&P and how many stocks actually have that configuration. 56.6% and losing. So we're starting to lose that bullish bias in the long term on a lot of these charts. We're already at a bearish bias when we had that negative crossover back here. That was already a problem. The Silver Cross Index, how many stocks have a 20-day EMA above a 50-day EMA? Remember, that gives you a bullish bias in the intermediate term. Right now, only 31%, so less than a third. That means that 2/3 of the index have bearish biases in the intermediate term. Again, this is going to make it really hard for us to see the market make a meaningful rally. At this point, we've got so extended to the downside, it was kind of inevitable that we would see a little something. And based on where price is now, it makes sense that we would get this rally coming off of that 200-day moving average. So there you have it. There you have the SPY. And if we wanted to go in and look at the SPY, if you really, if you're interested in entering it or you're interested in shorting it, well, right now we're in an entry for a short position because that PMO did top. So this would have been an exit for you right in here. The last entry was back here on this bar. So this one didn't turn out to be a great day trade, but it certainly did get you in at a decent place, and it definitely got you out before this big bar right here. So that is your 5-minute chart for the SPY. So let's go ahead and look at, we've been looking at all these ETFs. I'll have to go and look at a different thing after this. Home builders.
All right, Erin, I'll let you do one more.
Oh, I only get one more, then let me pick a stock. I'll just tell everybody really quick on home builders. I've been in a short position for a while, but I have to say I am looking a little bit more anxious about that short because things are starting to improve on the chart. But again, with all of these, with the rallies we're seeing, I would be very, very careful. All right, let's go ahead and look at NVIDIA. All right, so NVIDIA is starting to make a move to the upside. This is probably part of the reason we're seeing a little bit of action to the upside in the market itself. So NVIDIA, here's just my first blush at NVIDIA. Yes, things are improving on this chart, but there are a couple things that bother me right out of the gate. Number one is this reverse flag. That's not a good sign. It means that you're going to get another leg down. So that's a problem. We have a dark cross of the 20 and 50-day EMAs. That's not a good sign. That has put NVIDIA into a bearish bias in the intermediate term. So there are a lot of things going against NVIDIA right now. However, yes, we're seeing some action here on the RSI. The PMO is trying to turn itself back up. I think this is really early on the move here. Stochastics, like I said, these stochastics are great. They really do give you that warning early on when there's something going on with the stock. And something's going on for sure, and it is to the upside. But my sense is with this dark cross, with this reverse flag in play, that this rally is going to be short-lived. And that's how I feel about the market overall. Looking at relative strength, you could see that semiconductors are starting to show some relative strength. So that's a good sign. And NVIDIA is starting to show a little bit of relative strength toward the market. But notice it's really not the best semiconductor out there. There are better ones, there are better choices, because you can see that the relative strength line is kind of moving downward a little bit. It's trying to move up right now, but overall, we're not seeing what we saw back here, which was a nice rising trend. We're not getting that right now on NVIDIA, so you might want to look at just a few other semiconductor charts with these particular relative strength indicators. I think that you would serve yourself well. And again, if you want this chart style, just go to DecisionPoint.com. You can send me, go ahead and sign up for the free email list. But if you want to send me a direct message at Erin at DecisionPoint.com, I will send you these chart styles that you can use on stockcharts.com, which I think is the best charting platform out there. If you haven't tried it, you really should. Okay.
All right, Erin, I think that's a good place to kind of interrupt you.
Okay.
I want to thank you for being here. I'd like to ask that any further questions do get directed to Erin at DecisionPoint.com. If you'd like to put your offer screen up, I'll give you another minute while I read your outro.
All right, I will get that exactly right up right now. Oh, let's get to this. Got to make it a slideshow again.
Got to find the last one.
Yeah, there we go. Okay. All right, so sign up for my free newsletter. I don't actually send the letter out every week or anything. I'm not going to bombard you with mail. It doesn't work that way. Not with me. I don't have time to send you stuff all the time. It's me and my dad. We run this company, so that's all it. So we don't send out a whole lot of stuff, but when we do, it's important. You'll also get notified when we do our free articles on stockcharts.com. But I do a free live trading room on Mondays, and you sign up for the free newsletter. I will get you the information. Also, you can sign up for the free trading room right off of our homepage. You'll see a little ad for it. Just click there and you can come in every week on Mondays for free. And I will do kind of what I just did at the end, where we look at stocks that you request and we determine what they look like going forward and how to enter and exit them. So you get really used to using that entry and exit tool of the 5-minute candlestick chart. And my offer today is a free 2-week trial of DecisionPoint Alert and DecisionPoint Diamonds. So I didn't really go too heavy into the marketing. DecisionPoint Alert is our cornerstone of the publications. This gives you your overall market outlook. If you want to know what's going on with the SPY and that bias chart I showed you, you're going to learn all about what's going on in the market in general, but we also cover the dollar, gold, crude oil, bonds. I'm actually covering yields now, and I'm also covering Bitcoin in the DP Alert. So that's where you're going to get your overall market, what's going on, the market health. DecisionPoint Diamonds are for the traders. If you want to trade and you want somebody to select stocks for you from exclusive scans, then this is what you want. I'll give you 10 picks per week, that includes 4 reader requests. So I'll give you a full analysis of one of your symbols. If you are a subscriber, you just put your reader requests in there and yours might get picked for complete analysis. But I also want to talk about, we are just about ready to launch a new service called the DecisionPoint Scan Alert System. And what that's going to do, and for you guys, this is, I think, going to be the best product. It's super affordable. It's going to be $39 a month. But what I do is I give you all of the signals for the trend models and for our bias. So you get all of those signals when they change every day. And then you also get the results of all of my scans. So I run a bunch of scans and then I select those diamonds out of those scans. The scan alert system is going to give you all of the results from those scans. So you can go in and actually say, well, I don't like this one that she likes, but I do like this one. So you get a really great selection of stocks right out the gate. That's going to be launched probably in another 2 to 3 weeks. So sign up for the free email list. You'll definitely get information on the new scan alert system as soon as we're ready to launch it. But in the meantime, go ahead and try us out for 2 weeks. Just use that coupon code DP Trial 2 and you're in business.
Sounds awesome. I did go ahead and subscribe to your email list at the first mention of it. Great information.
Excellent.
I love your analysis. Thank you for doing the SPY for me. I'll know to have a bias down next week. And
Yes.
your insight is incredible, truly gifted. And I just want to thank you so much for sharing your vision of what you see on the charts with everybody, because that's all that really matters. Anyway, it's what's on the chart.
And make sure you put the right things on it.
Oh, thank you again for being here today and sharing with our audience. Ladies and gentlemen, this is Mrs. Erin Swenlin. You can find her at DecisionPoint.com. I put her links in the chat box. I think I spelled them correctly because someone caught me mistyping one earlier today, but thank you for being here, Erin. We hope you come back and see us again.
Excellent. Go ahead and put that coupon code in there too.
I did. DP Trial 2.
That's the one.
All right.
All
You
right,
have yourself a
thank you.
wonderful weekend, ma'am.
All right. Thank you.
Very welcome. That will bring us to our last presenter of the day, and you will want to pay close attention. Our anchor presenter today has been a professional full-time options trader for the last 13 years. He has a verified live performance with Reddit and has been mentoring students for close to a decade, and I will personally vet for his Reddited, verified performance, because I've been in his trading room once or twice and he almost does not lose. He's been able to maintain an incredible 90% win rate trading his own live account. He also has his own options live trading room and alert service that has garnered his members consistent profits. And the good news is he's going to tell us exactly how he does it. Here to present SPY Super System Revealed is Mr. David Wyse of Right Line Trading. Welcome to Traders Corner, David.
Hello, thank you very much. Thanks for the nice introduction. I appreciate it.
Hey, I appreciated my time spent with you, so thank you.
Yeah, I appreciate that. And yeah, 90% win rate. It's a lot of pressure.
Yeah, maintaining it's not as harder than getting there, right?
Yep, it's tough. But again, I appreciate the introduction, and I'll get into the presentation. I know everybody's had a long day, and this will be the last one, I guess, for you. But I appreciate folks coming to see this, and I'll give you a little, try to make this about 40 minutes or so, 45 minutes, and I'll be answering your questions as well. So again, my name is Dave Wyse, and I'm with the Compass Options Trading Room. And what we're going to be talking about today is about 2 or 3 things. We're going to be talking about what's called the SPY Super System, which is a couple pieces of software that Right Line produces that I use to find my trades. And specifically, the SPY Super System is identifying the highest probability trade setups for people that like to trade futures or SPYs and Qs, things like that. And then we're going to also focus on the Compass Options text alert. I do have a trading room and a text alert service that gets sent out anytime we find a high probability trade setup. So that's what we're going to be discussing, and let's get right into it. Again, first I have to, of course, do my disclaimer, and all signals and trading opportunities we provide here are for educational and demonstration purposes only. Trading is very risky, so you should never trade with more money than you can afford to lose. And neither myself or Right Line Trading are licensed financial advisors, so we won't be giving financial advice. All right, so let's get to this. One of the things I want to put up here, if you have any questions or you have to leave early, if you go ahead and put your name and number or a Skype username in the chat box, Rory will give you a call from Right Line and answer any questions you might have. He's not going to pester you with calls, but he will answer any questions that you might have. So you just put your name and number in there, your Skype number, and that will take care of it for you. All right, so this is the SPY Super System here. You can watch it on YouTube. I've done videos on this particular super system in the software and how we use it. So what we're going to talk about today when we get to the super system is we basically look to track institutional money flow. And my focus is on finding those highest probability trade setups that are available at any particular time during the day, both on the daily chart and the 5-minute chart. And we'll go into some detail on that. All right, and there's the bell. So anyway, the first thing we'll talk about is the Compass SMS text alert service. Again, you can take these trades anytime during the day. They come right to your cell phone. This is actually a picture of some of what the alerts look like on your cell phone. They basically just come through with, and I'll go over what's on there, but they're pretty easy to read and pretty clear cut, and they give you all the details that you need to put on the option trades that we take. So again, you can take trades on the go, of course. First thing I do want to talk about before we get into the actual service and the trades is just to go over what drives the market. It's really important to understand that there's two really categories of traders. There's retail traders such as myself and most everybody that's in here most likely. We're retail traders and we're these little marbles here. And it's important to understand that retail traders on our own, we cannot move the market. We just cannot create trends or reverse trends. This is the big ball here. This is the institutions. And this is the institutions like HSBC Bank and Goldman Sachs and JP Morgan and any of the mutual funds. The mutual funds have billions of dollars, which Vanguard, T. Rowe Price, and then you have all the 401ks that exist, and then the huge pension funds from the state pension funds and all the big workers pension funds. These people have billions and billions and billions of dollars, and when the institutions decide they want to move a stock up or they want to move a stock down, that's when it moves up and that's when it moves down. And our job as retail traders is to find out when that occurs. When are the institutions actually driving a trade and when are they not driving a trade? We don't really want to be in there unless the institutions are moving it. So my job and what the software does for me and what I'm looking for high probability trade setups is only to take trades when the institutions are in there either buying or selling that trade. If the institutions are not involved in the trade, I don't want to be involved in the trade because I know who's in there. It's the retail traders trying to pick bottoms, pick tops, move things around, and all you get is chop and chaos when that happens. So that's really important to understand that to find a successful trade, a high probability trade, it's important to understand that you have to know if the institutions are in the trade or not in the trade. So how do we do that? And that's what we do. Now, the first thing I'm going to talk about is the strategies that we use both in the option room and the alert service. So any trades that you get, if you're on the alert service or you're in my trading room, these are the categories they're going to come out of. They're going to be either straight calls or puts, and they're going to be option trades. Now if you don't want to trade options, you don't have to. If you get a pick, for example, we're taking Microsoft long, then you can just trade the stock. There's nothing wrong with doing that, but I leverage my trading, so I use options to do all my trades. So there'll be straight calls and puts. Most everybody's familiar with straight calls and puts. Then I use debit spreads, but I use debit spreads and I only use weekly options expiration on weekly debit spreads. I don't go out to debit spreads, 2, 3, 4 weeks out. I only use weekly options expirations because over many years of running these trades and basically analyzing my trading journal on these things, I found that if you do debit spreads and you use weekly options expirations and you actually have the stock move in your direction, this is where you get your best ROI. Because when you do a debit spread, you get two legs, of course. You're long one leg and short the other leg, and the short leg is going to deteriorate much faster because of time decay. It gives you a much bigger edge. And debit spreads on weekly options, many times, even if the stock doesn't move very much at all, you can actually make money on it, which you wouldn't do if it was further out. So that's another one of the strategies we use. A third one that we use, which will be coming up here pretty soon, is we do what's called time spreads. They're called calendar spreads, but I call them time spreads. And we do this over earnings. And I only do it, this is the only strategy I use over earnings. And it doesn't depend on the stock being bullish or being bearish. I don't have to guess the direction of where it's going to go on earnings. All I have to do is capture the volatility crush when the earnings come out. And what happens with earnings come out is the volatility on the option premiums gets drained out of them very quickly. And my job with the time spreads is to capture that decay or volatility crush as quickly as I can. So that's another strategy that you would see. And another one is called the weekly ATM strategy. This is a strategy that we use to actually sell premium every week on stocks that are neutral to bullish. So we basically sell in the money calls. In the money puts or at the money puts on the stock, and we keep a much later dated out in the future long put to protect that. Basically, we're going to be selling puts this week and next week, and then we're going to have a long put that's out like 4 to 6 to 8 weeks out in the future, and then we just keep selling puts against them each week and bring in premium. And then we have the SPY super system, and these are for very high probability trades that we talked about. And I'll show you some of those and how we use that by using the ability to identify when the institutions are in the trade and when the market internals are in our favor. So this is what you would see when you've got some trades coming through. I'm going to review some of the trades we've done later on in the presentation, but I just wanted to throw this up. This is the September 2023 trades. These are the trades that we've done this month so far. We did have one loser, this firm, but this is what we've done so far, and we've got 21 wins. Actually, we had one more win today, but so we're 21-1 or 22-1 right now on closed trades, and under really difficult trading conditions. If you're a trader, you know that the trading has been pretty tough, but you can see these are fairly predictive of what we get typically. We're going to get anywhere. Square was a small win here, but typically anywhere from 20 to 40, sometimes 50% of the trades. You're not going to get. I don't advertise or try to convince people that we're going to get 100, 200, 300, 400% wins because that's very, very rare. It happens very occasionally, but what we're looking for here is to basically hit singles and doubles and bring in nice 20, 30, 40% profits, trade after trade after trade, week after week. And going after the big ones was way too risky. We did have a nice trade in STX this month, 108% back on the 5th. That was a nice one. But basically, you can see they typically fall in the 10, 20, 30% range. So that just kind of shows you what's happened in September so far. And what I use as a baseline, and everybody has a different account size and how much money they want to put in, but I use just a baseline of if you invested $2,000 in each one of the trades that we did this month so far, you'd be up 88 happens to come out about $8,800, which is pretty nice for 200 in each trade, 2,000 in each trade, and that's what I use as a baseline. Some people can use less, some people use more, but it's just so we have something to compare months against. So that's the trade review for September, and those are pretty good results. And I think most people would agree that that's a pretty high percent win rate right there, about 92%, which pretty much falls in line with what we typically do. We've had worse months, but better months as well. All right, so the Compass Alert Service, what we call the Compass Options Alert Service, is designed for day trades and short-term swing trades. We're not doing any long-term investments. We're not doing any options that are 4, 5, 6 months out. These are day trades and short-term swing trades. It's designed for traders who can't watch the market all day. That's what I think a lot of people, they work. They'd like to be able to be involved in the market. They'd like to be able to bring in some additional income on a weekly and monthly basis, but they can't sit in front of the computer and watch the market all day. So this is designed for traders who can't watch the market, who would like to get real-time alerts of only the highest probability trade setups. And I'm going to go into how we find these. One of the things I'm going to do today that some people will be interested in, some people won't. A lot of people who want to get alerts, they just want to get the alerts. They don't really care where the trades are coming from. But I'm going to go into some detail on how I find these high probability trade setups. So you as an alert member or a room member, we can see where these trades are coming from. Where are we getting the criteria to find these high probability trade setups? Because believe me, it's not easy to get 85 or 90% win rate. It's difficult, and it's very important to only use the highest probability trade setups. And how do we do this? I'm going to get into a little bit more detail, but the highest probability trades are, we identify when the institutions are in the trade. And again, I'm going to go into how I find those. But when we find stocks that have institutional involvement in them, whether they're buying or selling, and we have market internals that are in our favor, and I'll go over what market internals are, and then we do some additional technical analysis on the trades that qualify here, and then we pick the best ones. All right, so that's how we send these alerts out. That's what they're coming from. So again, the trades are going to be alerted by SMS message, and one of the sayings we have in the room is we're going to trade the best, we're going to skip the rest. We're not interested in mediocre trades. We're only looking for the best trades. A lot of times, you know, you might only find 1 or 2 a day. Some days there aren't any, but we don't, you know, it's not something you're going to find 10 high probability trades in a day. Every alerted trade is going to include the stock symbol, and the option strike price, of course, the option expiration date, and the price to pay for the option. And, you know, there could be a range on that. It could say, you know, $1 to $1.05, something like that. And then sometimes when the alert comes out, you'll get the exit price as well at the same time. But generally speaking, I'm going to send a separate alert out with the sale price on it, with the sell price on it. Because I like to watch the price action. It looks really strong. We'll say let's take it overnight or a couple of days and set the price at a higher profit target. So I have to decide on that as time goes by. But once you do get the strike price or the sell price for your trade, you're going to want to make it good till canceled, because we always want these trades operating or working when the market opens in the morning. All right, so how do we achieve such stunning results? And you saw those percentages, and you know, 85 to 90% is fairly normal for us. But how do we achieve this? And we're able to identify when the institutions are driving a trade and when the market internals are heavily bullish or bearish. Now, these are two things, they're two different things. The institutions can be in a trade, but the market internals don't have to be bullish at the time. They could just be neutral. So it's when those two things line up, you've really got the very highest probability trade. Again, we only take trades when both of these are in our favor. Those are the very highest probability trades. I will say that we do take trades when the market internals are neutral. I don't have you know, there's no bias necessarily in the market internals, but if I know an institution is in the trade buying it and it's got a very good technical setup, then we'll take that as long as the internals are not bearish. If we're going bullish, we just want them to be either neutral or bullish. So again, we trade the best and skip the rest, and this is important. So this is what the two systems that I use to do this. It's the compass system and the dominator system, two different systems. The compass system identifies stocks that are being moved by institutional buying or selling. And we just talked about that. That's what we look for, but we've got to know that. It also identifies stocks that do not have institutional buying or selling moving them. So those can be avoided. This is very important. We don't want to be in trades if the institutions are not in there. Now, the dominator system is going to display market internals, and it produces buy or sell signals when the difference in the number of stocks moving up on up volume and upticks is much higher than the stocks moving down on down volume and down ticks, and vice versa. So we're going to get a buy signal if we've got like 800 stocks moving up on up volume and upticks, and 100 stocks moving down on down volume and down ticks. So this would be where we get the buy and sell signals from the dominator system. So if we've got the compass system telling us the institutions in there buying, and we've got the dominator system telling us not only that, but the market internals are also in our favor, the whole market is bullish, that gives you a very high probability trade setup when that happens. All right, so that's what the SPY Super System software is going to identify, and I'm going to show you these the charts and how we find these things and why we find them like that. So again, this is what we're looking for: institutional money flow. Again, that's the how do we know the institutions are in there? And again, the combination of market internals, dominated system, and compass trading system has been the cornerstone, which it has. This is what makes this work, because when we know both of those things, we know immediately that we've got a really good high probability trade setup, and then we just have to find a good entry for it. And again, these things together provide a comprehensive view of the market. And again, allowing me to precisely identify when institutions are influencing trades and gauge the overall market sentiment. And that's the key to the whole thing right here. Again, so this ensures that we're trading strategically. We're not just picking stocks willy-nilly. We're only aligning with institutional activity. And basically we're riding the coattails of the institutions is what we're trying to do. And so again, you can read this, but we make well-informed decisions with high probability trading success. And I feel pretty proud of what we've been able to accomplish by doing this. And that's basically, you're going to see some charts. That's the compass system right there on a slide for on the Thinkorswim platform. All right, so just so you know, how do we identify institutional trading? This is important because it's one thing to say I want to be in the trade when the institutions are in there. How do I know that the institutions are in there? Well, the compass system, which is looking at institutional trading, is looking at what's called a triple screen assessment. And basically that's a fancy way of saying looking across multiple time frames. It's fractal. It's looking at 4 different things. It's looking at momentum, it's looking at trend, it's looking at money flow, and it's looking at quant. And the quant is stocks that typically move with the stock we're looking at 70% of the time or more. So if we're looking at Microsoft, the quant's going to tell us if the stocks that usually move with Microsoft 70% of the time or more are moving in the same direction. Now, it's looking at this momentum and the trend and the money flow. It's looking at all 4 of these criteria across 3 different time frames. So if I'm looking at momentum on a 5-minute time frame, and I'm looking at it on a 15-minute time frame, and I'm looking at it on a 45-minute time frame, and all of the momentum is moving up, and I'm looking at trend across the same 3 and the money flow across the same 3, the chance of this move not being driven by institutions is almost nil. I mean, it takes institutions in order to drive these things in the same direction over multiple time frames. And this compass system identifies this, and this is a pretty complex thing that it does to find this information, but I'll show you how easy it is to identify it for you as a trader. But this is how we're finding the institutions, because a lot of people want to know, how do you know about institutions? Some people like to look at volume, some people look at RSI, or they'll look at other things to see if an institution is in there. But volume is not enough, and even price moves aren't enough. You've got to have this momentum that's going across multiple time frames. All right, so that's the compass system, and that's how we find whether institutions are in there or not. The market internals dominated system that looks at market internals across 5 indexes. So it's looking at the Dow, the New York Stock Exchange, triple Qs, the NASDAQ, the SPY, S&P 500, and the Russell 2000. And it's looking at this number of stocks moving up on up volume and upticks versus the number of stocks moving down on down volume and downticks. And it's looking at this every few minutes. I mean, it's looking at them all the time. It's just analyzing this on a real-time, ongoing basis. This is a real-time analysis of those volume and ticks. And when it identifies that there's a large disparity, as I mentioned before, like 500 moving up versus 100 moving down, the software is going to create a signal. If there isn't a big disparity, it's not going to create a signal. It's just going to tell you that it's neutral. There'll be no signal. And when we use it in conjunction with the compass system, we identify even higher probability trade setups. So that basically covers what we're looking for here: institutions and market internals. And I want to run through some charts here. Now, this is going to show you what the information that we're looking for, the institutional involvement, how it's reflected on the chart. And that's how we trade. We trade off of this information. All right, so this is a trade that we took just a few days ago. This is on Hershey. This is a daily chart, and this is the compass system. This is the compass system on Thinkorswim. I have it loaded on Thinkorswim. It runs on Thinkorswim, it runs on Ninja, but typically I like the Thinkorswim version of this. Now I don't trade off of Thinkorswim. I trade off another platform, but I use Thinkorswim to get the Compass software loaded. So if you don't trade on Thinkorswim, it doesn't matter. You can still get the Compass system and have it loaded on Thinkorswim because you don't have to pay for the platform. What we're looking at here is Hershey on a daily basis. Now the indicators down here, I'm just going to go over these fairly briefly, but this one right here, this red line right here, this is the multi-time frame momentum. This is tell us what Hershey is doing over the 3 different time frames: the daily, the 3-day, and the 9-day. And it's telling us here when it's red. If it's red or yellow, that tells us we have institutional selling across those 3 time frames, as long as the current time frame is also lined up with that. And the colors would be red or yellow is short, and blue or green is long. All right, so that's what we would see there. I hope I didn't mess something up right here. But anyway, so this is the multi-time frame. This is the current time frame. This is what Hershey looked like on the daily chart. So when I look at this, we took this trade right here, and this is Compass system that's got a couple of things on here. This has a shaded area that's called this is called a dynamic compression zone. This is telling us that the stock is in compression on the daily chart, and it broke down out of this dynamic compression zone right here. It broke down right out of it here, and this becomes a buy because we've got multi-time frame momentum bearish, current time frame momentum bearish. This is the quant line right here, and that's also bearish, and this was a bias line or the money flow line. This is also bearish. So everything is bearish here. We went from blue to yellow. So this went from some buying to selling. Institutions are selling, and we know that it's got to be institutions when we've got all of these things and the stock is dropping down like this. So we bought it right here. We rode it for a couple days, and we took profits on it. We were out before today. We took it off right here for profit. But this kind of shows you what the Compass system looks like and what you would see on your chart if you had the Compass system. It's going to look exactly like mine. This little thin red line here is the 15 EMA of an EMA. It's a smooth and exponential moving average. And obviously it's red and sloping down, so we want to be short this stock. So that's the daily chart on Hershey. Now I use dailies and I use 5-minute charts. The daily chart needs to line up with my 5-minute chart. This was another one we did. This is Oracle. We were short Oracle as well. Very similar to what we see here. You see how we've got red and yellow across the board here coming out of another dynamic compression zone. It's coming down here. So this again, we shorted Oracle. And this was a really nice trade. I mean, I think we paid, trying to think, $4.50, $5.50, yeah, $5.50 for the option, and we get out for $7. So $1.50, which is a really nice profit on a fairly quick move on this. We just held it just one day, one overnight. So that's Oracle. Again, you can see, easy to see it's bearish. And I mean, this basically is yelling at you that the institutions are selling this stuff. If you had different colors, reds and blues and stuff, so you wouldn't touch it here. You see, you've got multi-time frame blue, current time frame red. We have no confirmation that the institutions are selling here. Now we have confirmation that they're selling. At Dollar Tree, this is another one. This is another daily chart that we took in Dollar Tree right here. It fell down out of dynamic compression, and look at your indicators here. Current time frame momentum, multi-time frame momentum, quants. Everything red. The institutions are selling this off big time, and you got to be short. I mean, you just go short on this. We wrote it down for a couple of days, and we took a nice profit in it. Okay, this is D-Dog. This is one more. Again, these are daily charts I'm showing you right here. I just kind of want to show you how these we could take overnight. We took Data-Dog right here, coming out of dynamic compression right here, and popped down. We took profits the next day. Everything's red or yellow. The institutions are selling. It's coming out of dynamic compression. Really easy to see. And remember, there's a lot of information being crunched here by the Compass system to show us these colored lines. And again, this is where I'm getting my trades from. When you get alerts, this is how I'm finding them. And I think it's important to be transparent and let you know where these trades are coming from. We're not throwing darts. We're looking for the very highest probability trade setups. All right, this was an ENPH. Now, this was a 5-minute chart. This is when we traded off for the intraday. And if you look at the colors, you can see this is like 10:30 in the morning. everything is red. We've got the institutions selling, but we don't want to just jump in on this compression. Now this symbol right here that the compass system puts up is called a pop signal, or a pop out of the box signal. This tells us that the compression is breaking. It's breaking to the downside, and we're below the 15 EMA. This pink line, by the way, is the VWAP, the volume weighted average price, very important support resistance level. As we break down below that, we get this pop out of the box signal, tells us to take it short. We take it short, and we ride this thing down. And you notice everything is staying red. It's, no matter what the stock price is doing, the institutions are still selling this. So they've got a lot of selling pressure on this. And once we go back over to blue, we just take profits out of this thing as it comes back up toward the 15 EMA. But I think we exited right down in here as we got the momentum waning. But that's, you can see how easy it is that to see that institutions are selling this off. I mean, this is really quite an important thing, because if you want to trade with the institutions, you need something like this to be able to identify that. The Verizon, another 5-minute chart. This was a really nice trade. Now Verizon doesn't move a lot. This stock does not move an awful lot. It's pennies, moves a few cents. But you notice we get a pop out of the box signal right here as it came down below the VWAP. That's a nice resistance level that it's coming off of. Obviously, the institutions are selling. Look at all the red here across the board. And as you get these pop out of the box signals, they continue down. We took this down, and this was they're fairly inexpensive options. We took this for 45 cents. We took a put on this for 45 cents, an in the money put, because it doesn't move a lot. And we get out right down here for 65 cents. That's almost a 50% gain on your option on this particular trade. People say, well, how can you make any money on a 45-cent option? Well, you can make a lot of money on a 45-cent option if it goes to 65 cents, because that's $20 a contract. And with 45 cents, if you buy 10 contracts, it's $450, and you just get out for $650 about an hour later. So that's how effective these are. And again, you can see there's no reason to be panicking in this trade, even if you get a pop-up. As long as everything stays red, the institutions are selling it. You know that and eventually it's going to turn back down. All right, here's a trade on the SPY. This is a SPY super system. This is what I talked about. I'm going to show you 2 slides here. This is the compass system, and this is how we find the trades for a SPY super system. Okay, we've got a pop out of the box signal right here, coming off the 15 EMA, and everything's red. So we know institutionally, the institutions are selling the SPY right now. They're definitely selling the SPY. All right, and we took this and we took it down, and we get out right down here. As just before it reversed back and went to blue, you exit the trade. But here's another thing I'm going to show you. I want to show you that's the institution selling. The SPY super system, to get the actual perfect setup, you also need the dominator system to be also bearish. All right, so here is the dominator system, and this one runs on Ninja. This runs on Ninja 8. This is the dominator system on the same SPY at the same time. Right here, if we go back and look at the SPY, well, the time is cut off there, but this was exactly the same time. Now you can see a couple of things that are important on the dominator system. We're looking at market internals. What's the background color? Background color is dark pink. That means that you've got a multi-time frame trend bearish in the SPY. And what you're looking for here is you're looking for a sell signal. These are all the indexes down here, and they're all pretty much red. This is a sell signal. This tells us there's way more stocks going down on down volume and down ticks than going up on up volume and up ticks. And this is where we entered it. So when we knew we had a good setup here on the SPY, off of the compass system, we knew the institutions were selling, we knew the market internals were in our favor, you take the trade. And that's what the SPY super system is. And when those occur, you can trade them, and usually you have to trade the SPY fairly quickly. This was good for, I think, 5 or 6 candles. Yeah, more than that, probably about 10 candles. But that's the kind of a move that you get out of the SPY super system. But that's why we call it that. The compass system is telling us the institutions are selling the SPY. The dominator system tells us that the market internals are also being sold off. That gives you the perfect setup for it. All right, so that's what the SPY super system is. And a lot of people in my trading room trade those each day on the SPY or the Q, just looking for those particular setups. This is another just a chart to show you the compass system. This was a Netflix trade that we took. Again, 5-minute chart. You notice that right here where we got this candle, where I've got this white arrow. You see the stock is compressing, and you see the pop out of the box signal, and it's breaking below the VWAP. But here's the key thing to see. You see this blue, that's buying. See this yellow? It's gone to selling. The institutions have turned to selling. They're already selling on the multi-time frame and on the quants. Turns to yellow, and you get a pop out of the box signal. That's where you get in. That's the perfect entry because you get selling across the board, and you jump in right here as it breaks below the VWAP, which is a resistance level, and you write it down and just keep writing it down. And we get out right down here, 20% profit on that Netflix trade. And I mean, it's you can see how well you can see that the institutions were selling this. This was a trade that some traders took right off of they took this trade right off of the dominator system. They didn't even look at the compass system, but they used the dominator system to tell them that market internals were working. Now I use them both. I lean on the compass system more than anything, but this was a nice SPY trade off of the market internals because you can see that we've got sell signals. We've got a dark pink background, meaning that the multi-time frame trend is bearish, and we've got a nice break right here. You can see it breaking down, and you just ride this thing down. We get, and then it moves around, it pops up, but we got 3 points in that, $250 a contract on that trade. So 5 contracts, you get yourself $1,250. It's a nice quick trade, and that's what the dominator system does for you when you're looking for those kind of trades. This was a Tesla trade, and I just I'm trying to make sure you can understand how I'm finding these trades. Before I get into a lot more detail, I just kind of want to show you the setup so that you can all see that if you're a fairly new trader and you want to know whether a stock is bullish or bearish, with a compass system, it's really easy to tell. I mean, you're looking at colors. These colors are being created by extremely complex calculations, but this was a perfect spot to take this Tesla trade right here. You see how it's kind of moving sideways and you're getting multiple colors changing. You get blue, yellow, red, blue, yellow. But right here we get a yellow breakdown. We've already got yellow in the multi-time frame. The current time frame momentum is also bearish. The money flow is bearish. The quants are bearish. And you get a pop out of the box signal telling you that we're coming out of compression. That's where you take the trade. And you just ride this thing down. And you get a couple of green here, but it never gets above the 15, and everything stays yellow or red the whole way. We just wrote it down right to the end of the day. This was at almost 4 o'clock, and we took a 30% profit in that simple little trade like that. When the compass system is telling us the institutions are selling, you want to be selling. When back here, they were just going back and forth, back and forth. You don't want to be involved in trade when you've got green down here, yellow up here, and then goes blue, yellow. You're getting all this chop. That's telling us that retail traders are moving this. The institutions are not. And this was a Tesla trade that we took. And this was an overnight trade we took. This was a little riskier because we had a sell-off in Tesla at the end of the day. We had a pop out of the box signal, so we took it short overnight. This is the 5-minute chart, but you still notice everything was lined up red or yellow. So we took a bearish trade and we took this, and fortunately for us, it gapped down. It fell from 120 at the close to 112, and when we get out, it dropped down to about 119. It closed down here at 112. We took profits. Those puts exploded. You can imagine how those puts exploded when a stock drops $8. I mean, like $6.50 profit per contract on those. That was a nice one. That was a very nice one. Now this is one of the things I use in the room is I use Heikin-Ashi candles, and Heikin-Ashi candles are specifically done using 2 candles. And what a Heikin-Ashi candle tells you is you can have a confirmation of a reversal. When you get a candle that has a wick and a tail on it, like that, wick and a tail, wick and a tail, and then you go to a flat bottom candle, that's a Heikin-Ashi bullish reversal. You go with wick and a tail to flat bottom. And you notice that each one of these candlesticks on the way up have flat bottoms because it takes two regular candlesticks to create a Heikin-Ashi candle. So when you're getting flat bottoms, it's going to stay flat bottom as long as it's still bullish. And that's a beautiful way to ride the trend. And that's how you find a confirmation of a trend. Because if you're looking for a confirmation, for example, off of support, and it's going to bounce, then if you wait for a Heikin-Ashi candle, that's 2 candles making that up. You basically, by definition, have confirmation of the reversal. And just wrote it up. This was another really nice trade. And we took profits here when we started getting wicks and tails again. a nice trade on Tesla. This is a case I want to show you. This is QSR, and I want to show you how I go into a little bit of detail to find some of these trades. This is a QSR on the daily chart. You see it's bullish. Obviously, here's the candlestick popping up. So it's bullish. So I know I want to trade this long. All right, so I look at it long, and I'm coming in on a 5-minute chart the day I want to trade it. What I'm looking for is I'm looking for an entry point. And here's the 15 EMA. You hear this just kind of, it's green, it's moving up. The colors are changing back and forth. Then I go to solid green here across the board, and then I get a pop out of the box signal. This is where you take it. So pop out of the box signal, off of the 15 EMA with everything green. It's long trade. I take it and I just ride it up right up to here. Again, 6 or 7 candles. Now, so that's the daily. This is the 5-minute. This is QSR on the dominator. If I want to get even a higher probability setup, what I do is I look at the dominator to make sure that I've got a dark green background telling me that I've got a multi-time frame trend to the upside, bullish, and I'm looking for buy signals. Now, in this particular case, the fact that I have a multi-time frame bullish setup on it, and I've got compression right here, I can buy it right here, which is what I did on the compass system, because the compass system was telling me to go for it, because it was the institutions were in there. But if you're more conservative, you can wait until you get a buy signal on the dominator system. So that's how we find the trade on QSR. There's a daily, the 5-minute, and the dominator, and that's how I found that one. And again, this is another dominator system trade, and again, you can see the buy signals in the dark green background. It goes from light green to dark green, and you get buy signals across the board. Anywhere in here, you can take this, and you can just stay in it. There'd be no reason to even get out until the end of the day. And same thing on the SPY. I just kind of want you to see what the dominator looks like. You notice how we had a black background, which is neutral, and we went to a light pink background, which is bearish. This is where you would take the trade here and write it down, or you could take it right here as it compresses and breaks down. Anywhere along there was a nice trade. And again, it was a SPY trade, a really nice SPY trade. And trade to the long side, and I'm gonna stop with these for those. All right, so that's the. What I want to do is I want to, before I end, I want to just kind of cover the results that we've had. And there's this trade, this one here, this is actually a year old. This was from 10/1 to 12/28 last year. But the reason I did this was because the dominator system just came out last October. So this was the first 3-month period that I was able to use the compass system and the dominator system in combination. So what happened is between October 1st and December 28th, all the trades that I took that were compass trades, they didn't necessarily have, they didn't have the dominator lined up with them, but they had neutral dominator. But these are compass trades without the dominator trades confirming it. And I had 129 wins and 12 losses. So 90.2% win, which is pretty common, pretty normal. I mean, it's sometimes I'll drop down below that, but that's pretty normal. Now, when I did the same trades during the same time period, when I actually had the compass system and the dominator system both lined up, so I had bullish compass system, institutions buying, bullish dominator system, I had 113 wins and 2 losses. You can see that the number of trades is fewer, of course, because this situation of those both aligning doesn't happen all the time. But that's a 97% win rate, astronomically high, and probably very difficult to try to repeat. But this was when I was doing the test on it, and that's what the results was with those particular trades. And I've got these slides that have been here for a while, just kind of to show what we've done in the room in the alert service for certain periods of time. This was March, April, May, and June. You can see the win rate here was between 86 and 87.5%. That's pretty normal. And we had 37 wins and 6 losses in March, 35 wins, 5 losses in April, 41 wins, 6 losses in May, and 37 and 6 in June. You can see the total number of trades, it hangs around in the low 40s usually. And the profit, these are the profit we made in each one of those months. Again, they're going to vary because it just depends on the market. And how's the market? How long is it? Are we able to stay in the trade? How much pullback do we get? How many losses do we take, and how much were they? But these were the profits for those particular months, March, April, May, and June. And this I'm just kind of proud of, because this was some trades we took in May and early June and April, I'm sorry, and through May. And we did 19 wins in a row, followed by 10 wins in a row in May. We ended April with 19 wins, and then we had 10 wins in a row in May. And again, $10,000 in each one of those trades produced about $11,000 in profit. Okay, so that was my pretty much the best. I actually had a 32 win run, but that was a pretty nice run right there. All right, so again, I just kind of want to cover, these are the strategies that we're going to be using. You're going to be getting information when the trades come through. They're going to be straight calls and puts. They're going to be debit spreads using weekly option expirations. There'll be time spreads when the earnings season occurs. There's really not much going on right now. October earnings season. When we have a bullish to a neutral to bullish market, we'll start doing some weekly ATMs. We do not have that right now. I also do put credit spreads when the market is bullish. Sometimes I'll do call credit spreads when it's bearish, but mostly bullish put credit spreads. And then we have the SPY super system. Now you won't get alerted on these. We do these in the room, but you're not going to get alerted because they're too quick. Some of these might only last for 2 or 3 5-minute candles. But that's where the trades from the room and in the options service will come from. And again, I'm just going to run through these. This was May trades here, and I'm not going to go through each one of these. But you can see that I just want people to see that the percentage gains are fairly consistent from month to month, and we do have losses. It's important to understand we have losses. Everybody has losses. We have losses, but you can see the number of wins kind of swamps the losses pretty high. And they're fairly consistent. They are fairly consistent. This was a weekly ATM, by the way, that we did on Microsoft. Okay, May. This was June right here. Same type of thing that you can see. And let's see. This was July trades. I was on vacation for the first week in July. Went to Iceland, and my wife and I went to Iceland for 8 days. This was so I didn't start trading till the middle of the month. So we had a pretty nice win. 20 wins, 4 losses. A pretty nice week. Multiple weeks. August was probably the toughest month that I've had in 3 years. We had some losses, but we did okay. I mean, we had a win rate of 70-some-odd%, but this was a very, very tough month in August. And then September, of course, 22 and 1 so far. This is kind of an outlier. But again, you're going to have situations where the market was extremely difficult. We get in a couple of these losses were because a news event came out and knocked the trade down. We didn't have any control over that, but that's going to happen from time to time. And these, again, I go over the September trades again that we talked about. We're actually at 22 and 1 right now, and pretty nice trades. And so this is typically what you can expect. Obviously, you're going to have wins, you're going to have losses. Can't guarantee anybody's going to have how much they're going to make or how many wins in a row they're going to have. All I can show you is where they're coming from and how I get them. And when you get them, you're going to know where they're coming from. If you look at the chart, you're going to be able to see why we took those trades. And these are some trades. These are actual alerted trades that we took recently. Crowd, we get in for $6.90, out for $8. That was an overnight trade. STX, again, this was a big one. We get in for $3.70, and we're in this for 2 days, and we get out for $7.70. That was a 108% profit, really massive. So again, I'm not going to go over each one of these, but you can see pretty much that and there'll be losses in the alerts as well. But these were nice profitable trades, 30, 40, 50% most of the time. Again, these are even some recent ones. Dash we looked at. Again, 31% profit. This was in the 64, out for 84 overnight. In for 66, out for 86 overnight. And one reason I mention overnight is a lot of folks are they're on PDT. They're on a situation where they can't make more than 3 trades, intraday trades in a week in 5 days. They're pattern day traders. So if they're under pattern day traders, a lot of the trades we take are going to be overnight or multiple days. The time spreads are all multiple days, and any credit spreads we do are all multiple days. So that takes the concern about being in the trade and having too many intraday trades in a short period of time. So anyway, these are the profits on these trades. Again, in for 35, out for 45. Doesn't sound like much. 28% profit, $2,000 invested, get you $570. This was a nice one. this was TSM, in for 580, out for 870 the next morning. I mean, you know, that's a pretty big move right there, 50% profit. And again, about 810% and $10 profit on that. So those are the alerted trades, and you saw how they would look. So we're going to talk about just the offer here, because we've taken up a lot of your time. This is the Compass SMS text alert service, and again, this is that's what it looks like. It's going to say David Wyse alert service, where the date is going to tell you the stock, the expiration date, the option, the premium, the option you're taking, the particular strike, and this was a sell order right here on this that we had in here. So that's what it's going to look like for you. All right, so this is the option, basically just the options trade results, which we see we had that a losing month here, but pretty good months. Most of the time they're somewhere between $5,000 and $9,000. But the Compass Options text alert service is if you use this $500 coupon, this $5 use coupon code 550, it's $9.96 annually. So you get 12 months of all the alerts. If you want to do it quarterly, make sure you use this coupon code SAVE100. That's going to give you a quarterly alert service for $296, $100, less than $100 a month. And you can see what the results have been on these things. So that's again, that's the alert service. Now we're going to talk about the SPY super system here. Now this is the software we just talked about, the Compass system, the Dominator system. So if you want to get the SPY super system, what we call the SPY super system, and this is a bundle, and normally it's $29.98, but for a coupon code of save 1,000, you'll get all of this for $19.98. This is really an amazing package. It's got the Compass trading system, the one we talked about that we saw on Thinkorswim. That you get that. You get the Market Internals Dominator trading system that goes on Ninja. That is also included in this thing. You get the text alert service for 3 months, and you get the trading room for 3 months. And the trading room typically is about $149 a month individual if you take 1 month at a time. So that is the bundle. Now the bundle also includes the scanners. We have scanners in Thinkorswim that I have that will look for these high probability trade setups. That would you get as well. We have a private Discord trading chat room where we have 2 other professional traders in there, Dr. No, Savvy Trader, that post charts during the day. They answer questions. They put out information on which sectors are the strongest. Lots and lots of information. There's also this Wise Way to Trade Options Master Class modules, pretty big mouthful. Basically, I have about 25 videos on the methodology that we use to find the highest probability trade setups, the strategies for doing time spreads, for doing weekly ATMs, for doing debit spreads. There's how to find how to use Heiken-Ashi candles. There's just a lot of them. There's one called Top Gun, which basically goes into, once you find some high probability trade setups using Compass system, how to find the best of the best by using additional technical analysis. And this, of course, will include all installation and customer service. The techs at Rightline are great, and they will just take over your machine and put the software right on there for you. It'll look exactly like mine did. And again, that's $19.98 if you use that Save 1,000 code. It's a really, really nice package. I tell you, when I didn't have the Compass system, when I first learned about this a little over 2 years ago, it made a big difference in my trading. And I was a professional trader at the time. I had been trading for like 13 years at the time when I found this, and it made so much difference because I was able to. The biggest thing I was able to find was I was able to stay out of trades that the institutions weren't in. That if I didn't have this, I wouldn't have known that, and I got in there and get chopped around. These are some reviews from people that are in the room talking about how great the room is. It's a little embarrassing to go over some of these. They're really good. And you know, they're really happy with the results, and I'm leave that at that. And again, here's the Compass option text alerts. Use Save 500 and you can get the annual for $9.96, and Save 100 you get the quarterly for $2.96. And again, this SPY super system today. This gives you all of this Compass system, the Dominator system, the alert service in the trading room, plus all these other add-ons over here, which are pretty nice. And this is a really, really good package. And again, if you have any questions or you want to learn more about it, put your name or number in the chat box, and Rory will give you a call and he'll answer any of those questions. I will mention also that if you want just the compass system, you just call Rory. They can take care of that for you. Or if you just want the dominator system. And again, obviously, if you just want the alert service, you'd use this. And if you just want the trading room is going to come with the alert, so you can ask Rory about that. But just put your name and number in the chat box, and Rory will call you, and he'll answer any questions that you might have. So that kind of takes care of it for me. I'm going to look and see if we've got any questions, folks who might want to answer some questions. Let me look here. Let me look. Will this be recorded? Yes, it is recorded. A link will be sent. Most of the time spots. I don't know what you mean by time stops. Yeah, the algos, we didn't get into a lot of detail on algos. Algos know what retail traders, if they're setting stops and everything. I never use hard stops. I only use profit targets. I don't use hard stops. Whoops, let me get down here. Oh yeah, my question start. I'm probably looking at somebody else's webinars. All right, here we go. A little after 3:45, I think. All right. What's my signal to exit? You know, most of the time, Dan, I use I'm looking at the price movement, and I'm looking at where the stock is and what the market's doing. To exit's not is not that simple to define, because I'm really looking at the SPY and see what the SPY is doing. If it's still going in the direction that my trade's going in, I'll probably stick with it. If it starts to lose momentum and I'm up 20, 30% on the trade during the day, I'll take profits. I'll also look at the compass system and see if the institutions are still in the trade or if they're not in the trade. If they're still in the trade, then I'd be more inclined to stay with the trade a little bit longer. And then, you know, I use that, I'll put an alert out, and you know, I'll put a sell price on it, and sometimes it may hit that day, sometimes it may take another day or two. Is the system adaptable to trading futures contracts? Yeah, absolutely. The compass system works great on futures. All you have to do is put the code in the Thinkorswim platform, ES, NQ, YM, whatever, and you're gonna know whether the institutions are in those in that particular trade at the time. And we even have a futures room that trades off a Ninja, which uses basically the compass system. It's called Money Flow Tracker over there, though, but it uses the same indicators to trade futures. And I mean, if you can trade futures off of Thinkorswim as well, and the information is perfect for that. You can use it for pretty much anything. How were trades in July and August? July and August were very difficult. Now we had, you know, August was very difficult. July was okay. I was only here half a month, but July was over. But if you've been trading, you know how difficult July and August were. It was a very tough summer. Now we had some profits. We had nice profits, and our win rate was decent. August was a little bit weak, but typically you're going to see somewhere in the neighborhood of 85 to 90% wins, and that's pretty consistent. Listen, you're not gonna win every single time. You can't. Let's see. Do I trade 0-day expiration every Friday for stocks? You know, I only have certain times I use 0-day expiration. If I'm trading the SPY, for example, I'll normally take the puts or the calls for the following day, so I don't get time decayed to death. But the only time I use Friday expirations for options is if I'm doing what's called a lottery. Typically, I want to be out in time. I want to be out so that I have you know, a couple of weeks of time on the options, so it's not going to get decayed to death. So I'll go out in time on that. So I don't do a lot of every day. I do it on SPY, like I said, or the Qs, because I'm only going to be in it for a very short period of time. But other than that, I don't do it. How many trade alerts per week? Neil, it's going to vary because I don't know how many good trades I'm going to have. I think this week we had three. I think we've had 5 this week, 5 or 6 this week so far. That's about normal. Some days you're not going to get any. Some days you're going to get 2 or 3. You're usually not going to have more than 4 or 5 trades at the most on at the same time. That becomes a management issue if you're trying to manage that many. So I like to. We had the Hershey's this week. We had quite a few. Actually, we had quite a few trades that we made money on this week. Let me just look here. I can tell you in a second. Yeah, we closed. We had McDonald's, we had Oracle, Hershey, Wyse, all 3 of those for wins first part of the week, and then a McDonald's, and we got a couple trades on right now. But yeah, listen, 5 a week or so. It could be 6, could be 8, could be 3. It just depends. Do I give alert for futures, ES and Qs? I don't know what you mean for alerts. I look at those during the day. I have, in fact, I have the ES up before even market opens in the morning. I follow the ES and the NQ, and I've trade futures sometimes. But if you're looking at the SPY during the day, typically I keep the SPY trade up, the SPY chart up, so I can see what the market's doing. I'm very interested in what the market's doing, because listen, the market drives 75% of the stocks. You really have to know what the market's doing, and base your trades on that. One of the criteria I use for high probability trade setups is we want to trade in, if the market has a direction, we want to trade in that direction. If it's bearish, we want to look to take puts. If it's bullish, we want to look to take calls, as long as the stock we're looking at lines up with a good daily chart and a good 5-minute chart. Do I have a trade mirroring offering? I mean, I said put the trades out, but you have to mirror them yourself. I don't have anything that's going to actually enter the trades for you. In the room, do I focus on SPY super system trades? If they're there, I point them out and I'll take them. But the lineup has to be really good, because you need to have the compass system telling you the institutions are in the trade. Then you have to have the dominator system telling you that the market internals are in the trade, and then you have to have it come to a good support or resistance level. If you're going long, you want the SPY bouncing off support somewhere, off of VWAP or off of a pivot point, or coming out of a compression zone. So all 3 of those things have to be aligned to get the SPY super system, to take those trades. But yeah, I look for them every data system. I've got SPY up so I can see what they're doing. Do you give cheap calendar option trade? The time spreads are calendar trades. The time spreads, we call them time spreads. And basically but I do that over earnings. Basically, I'm trying to harvest the volatility crush when the earnings comes out. So what we're doing is we're selling this week's call and buying next week's call. And typically it doesn't cost much. I mean, they're inexpensive. Usually they run, it depends on if it's an expensive stock, it might be $1.50, but a lot of times they run from 25 to 50 cents, or 25 to 50 bucks basically per contract for the time spread. And you try to take 20 to 25, 30% off a trade like that. Can I show a current chart for SPY 15 minutes and 30 minutes? Yep, hold on just a second. How many trades do I have in the room each day? That again, it depends. It's so dependent on the market. Some days one or 2, some days 5. It just depends. It really does depend. I mean, it's hard to try to quantify how many we take. I mean, it's probably going to be in the room, depending on what the SPY is doing, in the neighborhood of 3 to 5 trades in a day. Because I don't alert on everything. I can't alert on SPY super systems. I can't alert on trades that I think I'm going to be in and out in 10 or 20 minutes, because it's not fair to the alert service. But people in the room can take advantage of that. But for somebody who's an alert, they're sitting with a phone and they get the alert. They don't want to get the alert, go in and try to find the option to put in, and then get an alert says we're out already. I mean, that's not fair to them, and I wouldn't count that as a fair way to do alerts. Let me drop down the drop this down for a second, and go over to all right. So here's the current. This is the current. This is the compass system. Current. This is live. It's SPY. Now I stop the SPY at the end of the day. So I don't. This is. If I was looking for after hours action right here, what I would do is I would typically use like the ES, and the ES is telling me this is a 5-minute chart in the ES. You can see that it's relatively bullish right here, and you can see it's coming up on a dynamic contraction. But notice I've got multi-time frame yellow, current time frame green. This tells me I'm not going to touch this right now for a long. I'm just not going to touch it because I don't have any coordination between these two time frames. So that's why I don't do that. And this is the 5-minute. Let's see if we got 30-minute. I'm not sure what this is going to look like right now. 5 minutes. This is a 15-minute. That's a 15-minute. And again, this is after hours, so it's not going to get all the information that it needs. Typically, I only use the 5-minute in the daily. If I go back to the daily on the ES, there's the daily on the ES. You can see we had a little green candle today. ES has been coming down. It's been fairly bearish. The daily chart on it still is bearish. We had a little pop in the market today, a little doji yesterday. Not much direction in the system. And yeah, anybody, the people in the trade room, they do get the alerts. Yes, if you're in the trade room, you get the alerts. All right, anybody else got any other questions? Otherwise, I'll wrap it up and say how much I appreciated everybody taking time. I know it's been a long day. If you've been listening to the presenters today, a lot of good information there. And again, I feel really strongly about the fact that you need to be able to see what the institutions are doing if you want to be able to trade successfully against other retail traders out there in the market. So I hope you enjoyed it. I hope you learned something from it. Give Rory a call. I'll put your name and number in here in the chat box here, and he will get back to you and answer any questions you got. In the chat box right now, there's links to there's offers out there for the compass system. I'm sorry, for the super system and for the alert service. And again, you can ask Rory if you have any questions on buying into any of the modules individually. So again, I appreciate everybody being here. Thanks so much for your time. And we'll wrap it up for the day. And we'll see, hope to see some folks in the room next couple of days. One more question. Is the compass system similar to the money flow tracker system? It is, Nick. The money flow tracker system runs on Ninja. Compass runs on Thinkorswim. And I'm used to using Thinkorswim, and that's why I use it. But yeah, it runs on Ninja Trader as well. It's called the money flow tracker over there. It's the same information. It's just being presented a little differently from how the compass system looks. All right, I think that's it. So I guess everybody wants to wrap it up for the day. It's been a long day, long trading day. We got Friday coming up tomorrow. I know Jay Powell was speaking tonight at 4 o'clock. I don't know how the market did when he spoke. I go back and look at the SPY at 4 o'clock. Didn't look like it did much of anything. So, all right, again, everybody, have a great evening. And you have the money flow on Ninja, but you were thinking about the compass system. Would it be worthwhile using both? I mean, if you're using, the compass system is running on Thinkorswim, the information is going to be pretty much the same. it's going to have to be pretty much the same as what you're looking for a Ninja and the money flow tracker. Just kind of depends on what you used to like to use, because the compass system is. I mean, I swear by the compass system, but again, I know a lot of people use the money flow tracker on Ninja. I prefer to use Thinkorswim personally, but it's just my own preference. All right, everybody.